listening to Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
All right, everybody. Carol Massar, Alexis Christophorus in for Tim Stenovec on this Thursday. Just a quick rehash of how we ended up on this Thursday. S&P 500 just up about 7.5 points, up 0.1%. NASDAQ 100 down 24 points, down 0.1%. But if you look at the charts throughout the day, we were just kind of all over the place. You said it, I said it, I feel like everybody has said it, that yes, we are definitely counting down to that Fed decision next week. I'm Carol Massar, along with Alexis Christophorus. Let's get to some of the stocks on the move this Thursday. Carmen Reinecke in the house. She's equities reporter and deputy team leader for U.S. equities. Got to talk Ulta. It is rallying big time in the aftermarket.
Yeah, let's look at it. So this is ticker ULTA. Shares of Ulta are up about 5.4% right now. So the company had quarterly earnings and it raised its full year outlook, and it also reported better than expected results in the third quarter. So really what it looks like here is that consumers are definitely happy to keep spending on cosmetics. And this can be, actually a really good sign in the economy. This is a place that people look at. It's like smaller discretionary purchases. So people are definitely still spending on these things, and investors are happy about it, sending the shares up in after hours.
Well, we did see the CEO also talk about consumers remaining cautious, which has really been kind of, I feel like, the watchword or words from
from
many
retailers, no
retail
matter what
CEOs,
kind of retailer you're talking about. It went from Kroger on down, right? I mean, the food companies, the clothing companies. Although Abercrombie and Fitch yesterday had a really nice earnings situation.
Dollar General today too. So they're we're seeing these pockets of like places where people are still spending and willing to spend, and it looks like Ulta.
But Dollar General tells a really big story, right? When they're doing well, it says how people are looking for bargains. All right, so Ulta, it is definitely up 5.5% here in the aftermarket. Let's go to HP, also reported after the closing bell.
Yeah, so this is down about 8% right now. It gave an outlook for sales in the current quarter that was just a little bit shy of what Wall Street expected. So basically they're saying revenue will be about $9 billion. Analysts were expecting, closer to $10 billion. So this is kind of an issue because it suggests that the company isn't meeting some very high expectations for the sales of AI servers. HP is definitely a name that's gotten a boost from the AI trade so far this year. And, that's something that investors have just become sort of increasingly cautious about going forward. They really want to see the results, the ROI, return on investment in these companies.
Is this just an example of like, hey, good is not good enough. You need to just be spectacular?
Yeah, I think that we see a lot of that. We're seeing that, it's not just a beat and raise isn't enough. It has to really blow earnings out of their water. And so then if you fall a little bit short, I think investors have been very swift to punish those stocks, especially if they're a name that's had a big run this year. I'm just going to pull up the year-to-date view. And so,
yeah, I'm curious.
HP,
I was going to pull that up.
It's down. It definitely looks like it got hit in the sort of drawdown that we've seen from October, but it's still up very, significantly since April at least, maybe about flat on the year. So a lot of these names really just under watch by investors. And so we're seeing, HP slip a little bit here.
Yeah. So another after the bell, a company that's a little bit smaller than HPE, Praxis Precision, it's a medical company. And I know that it's a smaller market cap, smaller company. So like the volatility is greater. The stock is up something like 54% here in aftermarket. What can you tell us?
Yeah, so ticker PRAX. So basically it had two things here. So it says that a study of a medication, I'm going to try to say it, Relutrine.
You're brave, man.
Okay.
So basically this company does a lot of sort of nervous system disorders. So this treats essential nervous system disorder, was successful. It also said that it has an NDA for another drug in the works to treat essential tremor. So both of these things were really positive. Shares are off their highs a little bit. It looks like in post-market up about 15%, but you're right, they were up as much as 50% after hours, especially when the headlines about the NDA hit.
Yeah.
And up about 147% year to date, although almost 15% of the float is short. So but it's, one of these high flyers, right, when it comes to biotech.
Yeah. And then not earnings, but a share sale helping out SoFi Technologies.
Yeah, so we're looking at SoFi, ticker SOFI. It's actually down about 5.5% right now. So it's seeking to raise $1.5 billion in the share sale, working with Goldman Sachs, looking to offer shares for between $27.50 to $28.50. So right now it's trading Actually, right about in that rate. It's trading at about $28 per share in after hours. So it's a little bit of a discount to Thursday's close. So it makes sense that the stock would be selling off a little bit here.
Why are they doing this? Do we even know? Oh,
Why are
diversification.
investors doing this?
Yeah, it says, let me see. Our reporting is saying that it's enhancing capital position, new business opportunities.
Okay.
And it looks like we've reached out, but don't immediately have a response to request for comment.
Yeah. Okay. It's interesting, right? Yeah, and it also says
That's a big sale.
right, but
Yeah.
it's looking to diversify beyond lending into other products. So they're looking to raise some money to like expand in terms of business. I'm always curious about why they need why the share sale and what they're looking to do. So yeah, it looks like they're expanding their business. Good stuff as always. Carmen Reinecke, she's equities reporter and deputy team leader for U.S. Equities, joining us here with Stock Movers. You can check it out, the Stock Movers podcast, 5-minute episodes of the biggest winners and losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts. That's going to do it. Thank you so much.
I have had a
You're hanging
you've
around
made
tomorrow.
it really easy. Everybody's been so awesome and gentle with me, walking me through this 3-hour show. But I've had a ball and lots of great conversations and really diverse conversations too.
Well,
It's
it
a
just
lot of
reminds
fun.
you, right? Left brain, right brain.
We're
the
doing it all
world.
here.
Like when we talked to Brad Stone.
I'm tapping my head and I'm doing this with my tummy. You can,
Yeah.
I don't know. Yeah, that's what I'm doing.
We go all over the place. Great stuff, folks. I'm going to take a day off. I'll see you back on Monday. Tim will be back next week as well. I think Alexis
I'm
is
here
gonna,
tomorrow with a surprise guest, I guess.
You're going to guide it through. You're going to do great.
Surprise
It's going to be
co-host.
good. Scarlet Fu is also going to be here, so looking forward to that. Do not go anywhere, folks. Balance of Power starts right now.
This is Balance of Power, live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power alongside Amara Amokwe. I'm Joe Matthew. Tonight in Washington, deeply disturbed. One lawmaker's reaction after seeing video of the so-called second strike that killed 2 survivors of an alleged drug boat. The Navy admiral who gave the orders now telling Congress his account of what did and what did not happen. We'll have a live report coming up. Also tonight, captured. A 5-year-old D.C. mystery is solved as the FBI says it now has the man who planted 2 pipe bombs the day before the January 6 riots. How they cracked the case coming up. Also, a live interview tonight with the mayor of St. Paul, where ICE agents are on the move right now after President Trump's harsh words describing the state of Minnesota as a hellhole and labeling an immigrant community as, quote, garbage. Also, ballroom blitz. Breaking tonight, Trump's handpicked architect heading the East Wing project has been replaced. But we begin this evening with a search for answers. Navy Admiral Frank Bradley briefing lawmakers from both chambers behind closed doors about the U.S. strikes on alleged drug boats outside Venezuela and what exactly happened September 2nd when he ordered the so-called double strike, the double tap on a vessel leaving the country, killing 2 survivors who were in the water. This as top lawmakers reacts for the first time to video of the incident with mixed views. It's a video President Trump says he's open to releasing to the public, and we start tonight with Bloomberg's Skylar Woodhouse reporting live from the White House North Lawn. Skylar, what can you tell us?
Good evening, Joe. The president is standing firm behind Defense Secretary Pete Hegseth, and this comes at a time where controversy is swirling. Calls are being announced for him to step down, but the president is continuing to support the secretary. He, had said yesterday that he would be open to releasing that strike video, and this comes at a time where the administration is really looking to shift the conversation away from what's happening in Venezuela and their handling. They want to talk about affordability. Today, the president was signing peace deals with Rwanda and the Democratic Republic of Congo. So, this is at a time where, look, they're getting a lot of pressure. The pressure is coming down right now in terms of what's happening in Venezuela and their plans in terms of how they're handling these strikes. And it's raising a lot of questions, and soon a lot of answers will have to be accounted for.
Skylar, we also understand that there are new developments with President Trump's plan to build a White House ballroom. What is the latest?
Absolutely, yeah. So what we're learning tonight is that the president has tapped a new DC-based architecture firm to take over the lead design on his the $300 million ballroom project that is happening over just behind my shoulder, really, if you can see, with the East Wing. And this is just sort of the next step as the president looks to sort of make his mark here in Washington, and even more specifically here at the White House, as he really leans into these new renovations.
All right, Skylar, thank you so much. Skylar Woodhouse with us live from the White House as we turn back now to lawmakers' briefing that we talked about by Admiral Bradley, who said specifically there was no kill them all order, as had been reported about the second strike on the boat. But he briefed lawmakers on what took place. They saw the video, and joining us now with his insights is Leon Panetta, of course, the former defense secretary in the Obama administration, who also served as CIA director. And he's the former White House chief of staff to President Clinton, of course, a former congressman as well. It's great to have you back, Mr. Secretary. Thank you for joining us here on Balance of Power. You, of course, have been watching this along with the rest of us, and the saga involving Secretary of Defense Pete Hegseth. As someone who actually held that job, do you believe the allegations that he would have sought to murder two people who were left in the ocean following the initial strike?
Well, I believe it's a serious enough charge that it does need to be thoroughly investigated. And I'm glad that the Committee on Armed Services, both in the House and the Senate, are going to conduct a full investigation, because I really do think that there are a lot of questions here that need answering. And it's going to require a full effort by the Congress, with the ability to look at sensitive information, to look at all of the discussion that occurred during the time of the strike, and to really determine exactly what happened here. I think it does have to take place in order to confirm that that this action was credible.
Yeah, there's reporting today in the Wall Street Journal that contingency plans had been approved by Pete Hegseth in the event that something like this happened. What to do if the initial strike left survivors. The military, as we understand, would attempt to rescue survivors who appeared to be helpless or shipwrecked, but it would try to kill them if they took what the U.S. deemed to be hostile action. In this case, Secretary, we saw one or two of these individuals trying to communicate, they said, with suspected cartel members. Is radioing in a call for help considered a hostile action?
Well, I don't think it would have been considered hostile when I was Secretary of Defense. It was basically a communication. You had two people in the water. They were obviously injured. Hard to comment without looking at the tape itself, but there were members who were obviously disturbed by what they saw on the tape. And it's, it's a stretch to say that two individuals who were in the water obviously were part of the initial attack and had to be wounded, I would assume, that they somehow represent a threat to our forces. I think that's a stretch, and that really does need to be looked at, because it's pretty clear from the law that when you have two individuals that don't represent any kind of threat to our forces, that it would be a war crime to in fact kill them.
Secretary, you have several members of Congress calling for the full release of the footage from the September 2nd boat strike. Could you help us understand what will we be looking to see on that footage to help us answer some of the questions that surround these strikes?
Well, normally, when I was secretary and we conducted any kind of military strike, there would be a tremendous amount of preparations in order to prepare for that. What forces are going to be moved, which are going to be deployed, which ones are going to be used, how are we going to go after the target, what are the contingencies that might be involved here. So there should be a lot of backup material that the Congress can look at in terms of how they prepared for the strike and what contingencies they consider. In addition to that, obviously the tapes of the strike itself, both the initial strike and the follow-up strike, are obviously available. I think they need to be looked at closely in order to determine just exactly what was the state of the two individuals in the water. So there are a lot of questions here that need to be answered because, look, this is a military action. The United States military always operates by the law, and it should. And we're proud of a military that abides by the law and that takes steps to make sure that we don't put their lives at risk. All of that needs to be looked at here to determine just exactly what kind of preparation went into this operation.
Defense Secretary Hegseth is weathering scrutiny on multiple fronts. The White House seems to continue to support him. Seems like several Republicans in Congress continue to support him. Do you think that he should remain on the job?
Well, I think it's an issue for those who are conducting the investigation and who are involved in the committee that oversees the Pentagon to be able to determine whether he bears responsibility here for what happened. Look, I believe that when an operation like this is put into action, that in fact the Secretary of Defense, rather than trying to avoid responsibility, should accept responsibility for what happened, whatever. My view has always been that those are orders that come from the Secretary of Defense and the President, usually, and that therefore both the President and the Secretary have to accept some responsibility for what happened.
Does it tell us anything, Mr. Secretary, that we've started, in fact, helping survivors go home? We saw that after the initial strike, after these two were killed. We actually helped to rescue others and sent them back to their countries of origin. Does that tell us anything about what the Pentagon or the administration think about those first killings?
Well, you know, my logical assumption would be that they learned the lesson from the first strike, and that rather than killing the individuals, it makes more sense to be able to go in and try to rescue those who are harmed and do what they did following that particular strike. So again, I think that is an indication that there are questions about just exactly what were the orders here that were issued? How clear was that? I'm a little concerned, frankly, that the Secretary of Defense, for whatever reason, did not stick around for the second strike, because when you've developed all of the preparations for proceeding with that kind of strike, you would think that the Secretary would be there for the entire operation to make sure that everything was happening according to his directions. So, you know, I understand what the Admiral's saying. I assume we'll have access to his testimony at some point. But I still believe that the primary responsibility rests with the Secretary of Defense.
It's pretty remarkable reporting about not Admiral Bradley, who commanded this operation, but Admiral Halsey, the former head of Southcom. With new reporting, we thought he had resigned based on earlier reports, Secretary, in some sort of opposition to the operation happening off of Venezuela. Wall Street Journal says now Pete Hegseth forced a four-star general out because he voiced concerns about the legality of these strikes. To what extent is this significant to have a commander during an ongoing military operation be taken off the job?
Well, it's very significant because, you know, I have tremendous respect for our commanders, both our admirals and our generals in military uniform. They have experience, they have combat experience, they have respect for the rule of law, they have respect for discipline. They are people who tell it like it is. And I always have respected that in the commanders that I dealt with, is honesty from them. And it's obvious that this admiral was concerned about these operations. After all, there are questions here. You know, we understand this is narco trafficking, but narco trafficking is a crime. It's not a military threat to the United States of America. And so to then implement that rationale that somehow this constitutes a direct threat at the United States is pushing it. And it probably raised some serious legal concerns about whether these actions were legal or not. But what also bothers me is that when a commander expresses his concerns to the Secretary of Defense, that the Secretary of Defense ought to take that kind of advice, respect the fact that the officer had the credibility to speak truthfully to the Secretary. It shouldn't be a basis for dismissal, very frankly. It should be a basis for hopefully further trust.
Leon Panetta, former Secretary of Defense, thank you so much for joining us this evening.
Good to be with you.
Let's turn now to power moves. Stocks rallied today but fell short of all-time highs ahead of next week's Fed decision. We also saw more earnings after the bell today. For more, let's go to Bloomberg's Nora Melinda, who joins us live from World Headquarters in New York.
Hey, so a lot of activities that we've been seeing in the market today, but let's take a look at some of the earnings that we got in the after hours trade. I've got my eyes on shares of Ulta. We're seeing them pushing higher here. This is after some robust demand that we did see. When you think about the health of the consumer more broadly, you've been seeing a little bit of a mixed perspective here. But in terms of Ulta, we're seeing a lot of people spending money on cosmetics, hair products, makeup, and that's really boosting sales over at the company here. So you are seeing the street celebrating with shares up about 5.5% right now in the after hours trade. But switching gears from what's going on in cosmetics over into the land of tech, I'm looking at HPE. That's Hewlett Packard Enterprises. We're seeing shares lower right now in the post market, down about 7% nearly. And this is after its sales outlook disappointed investors. It missed expectations for the current quarter. There's a lot of concerns right now being underscored about it not meeting the high expectations as it relates to its AI servers here. So you are seeing this really taking a beating just a tad here as we continue to look on the sector right now more broadly. But let's take a look about the big picture right now that happened during the trading day. Let's take a look at how major indexes closed. So we did see the S&P 500 ending just above, a little bit higher, about 0.1% higher. The NASDAQ 100 down about 0.1%. And then we also are seeing the Dow Jones Industrial just about unchanged, about 0.1% lower here. But we are really just parsing earnings, continued focus right now, especially as we're looking at the Fed coming next week.
All right, Nora, thank you so much as ever. Bloomberg's Nora Melinda with Power Moves live from New York. Coming up, we'll have the latest battle between congressional Republicans, this time between New York's Elise Stefanik and the Speaker of the House. We'll bring you those details and discuss the latest White House ballroom shakeup with our political panel. They're in next on Balance of Power on Bloomberg TV and radio.
can tell you what comes next. There'll be an awful lot of unhappy people, disappointed people, who will wonder why the Republicans let them down. Here's a situation where a dozen Republicans can make a difference in the lives of millions of Americans, extending a law which was on the books for a long period of time. Do we need to do other things in health care? You bet. Sign me up. Let's do it. But for the time being, let's take care of this emergency situation created by the Republicans in their big, beautiful budget bill.
It's Balance of Power on Bloomberg TV and radio alongside Amara Omokwe. I'm Joe Matthew. That, of course, Democratic Senator Dick Durbin of Illinois. He joined us last evening responding to the latest health care standoff on Capitol Hill and some of the ideas that have been floated. A group now of moderate House Republicans have joined several Democratic colleagues to support a compromise plan to renew expiring Obamacare subsidies. The proposal faces an uphill climb, though, as Republican congressional leaders dig in on opposition to renewing tax credits set to expire at the end of the year. The president hasn't weighed in yet, and joining us now with their reaction to this story and more, this evening's political panel. Bloomberg Politics contributor, Democratic strategist Adam Hodge is with us, managing director at Bully Pulpit International, alongside Republican strategist Sarah Chamberlain, president CEO of the Republican Main Street Partnership. Great to have you both with us. Sarah, you're the first person who told us about a bill that was sponsored by Representative Kiggins, the Republican on this piece of legislation, together with Representative Gottheimer, the Democrat. This is one attempt, and I know they met with Bill Cassidy, the senator, last evening about maybe a bicameral action. John Thune promised a vote a week from today.
It did.
Might it be a bill that looks like this?
It might very well be a bill like this. There's a lot of support in the House to get ACA fixed. The Republican Main Street Partnership Caucus last week came out with a statement. Like, there's 87 of us. We need this fixed. They're behind her bill. Fitzpatrick also has a bill, but right now I think more of them are behind her bill. They want to fix before they go home in 2 weeks. That is a top priority for the Main Street Republicans.
What does it say to you that some Republicans are willing to join Democrats potentially? Does it say to you that Republicans are really feeling the pressure on this affordability question that has bubbled up in recent weeks?
They are feeling the pressure, but also, like, they want to do what's right for the American people. You know, they're not the Freedom Caucus. The Freedom Caucus is kind of all over, and then they won't vote for it anyway. These men and women came here to make a difference, and we can't just leave ACA hanging out there. I mean, too many people can't afford what their new premiums would be.
So how are you feeling about this as the Democrat on our panel? Adam, when we spoke with Senator Durbin last evening, Democrats were talking about a potential 3-year extension to Obamacare subsidies. In this legislation, we have a 1-year extension and new limits on eligibility. Is it something that Democrats can vote for?
Well, first, Joe, I think I take a step back, and I'm amazed that we're at a point where we have Republicans defending Obamacare. But we will take it and move on, because I think it is making a difference in the lives of millions of Americans. I think the Democrats are trying to find a clean extension, right? Part of the negotiation around the shutdown was a 1-year clean extension. I think that's the bare minimum the Democrats would go for, and I think there would make openings for some compromises around the margins, but I think the most effective thing, given how close we are to the start of the new year, to when people are going to see their premiums skyrocket, is just a 1-year clean extension. And then you hope to bridge to a more permanent extension down the road. But I think politically, there's no question that Democrats have been able to flip the script. It fits in with the affordability topic that we're all talking about, that the president, despite his claims about it being, you know, a hoax, are dragging down Republican poll numbers around the country. And I think finding a fix is the right thing to do for the American people. And my advice to the Republicans on their politics is to find a way to do it to help stop the free fall in their support.
Adam, how do Democrats strategize around this issue if a 1-year clean extension ultimately doesn't move forward? Obviously, this is going to be an uphill climb. What's the game plan going forward if this doesn't work?
I mean, just the raw politics of it, I think, and you've seen this a little bit, they will hammer Republicans across the country for creating this mess and getting us in this situation. There is a clean extension that would give people the confidence and the comfort that their premiums won't go up. I think if it fails, this will be part of every single political advertisement that you see from Democrats, both who are running against incumbent Republicans and in open seats across the country, to really drive home this wedge, because it does fit very neatly into this affordability issue. If your eggs are more expensive, if your beef is more expensive, if your burgers at 4th of July are more expensive, and you can't afford your health care, that is a terrible political place for Republicans to be in as we get into the busy season of the campaigns for the midterms.
Well, this whole healthcare debate is coming against the backdrop of some discord reportedly within the Republican conference. Look no further than Elise Stefanik holding a series of interviews, going to social media to criticize the leadership style of Speaker Mike Johnson. She told the Wall Street Journal that she cited matters ranging from members criticizing his decision to keep lawmakers at home during the shutdown, to weak showings in special elections, to what she cast as his failure to address the expected jump in health care costs if the party doesn't reach an agreement on this. Speaker Mike Johnson reacted yesterday. Listen.
All of that is false. I don't exactly know why Elise won't just call me. I texted her yesterday. I sent my friend Elise a text last night, and I said, can you find out what the issue was, and I'll help you resolve it. I support her provision. I mean, I would vote for it. I think it's smart. And I'm not sure exactly why it wasn't included. So I don't know why she's frustrated with me. I literally had nothing to do with it, but I'm happy to roll up my sleeves and help her. I want everybody to be successful, and we're going to try to make the bill as best it can be.
This coming, Sarah, just after Nancy Mace suggested that she might be retiring soon. They're both running for other jobs,
they are.
Though, right?
They both have to be running for governor of their states.
Gubernatorial campaigns, or is there true discord of the family?
So there's a couple things going on there. Nancy Mace, I'm not really sure, just for full disclosure.
Fine.
I do know she's running
Maybe we shouldn't conflate them.
Right. She's running for South Carolina governor. She's been all over the place. Elise Stefanik, running for governor of New York, she has a personal... it's personal with the speaker. You know, she was selected to be the ambassador to the UN.
Right.
That fell through because the speaker was concerned about having such a small margin. So she's disappointed by that. She didn't get her leadership position back because that had already been previously filled by another Main Street member, Lisa McClain. Yeah. So she's kind of a little bit, but you know, Lisa does have some points. Sure. For full disclosure, I'm very good friends with her. She's a member of Main Street. She's a great person. She airs her frustrations. Maybe she should have kept it behind closed doors, but you know, she's not wrong on some of it. And she did get the issue fixed. So you have to, she did get a victory
with that provision in the NDA.
She got the provision back, which is what she wanted.
Joe, I'll just say,
we're peace from here, I'm sure.
The Democrats
yes, it's be peace forever here.
We read you, Adam Hodge. Grab the slushie. Adam Hodge and Sarah Chamberlain, our great panel. Thank you so much. Much more ahead as we turn to the Fed next on Balance of Power on Bloomberg. It's Balance of Power on Bloomberg TV and radio. Alongside Amara Omokwe, I'm Joe Matthew. Thanks for spending some time with us on this Thursday. We'll have more coming up on the president's looming selection for a new Fed chief. But first, the stories we're watching in today's Power Brief. A Virginia man has been charged with placing pipe bombs outside the Republican and Democratic National Committee headquarters here in Washington on the eve of the January 6th riot, ending a 5-year investigation. Brian Cole Jr. of Woodbridge, Virginia, is charged with transporting explosive devices and attempting malicious destruction after being arrested earlier today by the FBI. U.S. Attorney for D.C., Judge Janine, took part in a briefing earlier today. Judge Pirro.
This case involved millions of pieces of data. And it is a huge win because it was like finding a needle in a haystack. So much of this evidence was very specific, but a lot of it was also very general.
And the FIFA World Cup draw tomorrow in Washington, D.C. is adding Canadian Prime Minister Mark Carney and Mexican President Claudia Sheinbaum to the star-studded list of attendees. Both leaders have confirmed that they will hold a short meeting with President Trump during the event, with the president saying that he is willing to talk trade during these conversations. Sheinbaum said she's planning to address auto, steel, and aluminum during her first ever meeting with the president. Carney and Sheinbaum will also meet with each other in anticipation of next year's review of the U.S.-Mexico-Canada Free Trade Agreement. And President Trump earlier this week continued to tease Kevin Hassett as a potential Fed chair. Take a listen.
I want to thank you all for being here. It's a great group. And I guess a potential Fed chair is here, too. I don't know. Are we allowed to say that? Potential. He's a respected person, that I can tell you.
Bloomberg News reporting last week showed that National Economic Council Director Kevin Hassett is seen as the frontrunner for the Fed job. While President Trump says he will not make that announcement until next year, markets are currently looking ahead to next week's FOMC meeting, where it's expected that interest rates will be cut for a third straight time. Joining us now with the latest here in Washington is Bloomberg's Enda Curran. Enda, good to see you. So markets are fully pricing in another rate cut next week, but that doesn't mean that this meeting is going to be uneventful. What can you tell us about what to expect?
It's expected to be a pretty close decision, Amara, as you well know. We have people on the policy committee who are more worried about inflation, some people on that committee who are more worried about the state of the labour market. It will depend just how deep that division is in terms of what final decision does come out of it. If they do cut next week, for example, they may perhaps suggest they won't be cutting in the months forward. But so there's a lot to come out of in terms of the details beyond whether or not they do cut.
We've been talking a lot about affordability and rising prices recently, but is it not the job market that the Fed is more concerned about?
Well, there are those on the committee, as I say, who are more worried about where inflation's at. We get PCE tomorrow. Core PCE will be very important. That's the Fed's preferred gauge of inflation. That will suggest where things are headed on that side of things. We haven't had official labour data. We have had soft private sector data like the ADP numbers suggesting the labour market is weakening. If that flows through, it will be enough to tip over the doves to just to win the day in terms of whether to cut or not.
Lots of news in recent days about Kevin Hassett emerging as the frontrunner in the Fed chair search. What are we learning about how markets might react if he is indeed the pick? What are you hearing?
Hints of a pushback, I think, Amara. Our own Bloomberg television colleagues interviewing some people overnight from the market side of things, expressing some concern. Other economists also going on the record to say that their worry is he might be seen as too politically aligned with the White House, maybe too politically invested, will not do enough to protect the independence of the Fed. That's the critical concern, and therefore, by extension, the worry is we would make policy error and lose the confidence of markets. Now, to be fair, we're not there yet. Mr. Hassett hasn't been announced. We don't yet know what he said. He has said he would protect Fed independence if he got the job. But right here, right now, there are certainly some concerns among Fed watchers as to whether or not Fed's independence would be protected.
This also reporting of Scott Bessent, if indeed Hassett is tapped, taking his job as the leader of the NEC inside the White House. That would be 3 hats, I believe, that he would be wearing. He's also still acting commissioner of the IRS at this point and speaking on a daily basis in the media defending the president's economic policies. Does he have the bandwidth for all of that?
Well, there obviously are a lot of moving pieces in the economic jigsaw over the White House at the moment. But if Treasury Secretary Bessent did take on that job as well, NEC, IRS, and of course the Treasury, it would surely make him one of the most powerful Treasury secretaries in recent years. And of course would give him broad oversight on economic policy at a time when the White House is hammering the Fed for not bringing down interest rates quickly enough. So if it makes him more powerful, you would have to say it might put more pressure on the Fed.
Yeah, got it. And great to have you. Bloomberg's Enda Curran with us in Washington. Joining us now with more insights, Claudia Sahm, Chief Economist at New Century Advisors. It's always great to have you, Claudia, on Bloomberg TV and radio, and we welcome you. We'd like to talk about both of these tracks with you, not only what the Fed is doing, but also who might be tapped to replace Jay Powell. And it does seem that Washington has its head around, the market's getting its head around Kevin Hassett. But what about next week's meeting? Is a cut in the bag?
I would say a cut is highly likely, but I also think there's a very high likelihood that they'll be signaling the likelihood that they'll pause after that. They're going to want to see a lot more information. They will have completed 75 basis points of cuts, and we haven't seen any improvement on inflation this year, right? So like the reason there's so much disagreement is it's a really tricky situation for the Fed with concerns about the labor market and concerns about inflation at the same time. So I do think they will do another cut, but I think they're going to really tell us, hey, we've taken in the insurance and now we're going to see how this plays out.
Claudia, headed into this Fed meeting, we heard a lot from Fed policymakers, and we saw the growing divisions among them about the outlook for the labor market and inflation. Is a divided Fed going to be the new normal as we head into 2026? And if it is, does that worry you at all?
So the division that we're seeing at the Fed is because the economic picture is really complicated for the Fed, right? Like this very much flows out of a difficult moment where inflation is still closer to 3% than 2%. It's been above the 2% target since 2021. And we have a labor market that is clearly slowing down, but like how worried we should be about this? Is this kind of a normalization, or are we getting ready to go off over a cliff, right? And so I think, you know, the disagreement we see right now, this is very healthy. I think it is notable that the one person out of the 19 that we didn't hear from was Jay Powell, the Fed chair. He was letting everybody speak, so we heard all their views.
Does that strike you as Chair Powell trying to sort of maintain optionality going into this meeting? Or what did you make of the fact that we didn't hear from Chair Powell headed into the blackout period?
So I think this was him being a leader of the Fed and wanting to make sure that all of the voices that were heard, I mean, they have been engineering, you know, rate cuts. This disagreement has been happening, but they have been moving the Fed funds rate lower. And the thing is, if Powell had come out and spoken, we wouldn't have paid attention to the other people, because there is this view, I think it's not a correct view, that the Fed chair is in charge of the Fed. Like this is just all, you know, what the Fed chair wants is what the Fed chair gets. But this was an opportunity for us to really hear what an independent Fed looks and sounds like.
I want to ask you about a point that you've brought up a couple of times here, which is the fact that we've had inflation above the Fed's 2% target for several years now. We heard several policymakers talking about that as we headed into this meeting. At what point does the Fed start to risk its credibility on inflation if we continue to have inflation lingering above target?
Well, I mean, you certainly will hear plenty of commentators say that the Fed has already lost credibility, you know, from inflation, you know, being higher early in the recovery from the pandemic, and then that we still aren't at 2%. What we haven't seen, though, is in terms of like market pricing, inflation compensation, the expectation, it looks like we still have, you know, people that are putting money on the line are still with the Fed in that inflation will get back to 2% in the next few years. And households, too, have been largely on board with eventually, you know, the inflation is going to come back down. Now, that's something that the Fed doesn't want to be cavalier about. They don't want to take for granted. And, you know, especially the Reserve Bank presidents that are out in their communities, like they are hearing a lot about affordability concerns. So like the Fed has to take this seriously. They are taking it seriously. But again, it's a tricky situation. People want inflation down, but nobody wants a recession.
Well, as you know, Claudia, it's been a bit of a data desert recently because of the government shutdown. And I wonder if the Fed is leaning harder into privately sourced data, whether it's ADP or something else, and what the side effects of that might be.
Right. So the Fed is data driven, right? They're always going to want more information. Sure. It has been difficult that the government data is delayed, and it's unfortunate they're not going to get the November employment report until after they have to take this vote. So they've been leaning harder on the private sector data, but they've been using those data for some time. These are not new data. So I think it adds some complexity, some uncertainty to their decision. But, you know, that's just, I think it's great. The alternative data, the private sector data can fill in some of the cracks, but we absolutely need high quality government statistics in a timely fashion, and we're going to get back there, but that's going to be a much better place for the Fed and for all of us when we have those data as well.
You know, affordability has been the key word around here recently. The President Trump seems to think that it's a new word. In fact, he called it a Democratic hoax. And I just want you to listen to the stylings of the president on this issue that, in fact, got him elected to begin with. Listen.
My administration and our partners in Congress will continue our work to lower the cost of living and make America affordable again. Affordability, they call it, was a con job by the Democrats. We did a great job on groceries and affordability. The only problem is the fake news. There's this fake narrative that the Democrats talk about, affordability. They just say the word. It doesn't mean anything to anybody. My administration has taken historic action to lower costs for American consumers. Just about everything is down. You know, this whole thing is, they use the word affordability. It's a Democrat hoax. I think affordability is the greatest kind of...
So let's ask Claudia Sahm, is affordability a Democrat hoax?
No, affordability is not a hoax. Now, I will give the president, there's more to unpack here. Like, affordability is not just about a price tag. Affordability is not just about your paycheck. I do think this is something bigger in terms of, you know, we've just in the last 5 years been on a real roller coaster. And so even if people look better on paper in terms of their wages are higher, they're handling these higher costs, there's a lot, people are unsettled. There's been a lot of uncertainty. This has been very traumatic. So it's not a hoax. This is a real issue. We do have to be mindful of any kind of policies that are pushing more costs into the system, like tariffs, that, you know, can potentially push up prices. And keeping the labor market firing on all cylinders is incredibly important for Americans. So I think this is a tough nut to crack. And I do worry that there will be some attempts to do really easy policy fixes, like jam down interest rates really rapidly or send out checks that aren't really going to solve the problem. And there is a real problem here.
Claudia, I want to turn and ask you a little bit about the Fed chair search. We here at Bloomberg are reporting that Kevin Hassett is now the front runner in that search. The next Fed chair will have to balance the president's desire for drastically lower interest rates, as you just mentioned there, with maintaining credibility in the markets, maintaining credibility on Fed independence. Does Kevin Hassett strike you as someone who can strike that balance, that very difficult balance?
Kevin Hassett absolutely can strike this balance. So he began his career as a Fed economist. So he understands the institution, the way it works. He knows that, you know, we talk about the Fed being data driven. That's because those data, they come into the discussions, the debates that are had around the table. It takes 7 people to vote for a rate cut. So he is one vote of 7 that can get a rate cut across the line. And so he has the skills. He understands the institution. But it is a question, and unfortunately it's a question that's kind of been forced on him because of the way this whole process is run out, is which Kevin Hassett shows up. Is it the skilled independent economist, or is it someone that's, you know, part of Trump's political apparatus? That's what he is right now. That's his job right now. As Fed chair, he has to set that aside and become nonpartisan and data-driven.
It's always great to spend some time with you, Claudia. Thank you for the insights. Claudia Sahm, Chief Economist, New Century Advisors. We thank you. Coming up, President Trump announcing his plan to deploy federal immigration officers to target specifically Somali migrants in the Twin Cities. We'll speak with the mayor of one of those cities next on Balance of Power on Bloomberg TV and radio.
the last thing that we need is federal agents coming here, pretending that we should be afraid of somebody just based on the color of their skin, just based on what they look like. The last thing that we need is federal agents coming to town attempting to turn us against each other, to turn us against ourselves. The last thing we need is federal agents coming in town to create chaos.
It's Balance of Power on Bloomberg TV and radio alongside Amara Omokwe. I'm Joe Matthew in Washington. That was the mayor of St. Paul, Melvin Carter, responding just a couple of days ago to comments from President Trump this week in which he announced that he's planning to send immigration officers to the Twin Cities in an effort to target specifically Somali migrants. Joining us now live with his response to the president is Mayor Carter. Mr. Mayor, welcome to Bloomberg TV and radio. We've got a lot of questions for you, but I'd like to start just with a status update. What is the level of anxiety on the ground in your city, and have you seen any federal agents yet?
Thank you so much for having me on, and thanks for the question. That's so critical. The anxiety level is high. The anxiety level is high in our community. Fear is high in our community because of our federal government's what they call, at least, their public safety strategy. One of the things that I shared in that speech is we sure need public safety strategies that reduce fear, that bring stability, that make people feel more safe. What they're talking about and what they're doing is doing the complete opposite. It's got folks, struggling to make sure they keep their paperwork, their citizenship papers, their immigration papers with them, and it's just a scary time right now.
Well, I mentioned the words of President Trump. We heard your response, but I want to bring people back to the White House for some offhand remarks that he made the other day. Yeah. And it's not the first time that we've heard him attack Somali migrants to begin with, including Ilhan Omar, the congresswoman from Somalia. Listen to President Trump and the way that he framed this community.
We're going to go the wrong way if we keep taking in garbage into our country. Ilhan Omar is garbage. She's garbage. Her friends are garbage. And from where they came from, they got nothing. You know, they came from paradise, and they said, this isn't paradise. But when they come from hell, and they complain and do nothing but we don't want them in our country. Let them go back to where they came from and fix it.
Wait, Mr. Mayor, I'm sure I'll get a lot of tweets about this, but I'm just trying to figure out how we're having this kind of language in the public square in 2025. What role do Somalian migrants bring to your community? Tell us what we should know about them.
Well, first of all, we know that we have a president who holds on to his space at the center of the public square just by coming up with the most despicable thing he can possibly say and say it out loud, and to try to make sure that everybody's arguing over what he said. That's disgusting. Second of all, as he talks about Somali Americans, their country is America. They are Somali Americans, and that's one of the challenges that they're going to have, is that they're going to find that the vast majority of Somali Americans in St. Paul and in Minneapolis and in Minnesota are citizens of the United States, a very large number of them who were born in the United States. And so, when he says their country, he's talking about the United States of America. He's talking about this country right here. He's talking about, teachers. He's talking about religious leaders. He's talking about entrepreneurs and business leaders, people who are pushing to achieve the American dream. When I grew up in school, just like many of us, that was a point of pride for America, that this was a place that people could look to from other places and from across oceans and say, I want to come here and pursue my dreams. It seems as those waves of immigrants have shifted from primarily being in Europe to being in Asia and Africa, our position on that has fundamentally shifted. But make no mistake about it, to hear a United States president saying he doesn't want Americans in America is a statement of incompetence. And I agree with him. He's incompetent to do the job.
Mr. Mayor, one of the reasons that the Somali American community there has caught the attention of President Trump is because of this issue with fraud in the Minnesota social services system. I wonder, what is your response to the president and others using that fraud issue to kind of lob broader criticisms at the Somali American community?
Yeah, we have I think, the largest Somali population outside of Somalia. We have an enormous Somali population. Like I said, people running stores and people who are students in our schools and educators and things like that. it is true that a very, very small number, comparative to the size of our Somali community, a very, very small number of people in our Somali community have been found guilty of committing fraud. Now, I'll tell you, if the president's mad about that, wait till he finds out how many white people commit fraud in America and how much fraud white people have been accountable for in this country as well. But we all know that to take the actions of a handful of people, and by the way, that includes the mastermind of that major scandal, is called our Feeding Our Future scandal, who was a white woman, not even a Somali person. But we all know to take the actions of one person or the actions of a few people and impute them across an entire group, that it's been asked and answered for a very long time. That's not what we ought to do. It doesn't make logical sense, and it certainly doesn't make human sense. And what we see on TV is an individual who seems to be aggressively losing his grasp on reality, someone who clearly has never been to a mosque or never been to a Somali mall in Minnesota or in Minneapolis, giving his opinion, which is unneeded by anyone here and really by anyone in the country.
Mayor Carter, have you heard from the administration on this? Have you been contacted by ICE? Or are you hearing about this in the media like everybody else?
We're hearing about it in the media. They don't, and they know that we despise their approaches. We have said loud and clear, we need public safety strategies that make us safer. We see ICE agents just sort of show up, and we track them on, social media, and we track them through the media. We track them through the rumors that we hear. Our police officers and folks kind of see them in community, or our rec leaders might see them in community and flag something for us. We're a community that, and it's really clear that we don't need them. We're a community that we solve 90 to 100% of homicides in this city. We've got gun violence down 70%. We've tripled our case clearance rate for non-fatal shootings. Nobody holds lawbreakers accountable better than our local police officers do here. So we don't need their help keeping us safe, and we don't need them. We absolutely don't need them parachuting in. They came in a couple weeks ago and arrested, set up a raid at a manufacturing facility, arrested 14 people, released a statement a couple of days later to say that one of those 14 people had some previous charges, not a conviction, that one of those 14 people that they created this big, huge carnival over had some previous charge. So that sounds to me like every single one of them were people who have never been convicted of a crime who were just trying to go to work that morning. So we don't need their help. We don't need their brand of public safety. And they've heard me say that so many times. They don't seek to come and coordinate with us or work with us on any of those types of things. They come in and set up chaotic moments that we end up having to deal with. And we're tired of it.
Mayor, stay in touch with us as this gets better, or bigger, I should say. I appreciate it, and I hope it does get better for St. Paul. The mayor of St. Paul, Melvin Carter, thanks for being with us here on Bloomberg.
Thanks for having me on.
On a lighter note, happening right here, right now in Washington, D.C., is the annual lighting of the National Christmas Tree. If we can show you, if you're with us here on Bloomberg TV or on YouTube, a live view from outside the White House. That's on the ellipse just across the way, Amara. That might be the coldest night I ever had on pool duty at the White House, and I almost missed the motorcade home. But the president will soon be there, and it is kind of nice to see the tree lighting.
I love Christmas. I love the tree
lighting. Yeah, you're feeling this?
It's my favorite time of the year.
It's getting a little cold out now, but
that's okay.
We're ready for it, right? We had, of course, the congressional Christmas tree lit a couple days ago. Then it was the Pentagon. Now this is the big one. If you've ever been to Washington, the ellipse right across from the White House, on the way to the mall, soon to be lit with a big ceremony and concert that'll be happening shortly, about 5 minutes from now. Check out the Washington Edition newsletter. You got a lot to catch up on. You can find it on the terminal and online. And following that briefing today on Capitol Hill, you'll have a lot to learn. We'll see you back here tomorrow. Alongside Amara Amokwe, I'm Joe Matthew. This is Balance of Power on Bloomberg TV and radio.
This has not been a great time for genius. The people who claim to have it do not seem to qualify for it. The people who diagnose it in others seem to have a very, very narrow definition in mind. And the people we can all agree are stone-cold geniuses always seem to have a dark side. I read in Bloomberg Businessweek about the biggest crypto genius of them all, Sam Bankman-Fried. At his peak, he was worth like $26 billion. And that was before he was accused of running one of the biggest frauds in American history. His defense is that he is not a criminal, essentially, just inept. What does it mean to have genius in work, in the marketplace, in life? And who is even to say? To make anything simple takes actual genius, and we're going to try to live up to that name together tonight. It's the Business Week Show. Hello, I am Max Abelson, and I'm not a genius, just a regular, like slightly above average journalist who has spent about the last decade and a half here at Bloomberg News and sometimes our magazine, Bloomberg Businessweek, writing about Wall Street's money and power. And what that means is I write about ambition and ownership and imagination and survival and risk and second acts and, of course, genius. Tonight, and in the weeks to come, we are going to be talking about those things at this table with people whose lives and careers and ideas are big or interesting or just really fun. So, welcome. This is the Business Week Show, and it's starting right now. If you consider yourself a master of Wall Street, a connoisseur of investing, a soothsaying financial genius, a brilliant portfolio manager, our guest has very bad news for you. Burt Malkiel's book, A Random Walk Down Wall Street, 50 years ago, had a clear and vivid message, which was that Wall Street genius is really just an illusion, and that professionals in pinstripe suits, at the end of the day, are no better than naked animals. It was a genius and radical idea, because what he had to say is that you should forget them and just buy and hold clear, boring, basic, low-cost index funds. He is here to tell us about it. Burt Malkiel, welcome to the show.
Thank you very much. Glad to be here.
Your book is actually pretty funny. It's a little saucy sometimes, your book. I mean, you say no one in finance can really forecast the future, or at least they can't do it successfully, consistently. You know, I think you use the word genius in quotation marks, and you give it to Ponzi schemers and whatnot. Right now, are there any actual individual geniuses on Wall Street? You know, real human geniuses, maybe AI is a genius we've been all waiting for. Can you identify any current geniuses on Wall Street right now?
Well, as you know, I put genius in quotes because I'm not sure there are geniuses in the market. And I've always said I would much rather be lucky than smart. Are there some hedge fund people who have, in fact, made a lot of money? George Soros bet against the British pound and made a lot of money. There were people who sold short in 2000 and made a lot of money. But I am not willing to say that they were geniuses. I want to say that they were lucky, because for every one of them, there was a hedge fund that in fact lost money. No, I don't think there are geniuses. I think there are a lot of very smart people in Wall Street, but it is not possible to predict the future. And, you know, it's kind of very interesting how you talk about AI. I recently had to give a presentation on the economic outlook. And I thought, you know, just for kicks, I will go to ChatGPT and I will ask, can you give me an outline of what I should say? And actually, ChatGPT gave me a wonderful answer. It was a one-sentence answer. I cannot predict the future.
It might not necessarily qualify as genius, but you're able to write about Wall Street with clarity, which is really unusual because Wall Street, and I suffer from this myself, you speak to Wall Street executives and they absolutely fetishize complexity. Why does Wall Street like to make things sound so complicated? Is there something sinister or something that has to do with the ego?
Whether it's sinister, but this is a very highly paid profession. And someone like me who says, listen, don't listen to anybody, just buy a simple index fund and keep on investing period after period. If I'm charging you 2% a year to manage your money, I want you to think you can't do it yourself. So sure, you've got a vested interest. This is a very highly paid profession. These guys do very, very well. Is that sinister? I don't know. You call it sinister, anything you want, but is there an incentive to make it seem like it's very complicated, that ordinary people can't do it themselves? I think that's absolutely right.
The honest truth is, it's not necessarily that I think that the aura of complexity on Wall Street is coming from a sinister place. More like it makes me feel bad or makes me feel dumb, and that I appreciate that your book is sort of written so that I can understand it. But it does make me think about exclusion in a small way, because so many stocks are owned by so few people in this country, because the very wealthiest people in America have such giant portfolios, that when the stock market goes up, inequality goes up too. Is there anything that can be done to change that in the future?
One of the things that's impressed me throughout my life is really how capable so many people are. And I think to the extent that we can eliminate discrimination, I mean, for example, opening up our jobs, our economic opportunities to women has been a very good thing, and I think has been generally helpful for women. I think it's the same sort of thing in terms of racial discrimination. I am absolutely convinced that rather than there being just a small coterie of geniuses, that intelligence is very widely distributed in our population. And so my own sense would be the more we can do with education, the better.
Why is it that we need geniuses, or really just the concept of genius? Is it like the way we need heroes and heroism, to help just explain the world and justify?
I think we need innovators, and I'm not saying that innovation isn't good. We absolutely do, but I'm not going to call them geniuses. And Jack Bogle would certainly have never have called himself a genius. But I think we do need innovators. There will undoubtedly be financial products that are actually good for one. I'm not a fan of Bitcoin. I don't think, I don't recommend that any investor buy it, but will there be improvements in the payment system in the future? And will there be digital currencies in the future that are stable and that are useful, as opposed to something that goes up $1,000 or down $1,000 in a day? Absolutely. And there's room for much more innovation in finance. So I think there will be innovation. There should be innovation. I just wouldn't call it genius.
That was great. Burt Malkiel, thank you so much.
Thank you so much. I really enjoyed our conversation.
Stay tuned, because next we have a very far out genius. There is no one way to be a genius. You could be dreamy and far out. You could be scrupulous and scientific. You could work within the institutional establishment, or you could honor indigenous wisdom. All of those descriptions apply to this guest. Moraba Jah is a space environmentalist, an astrodynamicist, a spacecraft navigator, and the first African-American professor of aerospace engineering at the University of Texas. Last year, the MacArthur Foundation gave him a fellowship that is informally known as a Genius Grant. So, if you want, you could call him a genius, you could call him Professor Jah, but you'd rather you call him Moraba. So, Moraba, welcome.
Great to be here, my brother. Thank you so much.
Really glad to have you. I really love the phrase, a stroke of genius. You were in Alaska with your family in a hotel one morning. I think you were taking a shower.
Yeah.
And you had this feeling and this vision that kind of struck you. And whether or not it has anything at all to do with genius. Tell us about that moment.
I'm in the shower, and I felt a presence. And in my mind's eye, I saw flashes of scenes from like history and how in the beginning, whatever that means, it seems like there was this intergenerational contract of stewardship with the planet, but that humanity over time has mostly abandoned that intergenerational contract of stewardship and has forgotten about how interconnected things are.
Did that moment change the life you led and the work that you do?
Absolutely. So one of the people that I really look up to is Jane Goodall. I watched something about Jane where she said that she went to a meeting as a scientist and she left that meeting an activist. In very similar ways, I went to Anchorage kind of just this scientist, and I came back both a scientist and now this space environmentalist activist to really try to, I guess, really showcase how we need to protect orbital space.
If there's a kind of genius that means something to you, something that you would want to live up to, or something you'd want to recognize in yourself, what would that kind of genius actually look like?
To me, the best kind of genius is simply allowing myself to let the universe go through me and, I guess, use me as some sort of vehicle for the work that I'm trying to do. And if I can keep myself kind of in the moment and in a place of compassion and empathy, then I think genius is just what comes through when you allow that to happen.
There's more garbage orbiting the Earth than there are working satellites. You now work not just to make sure that all that stuff is properly tracked, but to be an evangelist for expanding the way we think about environmental protection so that it includes all that stuff. What can those of us who are not scientists, what can we do to help you?
Every day, the technologies that we have are more and more reliant on these robots in the space that we call satellites. And we're tracking about 50,000 things ranging in size from a cell phone to the space station. 5,000 are working and everything else is garbage. So that's like 90% of the stuff is trash. The thing that most people just don't realize is that these satellites that are providing these critical services and capabilities, position, navigation, timing, communications, internet with the Starlink satellites, right? Any of these things can get schwacked, that's the technical term, get schwacked by a piece of junk, and then it's game over, and then you lose that capability. So I think more and more people just need to be aware that, oh, well, that space, that's somebody else's problem. No, it's our problem because our way of life, our technology is now going through this infrastructure.
There's a real stereotypical idea of genius that I'm thinking of a kind of solitary genius working by herself or himself off in a fun cabin, you know? What does it mean, what would it mean to be a genius collaborator?
Back in the times of like the Renaissance, people looked at folks like, Da Vinci, Michelangelo, and they said, okay, these are geniuses in their own right? And people say, well, how can anybody be like another one of those? Science has developed so much beyond those days that there's no way for somebody to be able to be, quote unquote, this Renaissance person that knows very deeply things in all these different fields. Like, those days are gone, okay? But to me, the real genius is recognizing where you bring in smart people from other fields that complement and augment your own to solve wicked problems.
Yeah, connectedness, connections with one another. But my understanding, though, from reading a little bit of your writing, is that you were, I think in your childhood, you felt really isolated.
I did, yeah. My mom was born in Haiti, and she was naturalized citizen. My father, Sierra Leone, naturalized citizen. They got divorced when I was very young, and yeah, my father was just very abusive. So at the age of 7, he kidnapped me, and 9 days later, they found me in some apartment in the Bay Area, put me back on a plane to my mom, and my mom had, we had a cousin that lived in Caracas, and so we fled the country because my mom's like, I don't want your father to ever find you again. He never did physically again. But growing up in Venezuela, I felt very isolated. I felt very alone. I came into contact in this void with what seemed to feel like an ocean of infinite love and compassion. And then I realized, I have a choice here. I can choose to meet my experiences with equal anger, or I can choose to act from a place of love and compassion and heal from my pain and make my healing be of service to others. And that's what I've chosen to do.
When the MacArthur Foundation, when they named you a fellow, they said it was because, they used a beautiful phrase, it's because you envision transparent and collaborative solutions for the Earth's orbital spheres. What are those solutions? And maybe when are they coming?
My inspiration for this comes from indigenous people, from traditional ecological knowledge, TEK, I call it ancient tech. And so for me, the vision of my future is seeing Western science and traditional ecological knowledge come together, not annihilate each other, but actually harmonize with each other, so that then that could be the way of the future, so that humanity does recognize interconnectedness, empathy, and stewardship.
Thank you so much for being here and sharing your story, sharing yourself.
Thank you, brother.
Truly enjoyed it.
Thank you.
Coming up next, a genius I would like to be when I grow up. Getting older is not easy, but the good news is time brings opportunities to become a more practiced, a more seasoned, a more you version of you. The guest who's sitting with me at this table is one of the most accomplished people I've ever met, and she is 17 years old. In 2021, Zaila Avantgarde won the Scripps National Spelling Bee. But She considers herself not so much a speller as a basketball player, and she has multiple Guinness World Records in juggling. A few weeks ago, this young genius started the 11th grade. Zaila, so glad you're here.
Thanks for having me.
Truth is, we're all super different. We all have our own gifts. We all have our own limitations. When and how did you come to realize how special you are?
So that's a complicated question, I would say, because I didn't so much realize, I realized I was special, but I became special through a process of like training and stuff. If you look back on it, like I wouldn't say I popped out the womb like a genius or something like that. It's like when people would start to stop and look at me while I was dribbling or practicing at a court, people like stop and look because, hey, look at this cute little girl. I was very small when I was that age. So this cute little girl dribbling 2 balls and doing all this between the legs, step backs into shots and stuff. So pretty early on, I realized that, yeah, I might be a little bit different than the average kid.
You won this like completely beloved national competition, but it's something that I think you no longer consider your main passion, or maybe you didn't even consider it your main passion then. What does basketball make you feel that spelling doesn't?
I would say basketball gives me even more of like the competitive rush. Like I just really love to compete and stuff. So like, and like spelling is more like, yes, it's not really like person-to-person competition. It's more like person versus dictionary, which is something you hear a lot from spelling bee people. It's like it's me versus the dictionary, because that's where the words are coming from. Whereas with basketball, it's more like physical competition, like, oh, I made it between the legs and there's this girl on me and I have to shield her off, and it's like more tangible competition as opposed to the more philosophical competition of spelling.
I want to ask you about a very different kind of genius. There's this billionaire named Sam Bankman-Fried. Think you've heard of him?
Of course.
Widely considered to be the world's, great crypto genius before he was then charged with fraud, which he has denied. How should the rest of us look at people who get called geniuses, but maybe they still have shortcomings, just like everybody else?
Sometimes I feel like the term genius is like nowadays it's so loaded. Like it's not, maybe it's like, oh, it doesn't just mean, oh, look at her, she's a genius, like she's so smart or whatever. But like then like if you're labeled with that like your whole life, that kind of like puts a pressure on you. Like maybe once upon a time, like I listened to a podcast about Sam Bankman-Fried, but I don't know him personally, so I can't speak for him. But hypothetically, like he's like his parents are like, oh my God, you're so smart. He goes to accelerated programs in school, and that's just putting pressure from a very early age. Like I'm a genius, I have to be a genius, I have to always be a genius. So I always feel like people like some of the scammers and stuff should get maybe just a little bit of sympathy, just a little bit, because they are like causing all sorts of trouble, because like they've been considered geniuses their whole life and they had a nice business plan or something, but then it didn't work out. And so what are they supposed to do? Go to all these people who say, oh, you're a genius. That just puts a little pressure on you to like give you that extra push you needed to try to maybe go into the murky waters of life.
The murky waters of life. I want to ask you one final question about pressure. I think that there is sometimes pressure in the United States, maybe everywhere, pressure on really smart people, genius or otherwise, to use their intelligence to like make a lot of money, to be successful. And like, I guess I'm thinking specifically about the finance industry and mathematicians, but it's true of the business world. You're smart, you go make money in business. Do you have a favorite company or an industry or like a job that appeals to you?
I mean, I'm not like super like make millions of dollars. I mean, if anybody who's watching or listening wants to give me millions of dollars, please hit me up. However, like I'm interested in going to neuroscience or maybe working for NASA or maybe being an NBA head coach. But I just realized I've never thought, how much money would I get for this? Because that's not really something like I think of, because you can make a lot of money, not to sound trite, but you can also be really miserable making a lot of money. So that's not even something I actually consider, like how much money will I make? I'll cross that bridge when it comes.
Zaila, you're gonna cross the bridge, you're gonna have a great time. I have had a great time talking to you. I'm thrilled you're here.
Thanks for having me.
When you ask geniuses, as I just did, what a genius is, or if we need geniuses, or if they're a genius, the answer you'll get will be genius. It turns out that there is not one way to be a genius of finance or of art or of language, just as there is not one way to think about genius itself. What matters is not what you call unusually high levels of intelligence or talent. What matters is what you do with it. Thank you so much for watching the first episode of the Business Week Show. We'll see you again for another one soon.
I am a completely virtuous person. I have no missing virtues. But I do wish I could sing.
People clearly tend to be impatient where they should be patient.
I waste the most money on champagne. I love champagne every day. Every day I have 2 glasses of champagne. That's my thing. 2 glasses of champagne every day.
Risk is everywhere. It is a risk to get out of bed, take a sip of coffee, step into the street, shake someone's hand, eat a tuna melt. Trust risk betrayal, authenticity risk rejection, and if you want to play it safe, doing nothing risks missing out on everything. We associate risk with what you might lose, but there is no winning in the marketplace without it. If anyone ever comes up to you and offers you something that is completely risk-free, buyer beware. Nothing ventured, nothing gained. I read this thing in Bloomberg Business Week about Silicon Valley Bank, which bought billions of dollars of bonds, a risk, and the value of those bonds fell, depositors went running out the door. The impact of that risk was one of the biggest bank failures in the history of this country. What does it feel like to take risk in business and in life? We're gonna try to find out from actual risk takers. It's a risk, we're gonna take it together, and we're gonna take it tonight.
It's the Business Week Show.
Welcome to the Business Week Show. Tonight, risk. The very idea of who gets to take financial risk in global markets and how they go about taking that risk and then how they talk about that risk changed thanks to tonight's first guest. In 2012, Jamie Rogozinski logged onto Reddit, he started a new page, and he called it Wall Street Bets. In the years that followed, it got millions of users. It sparked real frenzies in stocks like GameStop and AMC, and at one point, it got its own Super Bowl ad. But As you may imagine, things did not work out all that well for everyone, and Jamie is here tonight to tell us all about it. Jamie, seriously, thanks for being here.
Thanks a lot for having me.
Risk is a funny thing because it freaks some people out, me included, but there's also something about it that is so attractive and so tantalizing. Why have you been so drawn to it?
Risk is a funny thing because when people say risk, especially when you frame it that way, the implication is either there's an element of randomness, right, or that's the outcome can be very, very costly because it's either unlikely to pay out or the actual, chance of losing might be really costly. But the way that I see risk is really, if you're able to actually quantify those elements, it's really a price that you pay for an opportunity. The way that I look at risk in that sense, it's not that I'm attracted to these thrill seeks. It's, I think this is worth it, right? I think I can identify these are the probabilities or possibilities, and sometimes I can't, but at least I can map them out. And this is what the possible outcome is. And I'm like, let's do this.
Okay, let's do this. Let's really talk about that. Because what you're saying is you're really talking about what it means for something to be risky. When you started Wall Street Bets, the way you've talked about it is that you said you wanted a place where people could talk about risky ideas and they could talk about it kind of proudly, risky trade ideas. You were enabling other people to take risks. So can you tell us, like, what worries did you have at the time that things potentially could go wrong for them?
You know, my definition, my understanding and my position on risk has evolved, right? It's become clear as the years gone by. And early on, I justified this by saying, well, look, they're all adults. You have to be 18 in order to open a brokerage. Same thing if you go to a casino, everyone can go through. And when I said I wanted to be able to discuss high risk, I wanted to discuss high risk, high return, right? It wasn't just high risk is throwing your money out the window and having it go away with 100% certainty. This was high risk with the possibility of making money. And those two obviously go hand in hand. There are some that are irresponsible with it, but I can't make myself responsible in much the same way that there's gambling addicts, right? But outside of that, what I start seeing is a learning process, much like the one that I personally went through. I lost tons of money, but I walked away with so much knowledge and understanding and hands-on experience that a textbook can never explain to you.
I want to ask you about someone who sort of counts as your really, really complete opposite, Jack Bogle. He was the founder of Vanguard. He helped popularize the very vanilla, very boring idea that if you're an investor, you can diversify your bets. He ended up popularizing the index fund. How did it feel that you, in some ways, were kind of singularly responsible for changing the way that just millions of people think about investing? What did that feel like?
It was humbling for sure. It was unexpected to see the enthusiasm. If I were to have predicted the outcome of it, it would have been people looking down at this particular type of activity. Secretly, it was almost a goal of mine. But the beauty of it is what conservative investors do, Bogle, Buffett, whatever it might be, is no different than what gamblers that literally go to sit at a roulette table do. The changes in the vision that Wall Street Bets were, it demystified the idea of finance to people that might otherwise think it's just Excel sheets and discounted cash flows.
You also took a different kind of risk, and you sued Reddit, and you lost. Will you tell us a little bit about what that felt like?
Terrible. Yeah, that was probably in the top 5 riskiest things, if not 3. I get kicked out, and the stubbornness behind Reddit, they never answered. I tried pleading and sorries and threats and back channels and lawyers. They would just be like, no, you're done. They got to a point where they said, no, we're done trying to negotiate. We want to take you to court with this. And I said, all right, well, I guess now I have to actually go to court. And so this is when I decided to countersue them.
So it didn't feel like a risk. It felt like just something you had to do.
I needed to do it for closure. I still had a chip on my shoulder, and I couldn't fully commit to anything. And I'd still kind of look at, every time I'd see Wall Street Bets on the news or people talking about it, it would still have that kind of sour feeling. And so, and I needed to get past that. And I'm like, look, if I lose, I lose. And then it is what it is. And it would have been the fight of the century for me, or my lifetime for me. But then I can be at peace. Right?
Is that how you feel now? Are you at peace?
Unfortunately not, because it's not over yet. I would have liked I would have liked for the judge to have been like, no, dude, you lose and it's over. You know, I don't want to comment too much on the legal side of things, but the judge, let's just say they left plenty of room for maneuvering. So unfortunately, it's not over.
I was told, I really don't know what it is. I was told you brought an object, I think, that maybe encapsulates risk. I think Natasha, my colleague, is gonna pass it to us, I do believe. What is this? Okay. All right. Tell us about this guy.
You're familiar with this?
Yeah. Remind me.
So this is from a meme, right? It says, "This is fine." It's a little dog, and this encapsulates so much of both my life and my ability to handle emotions, especially with the volatility of markets, but also life in general. It gives you so many ups and downs and so many ways to go through it. Oftentimes, when faced with adversity, my composure resembles this. It's like, yeah, don't worry about it.
Can I see him?
Okay. Yeah, absolutely.
All right. Well, this is mine now. Jamie, thank you so much for being here. Loved having you.
Not a problem. Thank you very much for having me.
We have more risk coming up next. When executives across corporate America want to take a little risk or manage it, they often turn to Wall Street. And there is no entity on Wall Street with a more interesting relationship to risk, including Wall Street bets, than the company Goldman Sachs. And when I think about Goldman, which I do often because I'm a Wall Street reporter, my mind often turns to Maeve Duvally. Maeve is a longtime media executive and until recently was a managing director at Goldman. The truth of the matter is, we have a cordial relationship, but a kind of antagonistic one because it's my job to report on Wall Street's money and power, and it's her job to push back. Recently, I finished her wonderful memoir, Maeve Rising, which is an account of her journey from being a lonely and angry person to the woman who is sitting at this table with me right now. Maeve Duvally, welcome.
Max, thanks for having me. You know, I would say we don't have a antagonistic relationship. I would say that we've locked horns through the years.
Okay,
is that a better characterization?
I think that's a better characterization, but I'm going to ask you in just a couple of minutes about all kinds of risks that you have taken, personally and professionally.
Sure.
But I feel like we should start first things first.
Yep.
Why is risk, which is really, I mean, it's just a fancy way of saying basically the things that can go wrong. Why is risk so important to the work that happens on Wall Street?
Well, from a market perspective, obviously managing market risk, managing operational risk that somebody pushes a button they're not supposed to, and the trade that happens is bigger than it was supposed to be. Those are obvious risks. And there's also kind of macro risk, right? That a central bank does something that people weren't expecting. But the kind of risk that I manage, and incidentally, everybody at Goldman Sachs is taught they have to manage, is reputational risk.
Okay, so I want to talk about 2018. I think my favorite page of your book. You put on makeup at the office for the first time. What I really want to ask about is, tell me about the day. What do you remember in full about that day in 2018?
Well, it was the day of the Knight Bagehot Fellowship dinner, which you've probably been to. Knight Bagehot Fellowship is a fellowship for mid-career financial journalists at Columbia University. I'm a alumni of that program and also on the board of Knight Bagehot Fellowship. It's really a nice gathering. I usually look forward to the dinner, but sometime early that afternoon, I literally had this overwhelming feeling and desire that I needed to wear makeup to the event that evening. And once I had that thought, I couldn't get it out of my mind. And I bolted out the door and walked a third of a mile to the closest Sephora and bought a bunch of makeup, which I put on at the end of the day. And I went to that dinner with some makeup on for the first time.
You put on the makeup, you end up kind of negotiating with yourself. And you say to yourself that you basically have this barrel of femininity, and you think should I just keep the lid on? Should I just keep the lid on? What would you have risked if you had done that?
I think that would have been impossible, but if I did that, I would have been miserable.
I was wondering when I read your book how it felt to kind of risk your male privilege. You were risking your male privilege in a male-dominated industry.
I'm certain I had male privilege, and I'm certain through the years I exercised male privilege, but I wasn't really consciously aware of it. And to be perfectly honest, it's not something that really matters to me.
When it's time for you to choose a name, you pick one that means she who intoxicates.
Yeah.
Which blew me away when I read it, because months before, you stopped drinking. You stopped drinking. Why did you quit?
Well, I had a series of progressively bad bottoms. My last bottom, which was in January of 2018, I holed myself up in an apartment. I only left to get alcohol. I drank around the clock, and I made an attempt on my life. So if I continued drinking, I'm convinced that I would have killed myself. After that episode, I made a decision that I wanted to live. And I knew if I wanted to live, I had to stop drinking.
Look, we have a professional relationship, so part of me feels like it's hard to say this, but it's also hard not to say it. I'm glad you made that decision. A lot of people who are miserable, they don't get out of their misery.
Yeah.
They stay there.
So the reality is there are a lot of drug addicts and alcoholics in the world, and the vast majority of them do not get sober and do not get clean, and they die alcoholic and addict deaths. That's the reality. So those of us who have made it to recovery don't take it for granted, number one, and two, realize that it was a gift. And it's a gift that has to be nourished all the time, because if you take it for granted, you're going to wind up right back on the street.
When you came out, you got, I think, literal bouquets from traders at Goldman. I think you got these very warm notes from people. I think you got phone calls.
Yeah.
Those were from traders, and they were not from investment bankers. And you write in the book with clarity, investment bankers were quiet. I was so surprised by that. What can you explain that? Why did that happen?
I think probably some of my relationships with investment bankers were shallower than I thought. And I think investment bankers are very good at having really expansive relationships kind of across a wide group of people. But, maybe some of those relationships aren't as deep as they would appear.
I love that you're accusing investment bankers writ large of a certain kind of interpersonal shallowness.
I'm not sure I said it exactly
that is exactly
way.
as you said it. No. I'm hoping that you'll...
You're not going to put words in my mouth, are you?
Well, I'm the interviewer now.
Yeah.
You know, I asked you earlier about male privilege. Coming out as trans in the milieu of, first of all, New York City, where we are, but also a corporation, which I'm sure, as I'm also keenly aware, has a lot of pressures too. Can you talk, if you want to at all, about, I don't know, maybe the kind of privileges that come with having a really good career as you do?
Sure. So I certainly have white privilege. I have the privilege of having worked at Goldman Sachs. I'm relatively well off. I live in the Chelsea section of New York, which is arguably the best place to be an out transgender person in the world. And even before I left Goldman Sachs, I began to, and I've continued to be, an advocate or activist for the LGBTQ community more broadly, because, you know, not everybody is in a position to speak out. Not everybody wants to speak out, but I'm in a position to, and I want to speak out, so I'm going to.
Thank you so much for being here. I really enjoyed this.
Thanks for having me, Max.
If the names RZA, Jizza, and Old Dirty Bastard mean anything to you, or if you've ever been moved by the music of A Tribe Called Quest or D'Angelo, then you owe a debt of thanks to Sophia Chang. As an artist manager and as a music label executive, she helped shape the landscape of a golden age of New York City rap in the 1990s in a way that would be totally under-celebrated if it weren't for her own book, which is called The Baddest Bitch in the Room. It's a book about the music business, but it's also a book about taking risks, some that work out and some that don't. We've talked tonight about personal risks. We've talked about professional risks. We've talked about financial risks. Sophia's story is a story about what happens when those things come together. Sophia Chang, welcome to the show.
I am so excited to be here. Thank you, thank you, thank you.
You manage Old Dirty Bastard without any experience as a manager. You ran RZA's record label without any experience running a record label. I think you say in the book that risk is in my DNA.
Did I?
You do.
I wonder if I plagiarized that from somebody. That's really clever.
Risk-taking was in my DNA. Sophia, why is that?
I would say certainly my parents' stories have a lot to do with that. My mother, Tung-Suk Chang, born in 1932, she escaped North Korea when she was 14. She was one of 10 siblings. That was a huge risk. It was a very risky boat ride. My father, he was, God rest his soul, he was estranged from his father, and he took a risk when he studied mathematics in Vancouver. They went to Canada to build a better life for their family. So none of that was explicit in my head as a child, but I think that that's probably the model. And I think the other thing that really supported my journey and my risk-taking was that my parents, every move that I made, they encouraged me. After I moved to New York, I didn't have a job. I didn't have a place. Their peers would say, your daughter, what's she doing? Get her back.
They would have had a good answer, because when you moved to New York, I think one of the first jobs you had was working for Paul Simon.
Yeah.
Paul Simon had a personal assistant who I think was a Korean American woman.
That's right.
And I think she taught you almost explicitly that it was important for you to take up space in a room. How is, not just confidence, but something like unapologetic confidence, how is that a risk?
I think when you take an intersectional view of this, right? When you think about the fact that I am a woman and I am Asian, and I mostly navigated, Max, very male-dominated milieu. And yes, I remember, her name is Sonia Che, God rest her soul, and I remember watching her move and I thought, wow, and she would just, and she was smaller than me, she would just burst into a room and you could just feel her. She didn't have to yell, she didn't have to do any of that, but her energy just emanated off of her, and I really took that lesson from her.
But, it occurs to me that you talk about losing the fear of embarrassing yourself.
Yes.
I think when you're at like Atlantic Records in an early job.
Yeah.
People have a fear of embarrassing themselves for a reason, because it's self-protected. It's a kind of shield.
Yeah.
So it occurs to me to ask, maybe the question I really want to know is why is it so risky to be yourself?
I think that in general, we as humans operate out of fear. Just in general. So if we're in a meeting and there are 10 people sitting around the table, and maybe I'm junior and I have an idea, my fear, and even if I think it's so smart, my fear is I open my mouth and everybody goes, and it's like the record scratch, rewind, and then everybody looks. I think we all live with a real fear of humiliation, embarrassment, excommunication, reprisal.
Right.
So I have gotten to the point where I just don't care. I mean, it's so incredibly liberating not to care what other people think. It doesn't mean that I don't get my feelings hurt. For me to be out here speaking as openly and fearlessly as I do, I know from people who come
planned, that's when you can get into trouble, when people have an unexpected negative surprise.
What's the worst thing that I've ever done professionally? Oh man, these existential questions, what is bad? There's nothing that I can recall that was not moral or not ethical. Mistakes, on the other hand, I've made plenty of those, but all of those have been good, right? They were all stepstones to succeeding, to being able to creating, to be able to actually fulfilling stuff.
I wouldn't say that I've had one sweeping gesture of generosity, and you got a car, you got a car, you got a car. I've never been in that position. What I do that manifests generosity is telling people they're doing a great job and always giving them credit when it's due. And it costs nothing.
welcome to the Business Week Show. When my colleagues and I thought about what kind of themes of the magazine we
Chapter 2, The Psychology of Temptation to Break Your Rules. Introduction, The Emotional Battle Behind Every Trade. What if I told you that your biggest opponent in trading isn't the market, the news, or even the economy, but you? That's right. Your emotions, not your strategy, are what make or break your success as a trader. And the truth is, mastering your emotions is the real edge in trading. Because in the chaos of price swings, red candles, and unexpected news, the one thing you can always control is your mind. Let's be honest. Every trader, no matter how skilled, has felt the gut punch of a bad trade. The heart-racing panic of watching the market turn against you. The sudden urge to double down and win it all back. The temptation to break your rules just this once because this trade feels right. Sound familiar? If you've ever blown an account, skipped your stop loss, or revenge traded out of frustration, you're not alone. Every successful trader has been there. The difference is, they learned how to stop letting emotions drive their decisions. They learned how to master themselves before mastering the markets. Let me give you a picture. Picture two traders. One makes a solid plan, follows his system, and walks away when the market doesn't align. The other jumps in and out, chasing green candles, second-guessing his entries, driven by hope, fear, and ego. Guess which one lasts? It's not about who's smarter. It's not about who knows more indicators. It's about emotional discipline, the skill that separates consistent winners from those who constantly start over. This audiobook is your guide to building that skill. Inside, you're going to learn how to identify the emotional traps that sabotage your trades: greed, fear, impatience, revenge, and self-doubt. We'll explore the psychology behind your decision-making and teach you how to rewire your brain to respond with calm and control, even in the heat of the moment. You'll discover the power of mental routines, journaling, reflection, and discipline. You'll understand what it really means to trade with emotional intelligence and how to become the type of trader who thinks clearly, acts strategically, and stays grounded. This isn't fluff. It's practical. It's actionable. And it's written for you, the trader who's tired of being ruled by emotion and ready to take control of the one thing that truly matters: your mindset. Whether you're trading crypto, forex, stocks, or futures, one truth remains: your ability to stay emotionally stable will determine your long-term success. You'll hear stories of traders who lost everything due to emotional decisions, and those who built slow, consistent profits through calm, focused discipline. You'll learn how to control your breathing, your thinking, and your reactions in real time. You'll even discover tools that elite traders use to reset mentally after losses and avoid spirals that lead to bigger ones. And most importantly, by the time you finish this audiobook, you'll walk away with more than just knowledge. You'll walk away with a new identity. The identity of a calm, confident, emotionally disciplined trader. Because this isn't just about learning tips, it's about transformation. So whether you're just starting out or already knee-deep in the trading trenches, get ready. This audiobook will challenge how you think, train how you feel, and unlock the trader you were always meant to be. Ready to take the first step? Let's begin. Chapter 1. Why Emotions Destroy Good Traders. Trading looks simple from the outside. You click a few buttons, watch a chart, make a decision. If it goes up, you win. If it goes down, you lose. Right? Wrong. If trading was just about patterns and entries, we'd all be millionaires by now. But every trader eventually learns the same hard truth. The biggest challenge isn't the market, it's your own emotions. Fear, greed, revenge, doubt, euphoria, panic. These are the real forces moving most traders' decisions. And if you don't learn to manage them, they'll quietly sabotage every plan you make. Let's start by breaking down some of the most common emotional traps that destroy even the most talented traders. Fear, the invisible hand that freezes you. Fear shows up in many ways. Fear of losing money, fear of being wrong, fear of missing out, fear of pulling the trigger, fear of staying in too long. It's a sneaky emotion. Sometimes it feels like logic, sometimes it feels like caution, but often it's just resistance, dressed up as analysis. Have you ever hesitated on a great setup, only to watch it play out perfectly after you skipped it? That's fear. Have you ever moved your stop loss too tight, only to get wicked out, and then see the market reverse in your favor? That's fear. Fear doesn't want you to risk anything. It wants you safe. But trading by nature involves uncertainty. If fear controls your decisions, you'll never give your trades room to breathe. You'll cut winners too early. You'll hesitate on great entries. And worst of all, you'll lose confidence in yourself. Greed, the illusion of just a bit. Greed doesn't always look evil. It's not just wild risk-taking or trying to double your money in a day. Sometimes it shows up in quiet whispers. Hold a little longer, just in case it goes higher. Double the size this time. It's a sure thing. Skip the stop loss. You won't need it. Greed blinds you to risk. It convinces you that profit means you're right, even if you broke your rules. And the most dangerous part? Greed feels good, until it doesn't. The moment you get greedy, you stop thinking like a trader and start thinking like a gambler. And gamblers don't last long in this business. Revenge, the emotional spiral. This one's ugly, but it's real. You take a loss, it hurts. Your ego feels bruised. Maybe you overreacted. Maybe the market was irrational. Either way, you want it back now. So you jump into another trade not because it's a good setup, but because you're angry. This is revenge trading. It's impulsive, it's emotional, and it's toxic. You're no longer trading the market. You're trading your emotions. And the more you chase, the more you lose. Until suddenly, your losses aren't just financial, they're psychological. You stop trusting yourself, and that is the most dangerous loss of all, the psychological roller coaster of wins and losses. Let's talk about what trading feels like. One day, you're on fire. Every trade hits. You're invincible. You start thinking bigger, risking more. The dopamine hits keep coming. Then, the market turns. You take a loss. Then another. Your winning streak disappears. Self-doubt creeps in. You hesitate. You overcorrect. You panic. Sound familiar? This is the emotional roller coaster. And unless you have a strong mindset, it will wreck your consistency. Wins make you overconfident. Losses make you overcautious. You start making emotional decisions instead of logical ones. You stop following your plan. You trade based on how you feel, not what you see. And that's where the downfall begins. The science of emotion in decision-making. Let's get a little scientific for a moment. Your brain is wired for survival, not trading. When you see a big red candle on your open position, your brain sees it as a threat. It activates your amygdala, the part of your brain responsible for fear and emotional reaction. That's the fight or flight system. It's the same response your ancestors had when they saw a tiger. Except now, the tiger is the market. This emotional response floods your system with stress hormones, adrenaline and cortisol. Your heart races, your breathing shortens, your vision narrows. Your ability to think clearly drops. This is not the state you want to be in when making financial decisions. Meanwhile, the rational part of your brain, the prefrontal cortex, gets pushed aside. Logic takes a back seat. And suddenly, you're making snap decisions based on emotion, not strategy. If you've ever found yourself wondering, why did I do that? After a trade, now you know. Understanding your emotional triggers. Every trader has emotional triggers. Some get anxious during drawdowns. Others get reckless after wins. Some feel pressure when trading in front of others. Others fear missing out on the next big move. Your job is to identify your triggers before they control you. Ask yourself, what situations make me feel out of control? What patterns do I repeat after losses? What thoughts come up when I'm in a winning streak? When do I break my rules most often? Awareness is everything. Once you can see the emotion rising, you can choose a different response. But if you're unaware, your emotions will drive the car, and you'll be the passenger. The first step to emotional awareness. Here's the good news. You can train your emotional awareness. It starts with a simple shift. Slow down. Before every trade, check in with yourself. Ask, am I calm? Am I following my plan? Is this trade based on logic or emotion? These micro-checks train your brain to pause, and that pause is powerful. It gives your rational mind a chance to take the wheel. Next, start keeping an emotional trading journal. Not just price, entry, and exit, but also, what did I feel before, during, and after the trade? What was my mindset going in? Did I follow my rules? What would I do differently next time? Over time, this builds emotional intelligence, the ability to recognize, understand, and manage your emotions. You'll start to see patterns. You'll spot red flags before they lead to mistakes. You'll become more mindful. And that mindfulness becomes your edge. Final thoughts for this chapter. Emotions are part of being human. You can't eliminate them, but you can learn to control how they influence your trading. It starts with awareness. By understanding your emotional patterns, fear, greed, revenge, you take the first step toward mastering them. You stop reacting. You start responding. You stop being ruled by your feelings. And you start becoming a disciplined, focused, and emotionally strong trader. Remember, the market doesn't owe you anything. It doesn't care about your feelings. But you should care. Because your feelings, left unchecked, can cost you everything. But once they're mastered, they become your greatest asset. You've taken the first step. The path ahead is powerful. Let's keep going. Chapter 2, The Psychology of Trading, How the Brain Betrays You. The market isn't just a test of your strategy, it's a test of your psychology. Every candle, every spike, every sudden drop. Each one triggers a response deep inside your brain. And unless you understand how your mind works under pressure, you'll keep making the same emotional mistakes over and over again. Let's be clear. Your brain was never designed to trade. It was designed to survive. And in the world of trading, survival instincts can lead you straight to destruction. Fight or flight and your trading account. Imagine this. You enter a trade. Everything looks perfect. You're confident. Then, a red candle smashes your entry. Price starts dropping, fast. Your heart starts pounding. Your stomach tightens. You break into a sweat. You stare at the screen, frozen. Do you close? Do you hold? Do you add more? Welcome to your brain's fight or flight response. This is your amygdala at work. It's the part of your brain responsible for processing fear and reacting to threats. It's ancient, powerful, and designed to keep you alive. Back in the day, this reaction helped humans escape predators. Today, it's what makes you panic. When a trade goes red, your body treats a losing position like a physical threat. Your body floods with cortisol. Adrenaline spikes. Your focus narrows. And your logical thinking shuts down. You stop being a trader. You become a frightened animal trying to escape. And just like that, Your edge is gone. This is how the brain betrays you in trading. It hijacks your ability to think clearly, all in the name of protection. But the market doesn't care about your fear. It doesn't care about your instincts. It only responds to your decisions. Which means, if you want to win, you have to rise above your biology.cognitive biases in trading. Now let's talk about something more subtle, cognitive biases. These are mental shortcuts your brain uses to make decisions quickly. They're helpful in everyday life. But in trading, they can be deadly. Let's look at a few of the biggest ones. FOMO, fear of missing out. This one is everywhere. You see a chart flying. You didn't enter. Everyone on social media is bragging. You feel the urge. You chase. FOMO makes you abandon logic. It pushes you into bad entries, late entries, high-risk positions with poor reward. It's based on emotion, not analysis. Confirmation. Bias. You've decided the market will go up, so you start looking for evidence to prove your bias. You ignore anything that says otherwise. You read only the bullish news. You cherry-pick bullish indicators. And when the market drops, you're shocked. Confirmation bias blinds you to reality. It feeds your ego instead of your logic. Loss aversion. This is the tendency to fear losses more than you value gains. Psychologists say losing $100 feels twice as painful as winning $100 feels good. In trading, this leads to holding losing trades too long. You don't want to take the loss. You hope it turns around. Meanwhile, you cut winners too early. You're afraid to give back the profit. This is how small losses turn into big ones, and how small wins keep you from real growth. Anchoring bias. You get attached to a specific number. Maybe it's your entry price, maybe it's a previous high, maybe it's your profit target. But the market doesn't care about your anchor. It moves based on supply and demand, not your expectations. Anchoring causes you to ignore new information. It keeps you stuck in the past. The lizard brain versus the rational mind. Your brain has two main systems when it comes to decision making. System 1, fast, emotional, instinctive. This is the lizard brain. It reacts immediately. It's what you use to jump out of the way of danger or catch something falling. System 2, slow, logical, analytical. This is your rational mind. It thinks through problems. It follows plans. It trades with discipline. When you're calm, your rational mind is in control. You follow your setup. You manage risk. You stay focused. But when emotion rises, when a trade moves against you, or a setup looks too good to miss, the lizard brain takes over. You act without thinking. You break your rules. You click out of fear or greed. You become reactive, not strategic. The goal of emotional mastery in trading is to train your rational mind to stay in control. Even when the pressure is on, it's not easy. But it is possible. And it starts with awareness, becoming the observer, not the reactor. So how do you rise above your brain's emotional traps? You become the observer. Instead of reacting automatically, you learn to pause. You watch your thoughts. You label your feelings. You create space between stimulus and response. Here's a powerful shift. Don't identify with your emotions. Observe them. Don't say, I am anxious. Say, I notice anxiety. Don't say, I am afraid of this. Trade. Say, fear is present. This may sound small, but it's huge. That shift in language gives you distance, and in that distance is power. It puts you back in control. It reminds you that emotions are just signals, not instructions. Your fear isn't the truth. Your greed isn't a command. Your doubt isn't your destiny. They're just sensations. And like all emotions, they pass. Your job is to feel them, acknowledge them, but not act on them impulsively. You are not your thoughts. You are the awareness behind them. The more you practice this, the calmer you become. And the calmer you become, the better you trade. Practical tips to strengthen the rational mind. Let's wrap up with a few tools to help your rational mind stay in charge. Breathe before every trade. Before you enter, take 3 deep breaths. In through your nose, out through your mouth. This calms your nervous system. It brings your thinking brain back online. Use a pre-trade checklist. Don't rely on memory. Use a checklist to confirm your setup. If all boxes aren't checked, you don't trade. This removes guesswork. Journal your emotions. Track not just your trades, but your mindset. What did you feel before, during, and after the trade? This builds emotional intelligence over time. Create rules and follow them no matter what rules. Protect you from yourself. If your plan says cut losses at 2%, you do it. Not because the market tells you, but because you decided before emotion got involved. Limit screen time. The more you stare at price movement, the more you feed your lizard brain. Set times to analyze, then walk away. Protect your mental capital, final thoughts. Your brain is powerful, but it's not perfect. It evolved to survive, not to succeed in a modern trading environment. That's why emotional awareness is a trader's greatest weapon. You must learn how your brain betrays you, so you can take back control, fight or flight. FOMO, confirmation bias, emotional triggers. They're all part of the game, but they don't have to rule your game. You're not here to trade emotionally. You're here to trade intelligently. The goal is to stop being the victim of your mind and become its master, because once you master your brain, you master your trades. And when you master your trades, you change your future. Let's move forward with that power. Chapter 3. Greed, the silent killer of profit. Greed doesn't shout, it whispers. It doesn't show up wearing a villain's mask. It arrives dressed as ambition, as confidence, as just a little more. And before you know it, it takes everything. Greed is one of the most destructive emotions in trading, yet many traders don't even realize when it's in control. Why? Because greed is seductive. It disguises itself as growth, drive, even optimism. But when you peel back the layers, what you often find isn't a hunger for success. It's a fear of missing out, a need to prove something, a craving for a quick win. In this chapter, we're going to expose greed for what it truly is. We'll look at how it creeps in, how it hijacks your decision-making, and most importantly, how to master it before it masters you, how greed disguises itself. Greed rarely says, "Let's gamble." Instead, it says, "This trade is too good to pass up. I'll just hold a little longer. If I double the size, I can make up for that last loss. One more trade, then I'm done for the day." Greed doesn't always mean you're reckless. Often, it just means you've stopped thinking in probabilities and started thinking in fantasies. It can feel like confidence. But it's not rooted in discipline. It's rooted in desire. Desire for more, for faster gains, for bigger wins. You stop asking, "Is this a good trade?" and start asking, "How much can I make if it works?" That shift from process to outcome is the red flag. That's where greed takes the wheel. And here's the truth. Every great trader knows when to stop. Every losing trader keeps pushing. Case studies. How chasing profits leads to disaster. Let's look at a few real-world patterns that illustrate how greed operates in the mind of a trader. Case 1. The winning streak spiral. You've had 3 green trades in a row. Confidence is high. Your account is up. Everything feels good. You tell yourself, "I'm in the zone. Let's increase position size and ride the momentum." The next trade is over-leveraged. You don't manage risk. It moves. Against you, you hold hoping it turns around. It doesn't. What started as a strong session ends in a massive loss. And worse, your confidence is shattered. What happened? Greed blurred your risk management. You let success turn into overconfidence. You chased the high instead of protecting the base. Case 2. The all-in moment. a trader sees a perfect setup. All indicators align, news matches. Market sentiment is strong. They throw everything at it. No stop loss, no plan, just conviction and size. At first it goes their way, then a sudden reversal. Now they're stuck, panicking, watching their account drain. They close the trade out of fear. Or worse, they hold and blow up their account. What happened? Greed convinced them it was a sure thing. They bet like a gambler, not a trader. Case 3, the overtrading trap. A trader hits their profit goal for the day, but they keep watching the market. They see another setup. One more, they think, then another, and another. Before long, they give back all their gains and end the day negative. What happened? Greed didn't know when to stop. It wasn't satisfied with enough. These patterns aren't just stories. They're daily realities for thousands of traders, and they all come down to one thing: the inability to say, "That's enough for today." How to set realistic expectations. One of the most powerful ways to defeat greed is to anchor your trading in reality. Greed feeds off fantasies. It thrives in the space between what's real and what you wish would happen. So how do you pull it? Back down to earth? Define your daily, weekly, and monthly goals, based on logic, not emotion. If your average win is $100 per trade, don't expect to make $1,000 in a day by chance. Set goals that reflect your actual edge, not your dream outcome. Accept that you won't catch every move. You won't top tick or bottom tick every trade. You won't catch every runner. And you'll never time every market perfectly. That's okay. Your job isn't to be perfect. Your job is to be consistent. Understand compounding. $50 a day may feel small, but $50 a day, 5 days a week, 48 weeks a year, that's $12,000 before compounding. Now imagine you grow your skill. Size. Up slowly, stay consistent. That small daily profit becomes a solid full-time income. Focus on process, not outcome. Instead of chasing profit, chase execution. Ask, did I follow my setup? Did I control risk? Did I exit according to plan? If yes, you won. Even if the trade lost money, because the goal is to execute with discipline. That's what leads to long-term profit. Tools to train delayed gratification. Greed is about wanting more now, but trading rewards those who can wait, who can stay patient, who can take the slow, boring, disciplined path. Here are tools to help. Train delayed gratification. Use a profit cap. Set a realistic profit goal for the day. Once you hit it, walk away. It protects you from overtrading and giving back gains. Reward discipline, not just profit. After a day of good execution, even with small gains or losses, reward yourself. Take a walk, treat yourself. Build positive reinforcement around discipline. Track impulsive trades. Every time you take a trade out of FOMO or greed, write it down. Log the reason, the emotion, the outcome. You'll start to see the cost of impulsiveness in real numbers. Visualize long-term growth. Have a visual reminder of where consistency leads. A chart showing account growth from small daily wins. A spreadsheet with compounding calculations. Remind yourself, it's not about today's big win. It's about stacking smart trades for years. Practice stop trading rituals. Set a routine to end your trading day. Maybe it's closing all tabs, journaling the session, going for a walk. This habit signals to your brain, I'm done for the day. It prevents that one extra greedy trade that ruins everything. Final thoughts. Greed will always exist. It's not about eliminating it. It's about managing it, understanding it, catching it in the moment, and choosing a better response. Every trader battles greed, but the best ones don't let it make decisions. They set realistic goals. They stay disciplined. They say enough when others chase. You don't need to double your account overnight. You don't need to catch every move. You just need to show up, trade your edge, and stick to the plan. Because when you do that long enough, the profits come. Slowly, steadily, quietly. Let others. Chase fantasy. You chase consistency. That's the mindset of a professional. Let's continue building that mindset in the next chapter. Chapter 4. Fear. The invisible barrier to growth. Fear is invisible, but its effects are everywhere in trading. It's in the hesitation to take a setup, in the panic exit when price dips a little, in the refusal to size up when your edge is clear, in the avoidance of pulling the trigger, even when everything aligns. Fear doesn't always look like fear. Sometimes it shows up as perfectionism, as analysis paralysis, as waiting for more confirmation. But underneath all of it, it's the same emotion. Fear of losing, fear of missing out, fear of being wrong, fear of looking stupid, fear of failing. Again, fear is the great limiter, the ceiling above your potential. And until you learn to face it, understand it, and work through it, it will quietly run your trading life. In this chapter, we'll shine a light on fear. You'll learn where it comes from, how it tricks your mind, and, most importantly, how to overcome it without ignoring it. Because real traders don't run from fear, they rise above it. Let's begin. Fear of losing money, missing out, or being wrong. Let's break it down. Fear of losing money is the most obvious. It's primal. It triggers your survival instincts. Money means safety, comfort, status. Losing it feels like danger. Even when the loss is planned, even when it's small, it still stings. And so, you hesitate, you double-check, you skip trades, you cut winners early, you start trading not to win, but to avoid pain. That's not trading, that's fear management. Next is the fear of missing out, FOMO. This is where you chase moves after they've already run. You see others making money. You don't want to be left behind, so you jump in, late, unprepared, emotional. And more often than not, you lose. Ironically, the fear of missing out causes you to miss out. On discipline, on strategy, on growth. Then there's the fear of being wrong. This one is subtle. It's the ego whispering, you have to be right. It's what makes you hold losing trades, refusing to admit they failed. It's what makes you ignore your stop loss. It's what makes you add to a loser, hoping it turns around. Because being wrong feels like being less than. It feels like weakness, like defeat. But here's a mindset shift. In trading, being wrong is not failure. It's feedback. It's a message. It's part of the business. Your job isn't to be right all the time. Your job is to manage risk when you're wrong and maximize reward when you're right. Why fear keeps you stuck? Fear doesn't just stop you from trading. It stops you from growing. Every time you hesitate on a setup, even though your plan says go, you train your brain to doubt yourself. Every time you ignore a new strategy because it feels uncomfortable, you train your brain to stay small. Every time you skip a backtesting session, avoid reviewing mistakes, or delay starting your trading journal, you feed fear. You protect your ego at the cost of your progress. Here's the truth. Fear wants comfort. Growth demands discomfort. That's why so many traders plateau. Not because they lack strategy, but because they've hit an emotional wall they refuse to climb. And often, it's not the fear of trading that holds them back. It's the fear of what trading asks of them. To be disciplined, to be patient, to be honest with themselves, to face their flaws and keep showing up anyway. Most people aren't willing to do that. That's why most traders don't succeed. But if you're listening to this right now, I believe you're different. Building courage with small wins. So, how do you overcome fear? Not by trying to be fearless. That's a myth. Real courage is not the absence of fear. It's the willingness to act despite fear. And that courage? It starts small. Here's how you build it, one step at a time. 1. Take small, intentional risks. Trade with small size. Size so small, it doesn't trigger panic. The goal isn't to get rich, it's to prove to yourself you can follow a plan. Each successful execution, regardless of the outcome, builds trust. 2. Focus on process wins. Forget about profit for now. Celebrate when you enter at your signal, when you respect your stop, when you journal honestly. Process builds consistency. Consistency builds confidence, and confidence reduces fear. Visualize success. Take 5 minutes before your session. Close your eyes. See yourself following your plan, entering clean, exiting calmly, walking away proud. Your brain doesn't fully distinguish imagined success from real. The more you mentally rehearse, the more familiar and less scary it becomes. 4. Learn from past pain. Don't relive it. We all have painful trading memories, a blown account, a massive loss, a string of bad trades. Don't bury them. Study them. Ask, what was the emotion? What was the decision? What would I do differently now? Then forgive yourself. And move forward, creating a mental safety net. Fear thrives when we feel out of control, so give yourself control. Here's how you build a mental safety net, a foundation that supports you when the pressure is high. Clear, written trading plan. Know your entries, your exits, your risk, your goals. When it's written down, it gives your rational mind power over emotion. Defined daily risk limits. Know exactly how much you're willing to lose in a day. Hit that number, walk away. No debate, no revenge trades. Safety first. 3. Scheduled breaks. Fear builds up over time. Set a timer. Every 90 minutes, step away from the screen. Reset. Breathe. You're a human, not a robot. Community or accountability partner. Talk to someone. Share your emotions. Discuss your trades. Fear shrinks when it's spoken. Isolation magnifies it. End of day reflection. Ask yourself, what did I fear today? What did I do anyway? Where did fear win? How will I respond next time? Track your emotional patterns like you track your trades. This is how emotional mastery is built. Final thoughts. Fear isn't your enemy. It's a signal. It means you care. It means you're stretching. It means you're stepping into uncertainty. But fear should never be the one making decisions. That's your job. You won't eliminate fear, but you can learn to see it, to understand it, to trade with it, not under it. Because the traders who grow, the ones who succeed, are not the ones who feel no fear. They're the ones who feel it and keep moving anyway. Step by step, trade by trade, breath by breath. You've got this. Chapter 5. Discipline, the real trading strategy. If trading were only about strategy, everyone would win. Think about it. You can buy the best indicators. You can copy someone else's signals. You can pay for education, courses, even algorithms. But if you don't have discipline, it all falls apart. Strategy tells you what to do. Discipline decides if you actually do it. That's why some traders with average strategies make consistent profits, while others with advanced knowledge keep losing. It's not the setup. It's the self-control. It's the execution. In this chapter, we're going to break down why discipline is the real edge in trading. You'll learn how to build it like a muscle. We'll explore the daily habits, rules, and rituals that emotionally strong traders live by. Because once discipline becomes automatic, success follows naturally. Let's dive in. Why strategy without discipline fails. Let's say you have a solid trading strategy. You've backtested it. You've journaled it. It works. But on Monday, you hesitate. On Tuesday, you overtrade. On Wednesday, you size up too big. On Thursday, you hold a loser too long. On Friday, you try to make it all back. By the end of the week, it's not the strategy that failed. It's you, and this is the cold truth. The best strategy in the world is useless in the hands of someone who can't follow it. Discipline is the glue between your system and your success. It's what keeps you from chasing green candles. It's what reminds you to walk away after a loss. It's what makes you stick to your stop loss, even when it hurts. Without discipline, you're just guessing. With discipline, you're executing. That's the difference between a gambler and a professional. How to build discipline. Like a muscle. Discipline isn't something you're born with. It's not a personality trait. It's a skill, a muscle, and just like any muscle, you build it through repetition, consistency. Recovery, here's how you grow your discipline over time. Start small. Don't try to become a trading robot overnight. Pick one area, maybe sticking to your stop loss. Focus on mastering that one behavior every single trade for the next 2 weeks. Once that becomes automatic, move to the next. Use a trading checklist. Before you click buy or sell, ask yourself, is this my setup? Am I following my risk rules? What's my plan before, during, and after the trade? This checklist forces you to slow down and think. Discipline starts with awareness. Delay the emotion. Before entering a trade, take a deep breath. Literally, one full inhale, one full exhale. This interrupts the emotional impulse. It gives your logical brain a chance to take back control. Keep a disciplined scorecard. Every day rate yourself, not on profit, but on discipline. Did I follow my rules today? Did I trade emotionally? Where did I slip? Track it, measure it, improve it. Because what gets measured gets mastered. Reward the process. Most traders only feel good when they win, but pros feel good when they follow their plan, even if they lose money. Rewire your brain to love discipline, not just outcomes. This is the foundation of emotional strength. Daily habits of emotionally strong traders. Emotionally strong traders don't have more willpower. They have better habits. They've structured their day to support consistency. They don't fight the market. They prepare for it. Here are a few daily habits that separate the winners from the strugglers. Morning mental reset. Before the charts, they reset their mind. Meditation, journaling, visualization, 5 to 10 minutes to clear the emotional baggage. They don't carry yesterday's win or loss into today. Pre-market routine. Strong traders don't just show up. They prep, they review key levels, set alerts, read relevant news, confirm their plan. When the bell rings, they're ready, not reactive. Trade review ritual. Every session ends with reflection. What went well? What could improve? Did I follow? The plan? They learn every day, not once a month. Breaks during the session. They don't sit glued to the screen. They take intentional breaks to reset their nervous system. Stretch, walk, breathe, because when your body relaxes, your brain works better. Strict shutdown time. At a certain hour, they're done. Win or lose. They close the platform and live their life. Discipline isn't just about what you do. It's about when you stop. Rules, routines, and rituals. Discipline thrives on structure. Let's break it down. Rules are your boundaries. They protect you from yourself. Examples. Never risk more than 1% per trade. Only take setups during the first 2 hours of market open. Walk away after 2 consecutive losses. These are non-negotiables. They create safety. They eliminate decision fatigue. Routines are your processes. They create consistency. Examples. 30-minute pre-market prep journal after each trade. End-of-day chart review. These routines ground you. They help you stay focused when emotions run high. Rituals are your anchors. They tap into your emotional center. Examples. Saying an affirmation before you trade, lighting a candle, or drinking a specific tea to signal focus. Listening to calming music during analysis. Rituals may seem small, but they make trading feel intentional, not chaotic. They train your brain to enter a state of calm readiness. Together, your rules, routines, and rituals form the discipline ecosystem. It's how you stay sharp, how you stay consistent, how you stay profitable. Final thoughts. Discipline isn't the sexiest part of trading, but it's the most powerful. It's not about being perfect. It's about being consistent enough over time. It's about showing up every day with clarity, patience, and control. You won't feel like being disciplined every day. That's okay. Do it anyway, because every time you choose discipline over impulse, you strengthen your identity as a professional. And over time, that identity creates results. Real, measurable, life-changing results. Build your discipline like a trader. Train it like a muscle. And watch your performance and your confidence grow. Chapter 6. Mastering the Moment. How to Stay Calm. During a trade, the real battle in trading isn't on the chart. It's in your mind. It's that spike of adrenaline when your position goes green and you want to take profits too early. It's the panic when the price dips and you want to close too soon. It's the rage after a stop-loss hit and you want to jump right back in. We've all been there. In those moments, logic disappears. You don't follow your strategy. You follow your emotions. And in trading, that's expensive. If you want to succeed long-term, you must master the moment. The second-by-second battlefield. That razor-thin space between stimulus and response. This chapter is about emotional control in real time. Not theory, not reflection after the fact, but what to do in the trade, when the pressure is on, when money is moving, when your heartbeat rises. You'll learn simple, science-backed techniques to stay calm, stay focused, and stay in control. Because the difference between a winning and losing trade often comes down to one decision made under pressure. Let's begin techniques for emotional control in real time. You don't rise to the level of your strategy. You fall to the level of your emotional training. Here are techniques traders use to stay grounded in the moment, even when everything feels intense. The 3-second pause. Before you click buy or sell, pause. Count slowly. 1, 2, 3. Take one deep breath. This pause shifts control from your reactive brain to your rational brain. It gives your mind space to think. And sometimes, that space saves your account. Tactical breathing, also called box breathing, used by Navy. SEALs, perfect for traders. Here's how. Inhale for 4 seconds. Hold for 4 seconds. Exhale for 4 seconds. Hold again for 4 seconds. Repeat for 1 or 2 minutes. This calms your nervous system. It lowers your heart rate. It brings you back to the present. Focus on execution, not outcome. During the trade, your job is not to win. Your job is to execute. Your edge plays out over time. One trade means nothing. If you focus on the process and not the profit, your emotions shrink. You stop obsessing over every tick. You start making clean, calm decisions. Use mantras, simple phrases, spoken out loud or silently. They anchor your mindset. Examples: I follow my plan. Next trade, best trade. Let the chart do the work. I control my exits. The right mantra in the right moment can interrupt panic and recenter you. Breathing, visualization, and pausing. Let's go deeper on 3 core tools. Breathing. Breath is the remote control for your brain. Shallow breathing, stress. Deep breathing, calm. Try this during a trade. When your heart races, inhale deeply through your nose. Hold for 2 seconds. Exhale slowly through your mouth. Do it twice. Instant calm, instant clarity. Visualization. Before you trade, or even during a drawdown, close your eyes. Picture yourself sticking to your stop. Letting a winner run. Walking away after following your rules. Feel it in your body. See it on the screen. Visualization is mental rehearsal. The brain doesn't know the difference between imagined and real success. So imagine calm, imagine control, then act it out. Pausing. Sometimes the most profitable move is to do nothing. Pause the trade, pause the screen, pause yourself. Walk away for 60 seconds, shake out your hands. Splash cold water on your face, reset. You're not a robot, you're a human navigating risk. Give yourself permission to pause. The mental stop-loss concept. Every trader has a price stop-loss, but few have a mental one. Here's what that means. A mental stop-loss is the emotional point where you know, I'm no longer thinking clearly. I need to stop trading, now. Examples of mental stop-loss triggers. Feeling revengeful after a loss. Obsessively checking charts even after your session is over, cursing, yelling, or punching your desk. Staring blankly at the screen. Frozen when these signs appear. It's time to walk away. It's no different from hitting your dollar loss limit. You're emotionally tapped out. You've entered tilt mode. The most dangerous trades happen here. Don't let your emotions drive the bus, create rules. 2 losses in a row. Step away for 15 minutes. Feel your emotions spike. 1 minute deep breathing. Can't follow your plan? Shut down for the day. Your mental stop-loss protects your account and your peace of mind. Training yourself to respond, not react. Reactions are instant. They're emotional. They're unconscious. Responses are thoughtful. They're measured. They're intentional. The goal of emotional mastery is to respond, not react. Here's how to build that skill. Reframe the trade. Instead of saying, I have to win this trade, say, I get to practice emotional control today. I can't believe I lost. Say, this is data, it's feedback, nothing more. Reframing turns pressure into opportunity. Journal the moment. After each trade, write, what was I feeling before I entered? What did I feel during the trade? Did I respond or react? This reflection turns emotion into awareness. Awareness turns into growth. Build a pre-trade ritual. Before every trade session, do the same 3 things. Maybe, review your plan, say a mantra, breathe deeply for 1 minute. This ritual signals your brain. We're shifting into calm, focused mode now. Over time, it becomes automatic. Your body remembers the calm. You enter the zone. Final thoughts. Mastering the moment isn't about being cold or emotionless. It's about being conscious. It's knowing that the market doesn't control you. You control how you show up. In the heat of a trade, remember, pause, breathe, visualize, respond, don't react. These are the real trading tools, not indicators, not alerts, inner mastery. And the more you train it, the more powerful you become, because when you master the moment, you master the market. Chapter 7. Revenge Trading and Emotional Overtrading. We've all felt it. That sting, that frustration, the trade that hits your stop, the missed move that takes off without you, the one that should have worked, but didn't. And in that moment, the urge rises to get it back, to prove something, to make the pain stop. You click again, enter another trade, then another, and another. That's not trading anymore. That's revenge. It's overtrading fueled by emotion. And it's one of the fastest ways to blow up a perfectly good trading account. In this chapter, we're going deep into the psychology of revenge trading and emotional overtrading. You'll learn how to spot the warning signs early, how to interrupt the spiral, and how to create your own emotional cool-down process so you can reset, refocus, and recover without digging the hole deeper. Let's break the pattern. Let's take back control. The damage of emotional retaliation. Revenge trading is the act of retaliating against the market. It's not based on strategy. It's based on emotion. It happens when you take a loss and immediately feel the need to make it back. The mindset sounds like this: I'll just double my size and recover fast. This setup looks good. I'll get back in right away. I can't end the day red. But here's the truth. The market doesn't care. There's nothing to win back. There's no opponent, only your own discipline, or lack of it. Revenge. Trading is gambling in disguise. It's impulsive, it's desperate, and it's usually the beginning of a much bigger loss. You don't just lose money, you lose confidence, you lose clarity. You damage your emotional capital, the most important asset you have as a trader. Recognizing tilt and the emotional spiral. Professional poker players have a term for this. Tilt. It's when a player becomes emotionally unhinged after a loss. They stop thinking clearly. They become reckless. They chase. They force. They spiral. Traders go on tilt too, and the sooner you can recognize it, the sooner you can stop it. Signs you're on tilt. Your trading setups you don't. Normally take. You've increased position size without reason. You're skipping your trading rules. You're ignoring stop losses or revenge entering after one. You feel frantic, anxious, or angry. But keep clicking. In that moment, you're not trading. You're reacting, and every click digs the hole deeper. You need a system to catch yourself before the spiral starts. Resetting your state. After a bad trade, what you do after a loss defines your long-term success. Losses happen. They're part of the game, but how you respond, that's what separates professionals from amateurs. Here's how to reset after a tough trade. Step away physically. Leave your screen. Walk to another room. Stand up. Stretch. Drink water. Get out of the emotional heat zone. Acknowledge the emotion. Say it out loud. I'm angry. I'm frustrated. I feel embarrassed. Naming the emotion gives you power over it. What you can name, you can tame. Breathe intentionally. Take 3 slow, controlled breaths. Inhale through your nose for 4 seconds. Hold for 2 seconds. Exhale slowly through your mouth. Do it again and again. This calms your nervous system. It brings you back to rational thinking. Ask yourself, what would a pro do now? Would a professional double their position out of frustration? Would they revenge trade to feel better, or would they pause, reflect, and protect their capital? Channel that answer. Become that person. Review without judgment. Don't beat yourself up. Ask, did I follow my rules? Was the trade part of my plan? What emotion was I feeling before I entered? Use the loss as data, not drama. Emotional cool-down. Routines. Every trader needs a cool-down process. A way to reset their mind before re-entering the market. Here are some powerful cool-down tools. The 15-minute timeout. After a loss, especially a big one, set a timer. 15 minutes, no trades, no screens. Use that time to breathe, walk, journal, or simply sit in silence. It creates distance between the pain and your next decision. The cool-down journal. Keep a notebook next to your setup. After a loss, write down, what happened? How do I feel? What triggered the loss? Strategy or emotion? This turns emotional energy into constructive feedback. The reset ritual. Create a short ritual to reset after a loss. Examples. Close your eyes and repeat an affirmation. Do 10 deep breaths. Light a candle or sip tea slowly. Anything that grounds you. It might sound small, but rituals train your brain to shift gears. The rule of 2. Make a personal rule. If I break 2 rules in a row, I stop trading for the day. It's a self-imposed circuit breaker. It protects your capital and your sanity. End of session. Debrief. At the end of every trading day, win or lose, do a quick recap. What were my best decisions today? Where did emotion sneak in? What can I do better tomorrow? This ritual creates continuous improvement and emotional resilience. Final thoughts. Revenge trading is the emotional explosion that follows an unexpected loss. Overtrading is the slow leak that happens when you trade just to feel better. Both will drain your account. Both will sabotage your progress. But both can be avoided with awareness, tools, and a commitment to control. Here's the rule to live by. Never let one bad trade lead to another. That's how you stay in the game. That's how you build confidence. That's how you grow. You're not here to win every trade. You're here to trade with control, composure, and clarity. If you lose today, fine, but do it with discipline and come back stronger tomorrow. Chapter 8. Journaling and Self-Reflection for Emotional Mastery. Every trader keeps track of entries and exits, but only the elite track their emotions. It's easy to log numbers, price, time, stop loss, take profit. But the real growth comes when you start logging something else, yourself. What were you feeling before the trade? What thoughts were racing through your mind during it? Did you act out of discipline or out of impulse? This chapter is about a trader's most underrated tool, journaling, not just for performance, not just to track results, but to master your mindset. If you want to gain emotional control, you have to start with emotional awareness. You can't manage what you don't monitor, and journaling makes the invisible visible. This is how professionals grow. They don't just trade. They reflect, they study their habits, they catch patterns, and they use that insight to evolve. By the end of this chapter, you'll know exactly how to create a journaling routine that sharpens your emotional intelligence, builds mental clarity, and helps you trade with confidence, not chaos. Let's dive in. How journaling transforms your trading psychology. Let's make this clear. Journaling is not just about writing things down. It's a tool of self-mastery. When you put your thoughts on paper, you create space between you and your emotions. You stop being inside the storm and start observing. You become the watcher, the learner, the strategist. Here's what journaling does for your trading psychology. It reveals emotional patterns you didn't know you had. It forces you to slow down and process your experiences. It creates accountability because your thoughts are now visible. It helps you make better decisions next time. Without journaling, mistakes become cycles. With journaling, mistakes become lessons. And in trading, that difference is everything. Emotional logs, beyond entries and exits. Most trading journals look like spreadsheets. Price in, price out, win, loss, PL, setup. That's useful, but incomplete. What's missing? The emotional data. This is where emotional journaling comes in. Here's what to log. 1. Pre-trade feelings. What was I feeling before I entered this trade? Was I calm, anxious, hopeful, desperate? During trade emotions. How did I feel as the trade progressed? Did I want to close early, double down, walk away? Post-trade reflection. Did I follow my plan? What emotion had the most influence on this trade? What would I do differently next time? Triggers and patterns. Did anything outside of trading affect my state today? Did I break a rule because of fear, greed, impatience? Over time, this data builds emotional intelligence. You'll start seeing patterns like, I always get impulsive after 2 green trades in a row. I trade poorly when I don't sleep well. I tend to overtrade when I skip my morning routine. These are gold. This is where emotional mastery begins. Review routines. How pros learn from their feelings. Journaling is half the equation. Reviewing is the other half. Set a weekly or bi-weekly review session, just for you. No charts, no trades, just your journal and your attention. Ask yourself, what emotional habits showed up this week? What triggered my best trades? What triggered my worst trades? Where did I follow my plan despite emotion? Where did I let emotion override logic? Rate yourself, 1 to 10. How was my discipline this week? 1 to 10. How well did I handle losses? 1 to 10. How calm was I in each trade? Then set intentions for the next week. This week I'll pause before every trade. I'll journal immediately after emotional trades. I'll avoid trading when I feel scattered or tired. This isn't just reflection, it's refinement, small adjustments, consistent insight. That's what makes you better over time. Pros know this. Your trading success rises with your emotional awareness. Awareness is the first step to control. There's a simple truth in psychology. You can't change what you're not aware of. And journaling creates that awareness. It shows you what's really running the show. Are you trading from fear? Are you chasing because of ego? Are you forcing setups to feel productive? The goal isn't perfection, it's progress. Every journal entry sharpens your awareness. Every review strengthens your self-control. Think of journaling like a mirror. When you look into it daily, you can clean up what's messy. You see where you're slipping, and you adjust before it becomes a problem. Your journal becomes your mental coach. It never lies. It shows your patterns and your potential. The best part? Journaling doesn't require talent, only honesty. Final thoughts. If you want to become a more consistent trader, start journaling. Not just your trades, but your mindset, your emotions, your impulses, your self-talk, because every entry you make is a step toward emotional mastery, and emotional mastery is the real edge in trading. Start today. Even one line per trade is better than nothing. With time, you'll build a database of you, your patterns, your wins, your struggles, and most importantly, your growth. Chapter 9. Mindset Rituals for Long-Term Success. Success in trading is not just about charts, setups, or even money management. It's about the mindset you bring to the market every single day, how you prepare your mind before you trade, how you protect your mental energy throughout the day, and how you build emotional resilience that lasts for the long haul. This chapter will guide you through powerful mindset rituals that shape your trading psychology. These aren't complicated strategies or secret hacks. They are simple, intentional habits that create consistency, focus, and calm, even when the market throws you curveballs. Morning and pre-trade mindset rituals, how you start your day sets. The tone for every trade. Morning rituals help you enter the market grounded, clear, and confident. They create space between you and emotional impulses. They build a mental foundation that supports disciplined trading. Here are some effective morning and pre-trade rituals. Mindful breathing or meditation. Spend 5 minutes sitting quietly, focusing on your breath. Breathe deeply and slowly. Notice your thoughts, but don't engage them. This simple practice calms your nervous system and brings focus. Review your trading plan. Before the market opens, read over your trading rules and setups. Remind yourself of your risk limits and entry criteria. This reinforces discipline and reduces emotional decision-making. Visualization. Close your eyes and visualize yourself trading calmly and confidently. Imagine spotting setups, managing risk, and staying cool even during volatile moves. Visualization programs your brain for success. Set clear intentions. Say to yourself, "Today I will trade with patience. I will follow my plan. I will accept losses without emotion." Intentions help anchor your focus and create accountability. Daily affirmations, visualization, and gratitude. Mindset rituals don't stop once the market opens. Throughout the day, use affirmations and gratitude to stay centered. Daily affirmations, positive. Statements repeated regularly can reshape your inner dialogue. Examples: I am disciplined and focused. I trust my trading plan. Losses are part of the journey. I stay calm and composed. Repeat them silently or out loud. The goal is to replace fear and doubt with confidence and clarity. Gratitude practice. It might seem strange to practice gratitude in trading, a tough, competitive environment. but gratitude shifts your mindset from scarcity to abundance. Take a moment each day to list 3 things you're grateful for, trading related or not. Gratitude reduces stress and builds emotional resilience. Visualization. In addition to morning practice, use short visualization breaks during the day. Close your eyes for 30 seconds and picture yourself staying calm and making smart decisions. This resets your emotional state and keeps you grounded, protecting your mental energy. Like capital, mental energy is your most valuable trading asset. Without it, your decisions suffer, your discipline falters, your emotions run wild. Protect your mental energy like you protect your trading capital. Here's how. Limit distractions. Turn off non-essential notifications. Close irrelevant tabs or apps. Create a quiet, focused workspace. Manage information. Intake. Avoid overloading yourself with market noise or social media drama. Stick to trusted sources and your own plan. Schedule breaks. Step away from screens regularly. Walk, stretch, hydrate. Breaks recharge your mind and reduce emotional fatigue. Sleep and nutrition. Prioritize quality sleep and balanced meals. Your brain works best when well-rested and nourished. Building emotional resilience. Over time, emotional resilience is the ability to bounce back from setbacks and stay composed under pressure. It's what turns traders into winners over months and years. How do you build it? Embrace losses as learning, accept that losses are part of the process. Instead of fearing them, study what went wrong, calmly and objectively. Practice patience, resilience. Grows when you resist the urge to rush trades or force outcomes. Patience allows you to wait for the right setups and avoid impulsive mistakes. Maintain a growth mindset. Believe your skills and mindset can improve with effort. See challenges as opportunities, not threats. Surround yourself with support. Connect with other traders or mentors who encourage disciplined, emotional trading. Community strengthens resilience. Final thoughts. Your mindset rituals are the backbone of your trading success. They create stability in an unpredictable market. They protect you from emotional breakdowns. They empower you to trade with clarity and confidence every day. Start small. Pick 1 or 2 rituals from this chapter and make them daily habits. Build on them consistently. Remember, the market will always test your emotions. But with strong mindset rituals, you can stay grounded and in control. The final chapter will bring everything together, giving you a blueprint to build emotional control into every aspect of your trading life. Keep going. Your best trades are ahead. Chapter 10. Becoming the Calm Trader. Your new identity. Trading isn't just what you do, it's who you are. In this final chapter, we focus on a powerful transformation, becoming the calm trader. The trader who faces the market with steady nerves, clear focus, and unshakable confidence. The trader who no longer lets emotion dictate decisions. The trader who embodies discipline as a core part of their identity. Let's explore what it truly means to be calm in the chaos, and how you can live that identity every day. What a calm trader looks and thinks like. A calm trader is not someone without fear or doubt. They have fear and doubt, but they don't let it control them. Here's how a calm trader thinks. They see losses as temporary setbacks, not personal failures. They trust their strategy, even when the market tests it. They focus on process over outcomes. They breathe through moments of stress instead of reacting impulsively. They remain patient and wait for the right opportunities. They control what they can, their mindset and actions, and let go of what they can't. Market noise and unpredictability. Calm traders understand that trading is a journey. Ups and downs come with the territory. But their steady mindset keeps them moving forward. Letting go of perfectionism and pressure. One of the biggest barriers to calmness is the desire to be perfect. Perfectionism creates pressure. Pressure breeds anxiety. Anxiety leads to mistakes. Trading isn't about being perfect. It's about being consistent, except that losses and errors happen. They don't define your skill or worth as a trader. Replace the pressure to be flawless with the goal of progress. Every trade is a chance to learn, adapt, and improve. When you let go of perfectionism, you free your mind from unrealistic expectations. That freedom is where calmness thrives. The identity shift, from gambler to strategist. Many traders start as gamblers, chasing quick wins, driven by emotion and chance. But true success requires an identity shift. Becoming a strategist means planning every trade with clear rules,
managing risk carefully, analyzing your performance objectively, staying disciplined even when tempted to chase losses or ride greed. This shift rewires how you see yourself. You move from reactive to proactive, from impulsive to intentional. Your
identity changes. You are no longer a gambler hoping for luck. You are a thoughtful, patient strategist playing the long game. How to embody confidence. Every day. Confidence isn't something you find. It's something you build. Start by taking daily actions that reinforce your calm trader identity. Prepare thoroughly before every trading session. Follow your plan without exception. Journal honestly about your emotions and decisions. Celebrate small wins and lessons learned. Use affirmations like, "I trade with calm and clarity." Surround yourself with positive influences and mentors. Every day, tell yourself, "I'm a calm and confident trader. I control my emotions. They don't control me." With time, this mindset becomes second nature. You'll notice your reactions soften, your decisions sharpen, your results improve. Confidence grows from consistent practice, not from winning every trade. Final inspiration. Your trading journey starts now. You've learned how emotions can make or break your trading success. You've discovered practical tools to master fear, greed, and impulsivity. You've built habits and rituals that protect your mental edge. And now, you're ready to claim your new identity. The calm trader inside you is waiting. Step into that. Roll fully and unapologetically. Trading is not just a skill, it's a mindset. And that mindset is yours to shape. Keep practicing. Keep reflecting. Keep growing. The market will always challenge you, but with emotional control, you'll always rise. Thank you for listening. If this audiobook helped you, be sure to subscribe for more insights and guidance. Your best trading days are ahead. Conclusion. You're the edge. Now, for too long, your emotions controlled your trading decisions, but not anymore. You've taken a powerful journey, from feeling overwhelmed by fear and greed to mastering your mindset with discipline and calm. You've learned to recognize emotional traps and respond with clarity. You've built daily rituals that protect your mental edge. You've embraced a new identity as a confident, strategic trader. This transformation isn't just about feeling better. It directly increases your profitability. Emotional control means fewer impulsive trades, better risk management, and smarter decisions. It's the real edge that successful traders have, one that no indicator or system can replace. Remember, mastering your emotions is an ongoing practice. Keep sharpening your skills. Keep reflecting on your mindset. Keep growing into the trader you want to be. Thank you for trusting this guide on your trading journey. If you found value here, subscribe now to stay sharp, level-headed, and ready. For every market move, your best trades are yet to come.
SSDs are more expensive. They offer significantly faster data retrieval than HDD. For instance, an SSD may have a read speed of 500 megabytes per second to 3500, while an HDD might offer 80 to 160 megabytes per second. The next immediate access point after disk is the RAM or random access memory. RAM serves as the primary active data holder, and it holds data structures, variables, and applications data that are currently in use or being processed. When a program runs, its variables, intermediate computations, runtime stack, and more are stored in RAM because it allows for a quick read and write access. This is a volatile memory, which means that it requires power to retain its contents, and after you restart the computer, the data may not be persisted. In terms of size, RAMs range from a few gigabytes in consumer devices to hundreds of gigabytes in high-end servers. Their read-write speed often surpasses 5000 megabytes per second, which is faster than even the fastest SSD disk speed. But sometimes even this speed isn't enough, which brings us to the cache. The cache is smaller than RAM, typically it's measured in megabytes. But access times for cache memory are even faster than RAM, often just a few nanoseconds for the L1 cache. The CPU first checks the L1 cache for the data. If it's not found, it checks the L2 and L3 cache, and then finally it checks the RAM. The purpose of a cache is to reduce the average time to access data. That's why we store frequently used data here to optimize CPU performance. And what about the CPU? CPU is the brain of the computer. It fetches, decodes, and executes instructions. When you run your code, it's the CPU that processes the operations defined in that program. But before it can run our code, which is written in high-level languages like Java, C++, Python, or other languages, our code first needs to be compiled into machine code. A compiler performs this translation, and once the code is compiled into machine code, the CPU can execute it. It can read and
Introduction. The lazy trader. Ever feel like you're trying way too hard and still losing money in trading? You wake up early, check 5 charts, jump into trades, watch every candle move, read the news, watch YouTube videos, and by the end of the day, you're stressed out, confused, and maybe even in the red again. Sound familiar? Yeah, I've been there too. Most traders think they need to do more to succeed. More screen time, more trades, more analysis. But here's the truth. No one tells you more doesn't mean better. In fact, it's usually the reason you're stuck. This book isn't about working harder. It's about working smarter. It's about trading in a way that feels calm, simple, and actually works without draining your energy or ruining your peace of mind. Welcome to the lazy trader, not the lazy that means careless, but the kind of lazy that means efficient, focused, and free. In this book, you'll learn how to trade less and make better decisions, why waiting is often your best trading strategy, how to build a trading system that fits your life, and how to stop trading emotionally and start trading like a pro. This book is for you if you're tired of overthinking every trade. You're done blowing up your account. You just want a simple way to win in the market without going crazy. Before you start, make sure to subscribe our channel to become 1% better of hustle. Why hard work doesn't work in trading and what actually does. What if I told you that working harder is the very thing that's holding you back in trading? Sounds crazy, right? From childhood, most of us are told, hard work is the key to success. Study more, hustle harder, stay up later, and push beyond your limits. And in many areas of life, school, career, sports, that advice can work. But trading, it plays by a whole different set of rules. If you're approaching the market with a hustle mindset, chances are you're already losing. And I say this not to discourage you, but to open your eyes to a truth most traders ignore. In trading, hustle doesn't equal success. In fact, it usually leads to disaster. Let me paint the picture. You wake up, open your laptop, and immediately start scanning the market. No plan, no preparation, just vibes. You see a stock moving. FOMO kicks in. You chase it. You enter too early or too late. It drops. You panic. You add more to average down. It drops further. You close in a loss. Now you're frustrated. You jump into another trade to make it back. The cycle continues. That's not trading. That's emotional gambling. And yet this is the reality for thousands of new traders every single day. They're working harder than ever, watching the market all day, juggling 3-4 indicators, following 10 gurus on YouTube, glued to their phones, 16 hours a day, but they're still losing. Why? Because they're trading with a grind and hustle mentality in a game that rewards patience, clarity, and control. The market doesn't care how many hours you stare at a screen. It doesn't reward effort, it rewards precision. This is where the idea of the lazy trader begins. Lazy doesn't mean sloppy. It means intentional. It means doing less, but doing it right. It means removing noise, distractions, and emotional chaos, and building a system that works for you, not one that burns you out. Let's go deeper. Think about any professional trader you've seen who's consistently profitable. Are they frantically entering trades every 15 minutes? Are they chasing every market move? No. In fact, many of them take only 1 or 2 quality trades a week. Some don't trade at all on certain days. They're calm, patient, detached. They have nothing to prove to the market, and that's why they win. This mindset is hard for most new traders to adopt because it feels like you're not doing enough. We're addicted to the feeling of being busy. We think if we're constantly doing something, we're progressing. But in trading, activity often leads to overtrading. And overtrading leads to losses, burnout, and emotional damage. The truth is, most of the time, the best trade is no trade. It's a tough pill to swallow. But here's where things start to shift. When you begin to understand that trading is not about action, it's about intention, you take your power back. Let me share a personal story. Years ago, I mentored a trader named Alex. He was smart, hardworking, and determined to become successful. He read books, watched videos, tracked dozens of stocks, and made multiple trades every day. But month after month, his account was shrinking. When we sat down to review his journal, the issue was obvious. He was chasing setups that weren't there. He was trying to force results through effort. His trades weren't based on solid rules or edge. They were based on emotions, impulses, and noise. So I gave him one simple challenge. Only trade when you have 3 solid confirmations. No guesswork, no gut feelings. If the setup isn't perfect, skip it. At first, he hated it. He felt like he wasn't doing enough. He was bored. But after 2 weeks, his win rate went up. His stress went down. And more importantly, he stopped overtrading. 1 month later, he messaged me. I've made more in the last 3 weeks, trading just 4 times than I did trading 50 times last month. That's the lazy trader mindset in action. Let me ask you something. What's your goal with trading? Is it to be busy or is it to be profitable? If your goal is profits, then you need to let go of this idea that hustle equals success. In trading, it doesn't. All hustle does is cloud your mind, drain your energy, and cause you to chase losses. Now you might be thinking, but if I'm not watching the market all day, I'll miss opportunities. That's another myth. The market is full of opportunities, but only a few are meant for you. The rest are distractions. You don't need to catch every wave to surf successfully. You just need to wait for your wave and ride it with confidence. And here's the beautiful part. When you stop hustling, you start seeing more. Your mind slows down. You begin to notice patterns. You're no longer reacting. You're planning. You're not forcing trades. You're waiting for them. The lazy trader is a sniper, not a machine gunner. You don't spray and pray. You wait. You breathe. You fire when the shot is clear. This doesn't just help your profits. It helps your life. Too many traders sacrifice their peace, sleep, and relationships in the name of hustling. But what's the point of making money if you're burned out, angry, or disconnected from the people you love? Trading should give you freedom, not take it away. So if you've been stuck in the hustle trap, this is your chance to reset. You don't need more trades. You don't need more indicators. You don't need more YouTube gurus yelling at you. You need clarity, simplicity, and control. You need to become a lazy trader. This is where it starts. In the next chapters, I'll show you how to build a system that works with your schedule and style. I'll show you how to control your emotions, protect your capital, and grow your account without selling your soul to the charts. But for now, I want you to sit with this idea. Success in trading doesn't come from trying harder. It comes from thinking smarter. Let that sink in. Because the faster you let go of the hustle myth, the sooner you'll find real consistency, not just in your trading, but in your mind. This is your edge. Most traders will ignore this. They'll keep grinding, guessing, and blowing up accounts. But not you. You're here. You're ready to trade differently. And you're about to discover that being lazy might just be the smartest thing you've ever done. Welcome to a new way of trading. Welcome to peace. Welcome to profit. Welcome to less, win more. The power of doing nothing. On purpose. Let's start with a simple truth that most traders ignore. You don't need to trade every day to make money. In fact, the traders who consistently grow their accounts aren't the ones who trade the most. They're the ones who wait the most. And yes, I know how strange that sounds in a world that glorifies hustle, alerts, and being in the market all day. But ask any professional trader and they'll tell you the same thing. Less is more. Most new traders believe more trades works, more opportunities charts more profits. But in reality, more trades usually saw more mistakes, more stress, and more losses. It's like shooting arrows blindfolded. You might hit the target once in a while, but most of the time you're just wasting arrows. The truth is, trading isn't about how often you enter the market. It's about how well you do when you do enter. Let's take an example. Imagine two traders. Trader A takes 30 trades a week, chasing every candle pattern and reacting to every market move. Trader B takes 3 to 5 trades a week, only when their setup is perfect, when the market conditions match their strategy, and when their mind is calm and focused. Who do you think is more likely to be consistent? Trader A is burned out, emotionally, drained, and always second-guessing their decisions. Trader B, focused, calm, and selective. That's what we call strategic inactivity, the art of doing nothing until it's exactly the right time to act. And it's one of the most powerful weapons a lazy trader has. But let's talk about why this is so hard for most people. We live in a culture that's addicted to action. Doing nothing feels wrong. If we're not constantly clicking buttons or analyzing charts, we feel like we're falling behind. The silence becomes uncomfortable. The waiting feels like weakness. But that's just noise from the outside world. In trading, waiting is a skill. Patience is power. Think about the best athletes, soldiers, or snipers. They don't fire constantly. They study. They plan. They wait. Then when the moment is right, they strike with precision. The market rewards that same kind of discipline. The problem is, most traders don't know what they're waiting for. They sit at their computers all day thinking, maybe this is a setup. Maybe this is a signal. Maybe I should jump in just in case. That's not trading. That's hoping. If you're hoping, you're already in trouble. One of the biggest shifts you can make in your trading journey is this: stop hoping. Start planning. The lazy trader doesn't guess. The lazy trader builds clear rules. Rules that say, I only trade when A, B, and C line up. If not, I walk away. It's that simple and that hard. Simple because the system can be designed in black and white. You don't trade based on your mood. You trade based on clear conditions. Hard because it takes real discipline to stick to those rules, especially when the market looks exciting. Let me tell you a story. I once coached a trader named Jenna. She was talented and knew her stuff, but she struggled with overtrading. She'd sit in front of her screen for 6 to 8 hours a day, jumping in and out of positions, burning through her capital, and constantly feeling exhausted. We worked on just one change. She could only trade if her setup appeared twice in the first 3 hours of the market. If not, she had to walk away. The first week, she hated it. She felt lazy. She felt like she was missing out. But then something interesting happened. She started sleeping better. Her anxiety dropped. Her trades became more thoughtful. And her profits, they started growing, slowly but surely. 1 month later, she told me, it's weird. I'm trading way less, but I'm winning more, and I actually enjoy it now. That's the magic of trading less. The more you trade, the more you expose yourself to risk. The more decisions you make, the more chances you have to mess up. But when you reduce your trades to only the best setups, you're stacking the odds in your favor. You're also saving your mental capital, and that's a term most traders don't talk about enough. Mental capital is your emotional energy, the part of your brain that helps you make smart decisions. When you overtrade, you burn through it. You become more emotional. You get tired. You start forcing trades just to feel in control again. But when you limit your trades, you protect that energy. You stay calm. You're not chasing. You're choosing. Big difference. Now, I'm not saying you should only trade once a month. Every trader is different. But I am saying find your rhythm and build your rules around it. For some, it's 1 quality trade a day. For others, it's 2 to 3 trades a week. The number doesn't matter. The quality does. Here's something else to consider. Every trade you take comes with a cost, even if you win. That cost is your time, attention, energy, and emotional bandwidth. If you take 20 trades a week, that's 20 decisions, 20 emotional reactions. 20 times your brain goes into fight or flight mode. That kind of stress adds up, and over time, it kills your consistency. But if you trade less, you conserve that energy. You focus it on the few moments that actually matter. You're not tired, scattered, or desperate. You're sharp, clean, in control. And that's when trading becomes enjoyable. That's when you start to feel like a professional, not just someone reacting to candles all day. One of the best pieces of advice I ever got was this: your job is not to trade. Your job is to wait for your setup. Let that sink in. If your job was to trade every day, then yeah, you'd be staring at screens nonstop. But if your real job is to wait, plan, and protect your capital, then doing nothing most of the time is actually part of the process. And guess what? That's what the best traders do. They don't rush. They don't force. They don't trade out of boredom. They wait. They sit. They read the market like a patient observer. And then, when the setup shows up, they act. That's the lazy trader mindset. Do less. Do it better. Let the market come to you. It's not always easy. There will be days when you feel like you're missing out. There will be moments when other traders are bragging about catching moves that you skipped. But long term, you'll win. Because while they're burning out, you're building a solid foundation. While they're gambling, you're protecting your capital. And while they're stuck in the cycle of boom and bust, you're growing, slowly, surely, and with peace of mind. Trading less is not about being lazy. It's about being smart. It's about understanding that in the market, time and patience are your real edge, not action. It's about learning how to sit with silence, how to trust your system, how to know the difference between a trade and a trap. Most people won't do this. They'll keep chasing the next big breakout, staring at charts all day and wondering why they're not getting ahead. But you're different. You're learning the truth early. You're taking control of your trading life before the chaos takes control of you. And if you stick with this approach, if you trust it, apply it, and build your system around it, you'll be amazed at how everything changes. Your profits will go up. Your stress will go down. Your confidence will grow. You'll stop feeling desperate. You'll stop feeling behind. You'll trade from a place of calm, not chaos. That's the lazy trader way. And it starts with this one simple mindset. Do less, win more. You don't have to do everything. You just have to do the right things at the right time. So take a breath, step back, stop chasing every candle, and start trading like a lazy trader. Because in this game, the one who waits, the setup is the edge. Why your edge lives in your preparation, not your prediction. Be honest with me for a second. How many times have you looked at a chart, felt something in your gut, and clicked buy or sell, thinking, this looks like it's going to move? And then, nothing, or worse, it moves the other way. Welcome to the painful truth. Most traders don't have a real edge. They're just making predictions and hoping they're right. But hope isn't a strategy. Guesswork isn't a system. And randomness overs. Time is just expensive gambling. This chapter is your turning point. Because here's what professional traders know that most people don't. You don't make money from predicting the market. You make money from preparing for it. That preparation, that's your setup. The lazy trader doesn't chase action. The lazy trader waits for the right conditions, the right moment, the right setup. That's the difference between trading like a gambler and trading like a sniper. Let me explain. Imagine two people walking into a casino. One sits down at the slot machine, pushing buttons randomly, hoping to hit the jackpot. The other walks into a poker table, studies the other players, waits for the right hand, and only bets when the odds are stacked in his favor. Which one has an edge? It's obvious. The poker player. Because he's not gambling, he's playing with information, discipline, and strategy. That's exactly how trading works. Your setup is your hand. Your rules are your edge. And if you play every setup the same way, with the same patience and precision, you remove luck from the equation and stack the probabilities in your favor. But here's the catch. Most traders never define their setup. They trade based on vibes. Maybe they see a big green candle and think, that must mean it's going up. Or they hear a YouTuber say, this stock is going to explode. So they jump in. No plan, no preparation, no edge. And it usually ends the same way. Loss, confusion, and frustration. That's where journaling, backtesting, and system building come in. Let's break this down in a way that's easy to understand. A setup is simply a repeatable condition that tells you when to enter a trade. Think of it like this. If this happens, plus, that happens plus, this aligns. Take the trade. If not, walk away. The more specific and rule-based your setup is, the more confident you'll feel. No second guessing, no panic, just execution. But how do you build a setup? That's where preparation becomes your superpower. The first step is observation. Go back to the charts, not to predict the future, but to study the past. Look for patterns. Look for trades that worked and ask, what was happening before that move? What indicators or price actions lined up? What time of day was it? Was volume increasing? Was there news? The second step is journaling. Write everything down. Not just the entry and exit price, but the why behind the trade, the setup, the risk, the confidence level, the emotional state you were in when you placed the trade. Your trading journal is like a mirror. It doesn't lie. It reveals your habits, your mistakes, and your edge. I once worked with a trader named Rob. For months, he was breaking even, winning some trades, losing others, but had no idea why. When I asked him about his edge, he said, I just go by feel. We changed one thing. He had to journal every trade in detail. Within 2 weeks, we discovered something powerful. Almost all of Rob's profitable trades shared the same pattern, a strong pullback to a moving average with decreasing volume on the retrace and a bullish engulfing candle as confirmation. He didn't realize it at first, but he had a winning setup. It was just buried under all the noise, all the bad trades, all the emotional guesses. Once we defined that setup and he committed to trading only that pattern, things changed. He started winning more consistently. He stopped overtrading. His confidence grew. Why? Because now he had an edge. He wasn't just predicting anymore. He was executing a plan. This is what most traders miss. They think trading is about constantly analyzing the market, following every move and reacting in real time. But the lazy trader flips that thinking. You don't need to predict what the market will do. You just need to prepare for what you'll do if it happens. Read that again. That one shift can change everything. Backtesting is another weapon in your preparation toolbox. It's the process of going back through months or even years of historical data to see how your setup would have performed. You're not just guessing, you're gathering data. If your setup worked 68% of the time across 200 plus trades in different market conditions, now you're no longer hoping. It's backed by evidence. This gives you statistical confidence, not emotional confidence. Most people lack this, and that's why they panic when a trade goes red. But when you've seen your setup work again and again, you don't flinch. You trust the process. Think about it like this. If you were flipping a coin and you knew it landed on heads 65% of the time, would you worry every time it landed tails once? Of course not. Because you know over time, heads wins. That's what a setup gives you. An edge over time. A game you can win. It also removes something that ruins most traders: overthinking. When you don't have a setup, your brain tries to make decisions based on emotion. You might second-guess a good entry, or you might jump into a bad trade just because the market looks exciting. Either way, you're playing a dangerous game. But with a setup, you trade like a robot. See the signal, take the trade. No drama, no panic, just rules. And here's the beautiful part. Your setup doesn't have to be complicated. It doesn't need 15 indicators or a fancy algorithm. In fact, the best setups are often the simplest. It could be a clean breakout after consolidation, or a trend continuation after a pullback, or a reversal signal at a key support level. What matters isn't how flashy it looks. It's how consistent it is. You want something that repeats, something that makes sense, something that fits your style. And, this is key, Your setup should fit you. Some people love scalping fast moves. Others prefer swing trading over days. Some like trading news. Others hate it. There's no one-size-fits-all setup. That's why journaling and backtesting are so important. They help you discover your edge, not someone else's. So the next time you're tempted to follow a random call-out or copy a strategy from a stranger on Twitter, pause and ask, does this align with my setup? If not, skip it. You don't need 100 trades to be profitable. You just need one setup that works, and the discipline to wait for it. This is what separates the lazy trader from the average trader. The average trader is always reacting, always chasing, always guessing. The lazy trader is always preparing, always refining, always waiting. And preparation builds confidence. Confidence builds consistency, and consistency builds results. Let's be real. The market is unpredictable. No one knows what it will do next. But you can control how you respond. You can control what setups you trade. You can control your risk. That's your edge. Your setup is your defense against emotional trading. It's your plan when the market goes crazy. It's your rulebook when your brain wants to gamble. It's your edge. So take the time to define it, study it, refine it, master it. Because once you do, everything changes. You stop feeling lost. You stop needing confirmation from other people. You stop feeling like you're guessing every time you hit buy. Instead, you feel calm, prepared, in control. And in a world full of noise, that kind of clarity is rare and powerful. So here's your homework. If you're ready to take this seriously, start building your setup. Go back through your winning trades. Look for common patterns. Define what must be true before you enter a trade. Then journal it. Test it. Commit to it. Treat it like a playbook. Treat it like a business. Because when your setup becomes second nature, you free yourself from doubt. You don't need to trade more. You just need to trade smarter. And smarter starts with a setup. So remember this, the setup is the edge. Preparation beats prediction. And the lazy trader always comes prepared. Chapter 4. Welcome to Kill the Noise. Level. Escape information overload and trust your plan. Let me ask you something simple. Have you ever opened your laptop to trade and been overwhelmed within minutes? Your chart is open. Twitter is buzzing. Discord has 100 unread messages. CNBC is flashing red alerts. Your favorite YouTuber just dropped a must-watch before market opens video. You've got 13 indicators on your screen, all pointing in different directions, and you're just sitting there thinking, what the hell do I do now? Welcome to the chaos. This is what we call trading noise. The mental clutter, the constant opinions, the fire hose of information that promises clarity but delivers confusion. And here's the harsh truth. The more noise you consume, the worse your decisions become. Most traders don't lose because they don't know enough. They lose because they know too much. At least they think they do. They drown in analysis. They get stuck in decision paralysis. And worst of all, they start second-guessing their system, their strategy, and themselves. This is where the lazy trader is different. The lazy trader understands that more information doesn't equal better trading. In fact, too much information is a liability. It creates doubt, hesitation, overreaction. It makes you emotional. So what do we do instead? We kill the noise. We simplify. We trust the process. Think about this. The best traders in the world are not sitting in front of 6 monitors watching 25 charts at once. They're not toggling between Reddit, Twitter, YouTube, and 5 Discord groups for signals. They have one screen, one chart, one system, and most importantly, they have peace of mind. Because here's what they know. Trading success doesn't come from more inputs. It comes from more clarity, Let me take you back to my early trading days. Like most beginners, I thought more was better. I subscribed to 5 news alerts, followed every guru on Twitter, and had so many indicators on my screen I couldn't even see the price action anymore. I was always reacting. One alert would make me bullish. A tweet 5 seconds later would make me bearish. My head was spinning. I wasn't trading. I was just chasing noise. I'll never forget one specific morning. There was this hot stock everyone was talking about. My Discord group was screaming, "Buy the dip." Twitter was saying, "Short this, junk." My chart had RSI, MACD, Bollinger Bands, and volume divergence, all giving mixed signals. I froze. I didn't know what to believe. I didn't take the trade. And then I beat myself up all day for missing a big move. But the real issue wasn't missing the trade. It was my mental state. I was exhausted before I even clicked a button. That's when I decided to unplug. I shut off every alert. I unfollowed 90% of the people I was getting trading advice from. I cleaned up my charts, removed every indicator I didn't deeply understand, and I decided from now on, I only trade my setup. No matter what Twitter says, no matter what the experts say, the result, my trading improved, my stress disappeared, and for the first time I felt like I was in control. You see, noise isn't just about distractions. Noise is a confidence killer. When you let every outside opinion into your mind, you give away your power. You start thinking other people know more than you. You stop trusting yourself, and that's dangerous, because trading isn't about being right every time. It's about following your process with discipline. And you can't do that if you're being pulled in 5 directions every second. So let's talk about how to kill the noise and become a confident, clear, and calm trader. First, simplify your sources. Pick one source of news if you absolutely need it. Just one, not 5. And honestly, most of the time, you don't need the news at all. By the time the headline hits your screen, the market already moved. If your setup doesn't rely on news, skip it. Next, clean your chart. If you need more than 2 indicators to make a decision, your system is too complicated. A clean chart with price action, support and resistance, and maybe 1 or 2 tools you understand deeply is enough. If you can't explain what every indicator on your chart does and why you use it, it doesn't belong there. Third, unfollow noisemakers. Yes, I'm talking about the Twitter gurus, the TikTok traders with Lamborghini videos, and the endless stream of top 3 stocks to buy today YouTube thumbnails. You know what they're selling. Attention, not accuracy. Their job is to keep you watching, not to help you win. If someone's content creates more anxiety than clarity, hit unfollow. Now here's where it gets deeper. Noise doesn't just come from screens. It comes from within. Every time you question your system mid-trade, that's noise. Every time you check your P&L 5 times during a trade, that's noise. Every time you compare your results to someone else's, that's noise. The lazy trader doesn't just simplify the outside world, they simplify their inner world too. And one of the best ways to do that is to create a trading routine, a rhythm, a process that eliminates thinking and replaces it with structure. Here's an example. Wake up, review the charts, mark your key levels, identify your setup, make your plan, then step away. No random trades, no midday FOMO, no revenge trading. Just follow the plan. That's it. When you trade this way, the noise disappears, the second-guessing fades, the fear calms down, and you finally start to feel in control of your decisions. Let me give you a relatable metaphor. Imagine a chef in a busy kitchen. There are dozens of ingredients, multiple dishes, and a lot of pressure. But the chef doesn't panic. Why? Because there's a recipe, a system. Every step is mapped out. The chef doesn't cook based on what's trending on Twitter. They follow the process. That's how trading should feel. You are the chef. The market is your kitchen, and your setup is the recipe. The moment you stop following it and start letting noise dictate your choices is the moment the whole dish burns. Now, some people say, but I don't want to miss out on opportunities. Here's what I tell them. You're not missing opportunities. You're missing clarity. Every time you trade something outside your system, just because it looks hot, you're making a withdrawal from your emotional capital. And those withdrawals add up. That's how you end up burnt out, bitter, and broke. The lazy trader understands this. They trade fewer setups, but they execute them with laser precision. No stress, no chasing, just clean decisions. One of my students, Jamie, struggled with this. He was always in 5 trades at once, always switching systems. One week he was trading breakouts, next week reversals, next week options. He was addicted to noise. I challenged him to do one thing, pick one setup, just one, and trade only that for 30 days. No matter what else was happening, it wasn't easy. He felt FOMO. He wanted to chase other plays. But he stayed disciplined, and guess what? His results improved. He made fewer trades, but more consistent wins. He slept better. He stopped checking his phone every 5 minutes. He stopped caring about what other people were trading. Because now he had clarity. That's the power of killing the noise. It gives you your brain back. So if you're feeling overwhelmed, scattered, or confused, don't look for more information. Look to remove it. The greatest traders don't know the most. They do the least, with the most precision. That's the secret. It's not sexy. It's not dramatic. But it works. So here's your call to action. Audit your trading life. Look at your screens, your feeds, your sources, your strategies, and ask, is this helping me think clearer or making me doubt more? Then start deleting, unfollow, unsubscribe, clean up your chart, delete the indicators you don't need, block the voices that don't align with your system, reclaim your focus. Because in trading, your edge isn't just in your setup, it's in your ability to stay calm while others panic, to stay focused while others chase, to trust your plan while others scroll endlessly. That's the lazy trader's advantage. You don't win by doing more. You win by doing less, better. So kill the noise. Trade with clarity. And finally, start winning on your 2-hour trading day. How to make your trading feel effortless and efficient. Let me ask you something real quick. Have you ever sat in front of your trading screen for 6 hours, watched 100 setups come and go, entered 3 of them, got stopped out twice, barely made a profit on one, and still felt like you got hit by a truck at the end of the day? Welcome to the trap 90% of traders fall into: overtrading and overanalyzing in the name of hustle. But here's a truth bomb. You don't get paid in trading for the hours you sit. You get paid for the quality of the decisions you make. Let that sink in. This chapter is not just about managing your time. It's about reclaiming your energy, your focus, and your life. Because here's the dirty secret no one talks about in the trading world. You don't need to be glued to your screen all day to be profitable. The lazy trader knows this. The lazy trader doesn't chase markets all day. They don't stare at candles forming second by second, praying for an entry. They've designed their trading around life, not the other way around. And the magic formula? A 2-hour trading day. That's it. 2 focused, intentional, high-quality hours. Not a minute more. When you hear this, you might think, only 2 hours? Is that even realistic? Not only is it realistic, it's optimal. You see, the longer you sit in front of the screen, the more likely you are to overtrade, get emotional, and break your rules. Trading is mentally exhausting, even if you're just watching. And fatigue leads to impulsiveness, that one quick scalp you take outside your plan. It usually happens in hour 5 of your watch everything marathon. Let's break this down and make it personal. Think of your brain like a battery. When you wake up, it's full, sharp, ready to execute. But the more noise, distractions, and decisions you expose it to, the faster it drains. The lazy trader protects that battery. They use their best hours, usually early in the morning, or a consistent window they know works, to do all their work. They get in, get out, and go live life. So how do you build your own 2-hour trading day? First, let's talk about structure. Every successful 2-hour trading routine has 3 simple parts: preparation, execution, and shutdown. That's it. These 3 steps give you everything you need to win and protect your mind from the chaos that burns most traders out. Let's start with preparation. This is your pre-market warm-up. Just like athletes don't jump into the game cold, traders shouldn't jump into the market without a plan. The lazy trader uses this first 30-45 minutes to review their watch list, identify key levels, mark support and resistance, and mentally prepare for what might happen, but without predicting. They don't browse Twitter or Reddit. They don't get caught up in hype. They focus on their setup, and only their setup. Next comes execution. This is your active trading window, typically 60-90 minutes. For most traders, this is during the first 1-2 hours of the market open, when volume and volatility are highest. The lazy trader already knows what they're looking for. If the setup comes, they take it. If it doesn't, they walk away. There's no FOMO here. No, maybe this is a good trade. It's either a clear setup or a hard pass. And finally, shutdown. This is the most underrated step. Most traders stay in front of the screen long after their edge is gone. They think they're being productive, but they're really just increasing the odds of doing something dumb. The lazy trader doesn't do that. They use the final 10-15 minutes of their 2-hour block to log their trades, reflect on their performance, and close their platform. That's it. Day's done. And guess what? That's where the magic happens. Because while everyone else is stuck to their chair, drained and anxious, the lazy trader is out living life, going for a walk, spending time with family, reading, working, on their side hustle, recharging. But let's address the elephant in the room. What if you work a 9-to-5 job? Perfect. You're exactly who this chapter was written for. The 2-hour trading day was designed with people like you in mind. People who want to trade, build wealth, and master their finances without quitting their job. All you need is a fixed window. That could be 8:30 a.m. to 10:30 a.m. EST before work starts. Or maybe it's 7:30 p.m. to 9:30 p.m. for swing trading or crypto. The actual time doesn't matter as much as the consistency of showing up. You don't need to catch every opportunity in the market. You just need to catch the ones that match your strategy during your window. Some of the most profitable traders I've coached are part-time. Why? Because they're not overexposed. They trade less, but better. They don't have time to second-guess everything. They trust the system. Take the trade. Close the screen. Done. Let me tell you a story. One of my clients, Lisa, was a full-time nurse. Her shifts were intense, 12 hours a day, on her feet, dealing with emergencies. But she loved the markets. She thought trading could be her way to financial freedom. At first, she was all over the place, trying to squeeze in trades during breaks. Checking her phone at every red light, dangerous, by the way, and staying up late watching chart breakdowns. She was exhausted and barely breaking even. We simplified everything. We built a 2-hour evening trading routine for her around swing setups. She only traded 3 days a week, just 1 or 2 setups max per day. She used alerts, no chart staring, no Discord hopping. And you know what happened? In 6 months, she doubled her account and finally felt peace. She wasn't chasing, she was flowing. The 2-hour trading day gave her structure, sanity, and results. This system works, not because it's magic, but because it respects the most valuable resource you have, your mental energy. The goal of this chapter is not just to cut your screen time, it's to increase your clarity to action ratio. The higher that ratio, the more confident you become. You're no longer scattered, desperate, or reactive. You become intentional, strategic, lazy, but in the smartest way possible. You know what most full-time traders don't tell you. They're miserable. They're always watching, always stressed, always scared to miss a move. They've built a life where they can't look away, not even for a weekend, but the lazy trader. The lazy trader builds a system that runs without them having to babysit it. They don't just trade for money. They trade for time, freedom, and peace. Because at the end of the day, it's not about maximizing trades. It's about maximizing life. Ask yourself right now, what if you only traded for 2 hours a day? What if you spent the rest of your time on things that make you better, calmer, and more creative? What if trading felt like a part of your life, not your entire identity? That's the goal. The market doesn't care how long you sit there. It cares how clearly you think. And the truth is, your clearest thinking usually happens early in the day, before the noise sets in. So here's your challenge. For the next 7 days, build your 2-hour trading day. Pick a consistent time. Create a pre-market checklist. Limit yourself to that window. Then shut it down. Log your results. Reflect. Walk away. You'll be shocked at how much better your performance becomes. You'll stop chasing. You'll stop second-guessing. And you'll start feeling like a real professional, not a gambler with a screen addiction. The lazy trader isn't lazy because they don't care. They're lazy because they're smart. They protect their energy. They trade their edge. They leave when their job is done. 2 hours. That's all you need the rest of the day. Emotional automation. How lazy traders protect themselves from their own mind. Have you ever been in a trade that was going south, and even though you knew you should cut your losses, you just didn't? Maybe you said, let's just give it a little more room. Maybe you moved your stop loss. Maybe you removed your stop loss. And before you knew it, what could have been a small $50 loss became a $500 meltdown and a whole weekend of stress. If that sounds familiar, don't worry. You're not broken. You're human. Every trader has been there. This chapter is about why we do that and how lazy traders build emotional automation systems to make sure it doesn't happen again. Let's get real for a second. Your biggest trading losses are rarely because of the market. They're because of your reactions to the market. The chart didn't hurt you. Your decisions did. And 90% of bad decisions come from one source: emotion, fear, greed, regret, FOMO, impatience, hope. These emotions are sneaky. They whisper. They justify. They convince you that this time is different. And in the heat of the moment, they override logic. You make impulsive choices that go completely against your trading plan. This is where the lazy trader stands out, because the lazy trader doesn't try to fight emotions in real time. They automate their responses ahead of time. They build systems that remove the need for emotional decision-making during live trades. Why? Because they know the truth. You cannot out-discipline emotion. You can only out-system it. Let's say that again. It's critical. You cannot out-discipline. Emotion. You can only out-system it. This is emotional automation in a nutshell. It's the art of pre-building decisions before you're in an emotional state, so that when the chaos hits, you don't have to think. You just follow the system. This chapter will show you exactly how to do that. We'll explore the psychology behind emotional mistakes and then break down simple tools lazy traders use to keep their minds clean and decisions sharp, even in the middle of market storms. Let's start with the root issue, the emotional brain. You see, your brain is actually two systems. System 1 is fast, emotional, instinctive. It reacts immediately, perfect for survival. System 2 is slower, more logical, analytical. It takes effort to engage. That's the part that writes your trading plan, does your backtesting, and understands risk management. But when money is on the line, especially your own, System 1 takes over. It doesn't care about your rules. It just wants to protect you from loss or chase gains to feel good again. That's why you revenge trade. That's why you hold on to losers. That's why you break your rules and tell yourself, I'll be more disciplined tomorrow. Here's the thing. Discipline is a muscle, and like any muscle, it gets tired. If you rely on willpower alone, you'll eventually crack. The lazy trader knows this. That's why they don't try to be strong during stress. They remove the stress ahead of time by building guardrails. Let's talk about those guardrails now. First up, automated stop losses. This is non-negotiable. You should never enter a trade without a stop loss already placed. Not in your head, not as a mental note, actually placed in the platform before the trade goes live. Why? Because in the moment, when the chart turns red, your brain will scream, it's just a pullback. But your pre-planned stop loss doesn't listen. It's already programmed. It executes when needed. No emotion involved. This one habit alone has saved traders millions in avoidable losses. Next, fixed position sizing. One of the biggest emotional triggers in trading is over-leverage. When you risk too much, every tick against you feels like a punch in the gut. You can't think straight. You panic. The lazy trader avoids this entirely by using the same risk percentage on every trade. For example, 1% of account balance. Always. No exceptions. That means whether your account is $1,000 or $100,000, the emotional impact of a loss is always manageable. You're never freaking out over a single trade. You're thinking in terms of series, not one shot. Now let's talk about decision simplicity. Most traders lose, not because they don't know what to do, but because they try to make too many decisions on the fly. The lazy trader removes this by creating if this then that rules. For example, if the trade hits this level, I exit. If I take 2 losses in a row, I stop for the day. If the market opens below my key zone, I don't trade. These rules are like an emotional firewall. They protect you from yourself. And here's the kicker. You must follow them even when you don't feel like it. Especially when you don't feel like it. Because the market rewards consistency, not emotion. Let me share a real example. Jake was a swing trader I coached a few years ago. He had a solid strategy, great entries, proper risk management. But every time a trade went slightly against him, he'd panic and close early. Or worse, he'd widen the stop to give it room. His win rate suffered. He kept beating himself up after trades saying, I knew what to do. Why didn't I just stick to the plan? Sound familiar? We rebuilt his routine around emotional automation. We created strict stop-loss rules. We set up a trading checklist he had to complete before any trade. We introduced a journaling habit to track emotions, not just results. Within 3 months, he had his average loss by 40%, his win rate went up by 18%, and most importantly, he felt peaceful. He wasn't battling his mind all day. He had rules. The rules worked, but emotional automation isn't just about risk management. It's about mindset recovery too. The lazy trader knows that how you think after a loss is just as important as how you manage during a trade. That's why they build reset rituals. After a tough trade, they don't jump back in to make it back. They walk, breathe, journal, reframe. They say, I followed my rules. That's a win, even if it was a loss. That shift is massive, because the moment you start measuring success by rule, following instead of just money, you gain emotional control. And once you have that, you become dangerous in a good way. You stop chasing. You stop doubting. You start thinking like a pro. Let's zoom out for a second. What is trading really? It's not about indicators. It's not about signals or news. It's about decision-making under uncertainty. And the better your decisions, the better your outcomes. But decisions don't happen in a vacuum. They happen inside your brain. And that brain is constantly being hijacked by emotion, unless you protect it. So here's the lazy trader's mindset. I do not trust my live trading emotions. I trust my plan. I trust my system. I trust my automation. This mindset doesn't make you robotic. It makes you free. Because when the rules are clear and preset, you don't waste energy doubting or overthinking. You just execute. Then you go. Live your life. And that, my friend, is the real secret. Trading is not just about winning. It's about lasting. The traders who burn out aren't the ones who lack skill. They're the ones who constantly run on emotional overload. You don't want that. You want to build something sustainable, something calm, something that fits into your life instead of controlling it. And emotional automation is the foundation of that. So if you've been struggling with discipline, stop trying to be stronger. Start building smarter systems. Set your stops. Fix your risk. Write your rules. Follow your plan, even when it feels wrong in the moment. Because real trading success isn't flashy. It's boring, repetitive, consistent. And for the lazy trader, that's exactly what we want. No drama, no mental roller coasters. Just clean, execution, and peace of mind. Because we're not here to chase dopamine. We're here to build freedom. And freedom starts with mastering the one thing most traders ignore. Your own consistent, boring profits. Why boring trading is the smartest kind. Let me ask you something. When you think of a successful trader, what comes to mind? Is it someone who flips a $500 account into $20,000 in 1 week? Is it someone who posts crazy profits on social media with screenshots of 500% gains? Or is it someone quietly making 1%, 2% per week, month after month, without drama? If you're like most new traders, you're probably drawn to the first image. It's exciting. It feels powerful, fast, impressive. But here's the truth that almost no one wants to hear. That jackpot style of trading is a lie. It's not sustainable. It's not consistent. It's not the way professionals trade. It's the equivalent of gambling. And the faster you try to get rich from trading, the faster you'll go broke. This chapter is about flipping that mindset upside down and showing you why boring, slow, consistent profits are not only smarter, they're what real wealth is built on. Lazy traders know this. They're not trying to win the lottery. They're trying to build a machine that generates quiet, steady income over time. They don't need fireworks. They need results. So, let's talk about what boring profits really look like and why they're the hidden superpower of every successful trader. Imagine this. You have a strategy that wins 60% of the time, and you only risk 1% of your account on each trade. Over a year, you take 200 trades. Some are wins, some are losses. Nothing dramatic, no massive home runs. But after 12 months of doing this consistently, you're up 30 to 40%. Now, that might not sound exciting to someone looking for 5x in a month, but here's what that actually means. If you started with $10,000, you've now got $13,000, $14,000. Repeat that for 5 years, and you're potentially doubling or tripling your capital with low stress and no gambling. More importantly, you've built a skill set that can scale. You can increase your position size, manage more capital, even trade for others if you choose. That's real trading. That's real freedom. But most traders never get there. Why? Because they're addicted to the big win. They want excitement. They want dopamine. They want the high of a 200% day, even if it means risking it all to get there. Let's be honest, that mindset doesn't come from logic. It comes from ego and impatience. You want to prove yourself. You want to tell your friends, I made $1,000 in a day. You want to feel like you're doing something bold and different. But here's the harsh truth. Bold traders don't last. Boring ones do. You know why casinos always win? Because they follow a boring system with small, consistent edges over time. They don't care if one gambler wins big. The house always profits long term because the math is in their favor, and they stick to it. Lazy traders act the same way. They're not trying to predict every move. They're not chasing every breakout. They're not entering 20 trades a day with no clear plan. They're patiently waiting for high-probability setups, managing risk like a pro, and compounding small profits over time. It's not sexy, but it works. Let me tell you a story. There was a trader I met named Sarah. She was a single mom with 2 kids. She didn't have time to sit in front of charts all day. No fancy equipment. No flashy indicators. Just one simple swing trading strategy she learned from a mentor. She risked 1% per trade. Took 2 to 3 trades a week. Kept a strict journal. Didn't chase anything. And you know what happened? She made around 2% a month. Month after month. It was slow, steady, predictable. After 1 year, she had earned 24%. After 2 years, she had built enough trust in herself that she got a small pool of investor capital. Within 3 years, she was managing $100,000 and making a full-time income. With a calm mind and zero stress, she didn't trade to feel adrenaline. She traded to buy back her time. That's the lazy trader mindset. Trading is supposed to give you freedom, not take it away. But most people turn trading into a chaotic job. They're glued to screens. They're constantly anxious. They're emotionally drained. And worst of all, they have no system, just hope. That's not freedom. That's addiction. You see, real wealth isn't built on jackpots. It's built on compounding. Let's do some simple math. Let's say you grow your account just 1% per week. Doesn't sound like much, right? But if you do that consistently, week after week, without major losses, your account grows over 67% in 1 year. If you grow 2% per week, you're looking at over 180% per year. And if you do that while managing risk, well, you're not just growing money, you're building confidence, you're building proof, you're building a track record. That's what gets you long-term success, not one viral win. Lazy traders play the long game. They're not in a rush. They're in control. They understand the goal isn't to make the most money today. It's to stay in the game long enough to win over time. And ironically, that's how they end up making more money than anyone else. So if you're still caught in the get-rich-fast trap, this is your wake-up call. Start thinking like a boring trader. Ask yourself, can I take this same setup 100 times and be okay with the outcome? Can I risk small and accept small wins without chasing more? Can I be okay with making $50 a day instead of trying to make $500? Because here's the thing. Once you master $50 a day, you can scale to $500. But if you chase $500 too early, you'll blow up and never get there. Boring builds the base. Then you scale from strength. Another key part of boring trading is having no attachment to single trades. You don't care whether this trade wins or loses. You care about the next 100 trades. That's how professional traders think. They don't get excited about a win or crushed by a loss. They just follow the system. Take the trade. Move on. It's mechanical. It's calm. It's effective. And guess what? It creates freedom because when your system is boring and repeatable, you don't have to micromanage. You can spend time with family, sleep peacefully, travel, read, create, live. Lazy traders value that more than screen time. They don't worship hustle. They worship systems. They know that success in trading comes not from working harder, but from removing emotion and increasing consistency. So how do you build a boring trading system? You keep it simple. One setup, one risk percentage, one routine. You repeat the process daily without trying to tweak it every time. You don't chase new indicators. You don't add 20 filters. You don't trade every market. You stick to your lane and do it well. That's where real confidence comes from. Not guessing, but knowing. Let me tell you one last thing. When I started trading, I thought I needed a million things. A fast computer, news feeds, gurus, expensive software. What I really needed was one thing, a calm mind and a clear plan. It took me years to figure that out. But once I embraced boring, everything changed. I made fewer trades, but better ones. I stressed less. I slept better. I made more money with less effort. That's the paradox of boring profits. They're not just profitable, they're peaceful. And in a world that constantly screams for attention, drama, and speed, peace is the new power. So if you take one thing away from this chapter, let it be this. Don't chase fireworks. Build a fireplace. Let your profits be small. Let your process be simple. Let your trading be boring. Because that's where real success lives. Not in excitement, but in mastery. Not in luck, but in system. Not in one big win, but in 1,000 boring, beautiful, consistent steps forward. That's what it means to be a lazy trader. Chapter 8. And that's what build a lazy trading system. Create a plug-and-play system that trades so you don't have to. Trading doesn't have to be complicated. In fact, the most successful traders are often the ones who keep it simple. The lazy trader knows this well. The goal isn't to spend hours glued to screens, juggling dozens of indicators, or constantly tweaking strategies. The goal is to build a system so clear, so straightforward, that it practically trades itself, allowing you to live your life while your money quietly grows. If you've ever felt overwhelmed by trading, like there are too many moving parts or endless choices, this chapter is for you. Because the truth is, trading can be easy. It can be simple. It can fit your schedule, your capital, and your temperament. It just needs the right system, and that's exactly what you're going to learn to build here. Why you need a system in the first place. Imagine walking into a kitchen and cooking a meal without a recipe. You might succeed, but most likely, it's a mess of guesswork, frustration, and inconsistent results. The same is true for trading. Without a system, you're guessing. You're reacting emotionally. You're chasing the next hot tip or market rumor. But a system is a recipe. It's a plan. It's a set of rules you follow, no matter what the market does or how you feel. A system removes guesswork and emotion. It creates discipline. More importantly, it lets you trade consistently. And consistency is the secret sauce of profitable trading. When you trade with a system, you're not gambling. You're not hoping or praying. You're executing a proven plan. That's the difference between a lucky trader and a professional trader. What makes a trading system lazy? The word lazy here might confuse you, because trading sounds hard, right? It's fast-paced, unpredictable, full of stress. But lazy trading isn't about slacking off. It's about smart work, not hard work. It's about building a system that works for you, fits your life, and requires minimal babysitting. A lazy trading system has some important qualities. It's simple. No complicated charts. No dozen indicators. No messy setups. It's rule-based. You know exactly when to enter, exit, and manage risk. It's back-tested, meaning it has proven itself over time and various market conditions. It's flexible. It fits your schedule, whether you trade 30 minutes a day or a few hours a week. It's scalable. It grows with your account and confidence. Most importantly, a lazy trading system lets you trade without feeling chained to your computer or trapped by stress. How to start building your lazy trading system. Building your system might sound like a big project, but it's easier than you think. Start by asking yourself a few simple questions. What markets do I want to trade? Stocks, Forex, crypto, futures. How much time can I realistically spend trading each day or week? What's my risk tolerance? How much am I willing to lose per trade? What kind of trader am I? Do I prefer fast trades or longer holds? Answering these honestly will help you tailor a system that fits your unique situation. For example, if you work a 9-to-5 job, trading, the stock market's opening minutes might not work, but swing trading on daily charts with a few minutes each evening could be perfect. If you have a small account, you'll want to manage risk tightly, maybe risking 1% or less per trade. Remember, the goal is not to copy someone else's complicated system. It's to design one that fits you. A simple sample. Lazy trading system to get you started. To make this less abstract, let's create a sample system you can plug in and start using. This system is designed for swing trading stocks or ETFs on daily charts. Perfect if you want to trade with minimal screen time. Here's the system. Entry. Buy when the 10-day simple moving average, SMA, crosses above the 30-day SMA exit. Sell when the 10-day SMA crosses back below the 30-day SMA. Risk management. Risk 1% of your trading capital per trade. Use a stop-loss set at 2% below your entry price. Position sizing. Calculate your position size so that if your stop-loss is hit, you only lose 1% of your account. Frequency. Check charts once daily, after the market closes. This system is simple, but powerful. It's based on trend following, a strategy used by professional traders for decades. The moving average crossover helps you identify when a stock is gaining momentum. By risking only 1% per trade and using a stop-loss, you protect your capital from big losses. Checking once a day means you don't have to watch the market all day. Perfect for the lazy trader lifestyle. Backtesting. Why it matters. Before you trade any system with real money, you want to know it has worked in the past. Backtesting means applying your rules to historical data and seeing how the system would have performed. Backtesting shows you how often the system signals trades, your win rate, average profit, and loss maximum drawdown, biggest losing streak. For our simple moving average crossover system, backtesting over 5 years on a popular ETF might show a win rate of 55%, an average gain of 2% per winning trade, and maximum drawdowns of 10%. These numbers tell you what to expect and help you prepare mentally. If you're not comfortable backtesting yourself, Many trading platforms offer automated tools, or you can keep a detailed journal and track trades manually. Building your routine. Around your system, one of the biggest benefits of a lazy trading system is that it can fit around your life, because the system is simple and rule-based. Your daily routine might look like this. At the end of the trading day, spend 10 to 15 minutes checking your charts. Apply your system rules. Look for moving average crossovers. Identify entries and exits. Set your stop losses and position sizes accordingly. Place orders and then step away. No stress, no constant screen watching, no emotional roller coaster. This routine becomes a habit, a stress-free habit. And over time, that habit compounds into profits. Dealing with drawdowns without panic. No system wins 100% of the time. Drawdowns, periods, when your account shrinks, are inevitable. The difference between a lazy trader and a gambler is how they handle drawdowns. Because you have rules, you know your maximum risk. Because you risk only a small percent per trade, you survive losing streaks without panic. This mindset allows you to stay calm and stick to your plan instead of chasing losses or abandoning your system. When drawdowns happen, remind yourself, this is normal. It's part of trading. Your system is still working. Your edge is still there. Adjusting. Your system. Over time. Lazy trading doesn't mean set it and forget it forever. Markets change. Conditions shift. What worked 5 years ago might not work as well today. But the key is small, thoughtful adjustments, not constant tinkering. Track your trades in a journal or spreadsheet. Review performance every 3 to 6 months. If you find your win rate dropping or losses increasing, it's time to review your system. Maybe your stop loss needs adjusting. Maybe you need to change markets, but only make changes based on data, not emotion. This keeps your system lean, effective, and lazy. The power of automation. Once you're comfortable with your system, consider automating parts of it. Many brokers and platforms allow you to set automatic entry and exit orders based on your rules. Automation helps remove emotion even further. It ensures your trades happen even if you're busy, traveling, or simply want to unplug. Automation truly makes trading lazy. It lets your system work for you. 24/7. Final thoughts. Your system, your freedom. Building a lazy trading system isn't about magic or luck. It's about designing a plan that fits your life, your goals, and your personality. It's about respecting the markets by trading with discipline and consistency. It's about giving yourself the freedom to live fully while your system quietly works in the background. Trading doesn't have to be a full-time job or a stress marathon. You can build a system that's simple, effective, and, most importantly, lazy. Because when your system trades so you don't have to, you win. Your time, your peace, your freedom, those are the real profits. And now, you have the blueprint to build it. Go ahead. Start simple. Start lazy. Trade smart. Trade easy. When not to trade. The secret skill that separates pros from gamblers. Every trader dreams of that perfect moment. The trade that brings big profits with minimal effort. But here's a little secret that's rarely talked about. Sometimes, the best trade you make is no trade at all. If you want to be a truly successful trader, especially a lazy trader who values simplicity and calm, you must master the art of knowing when not to trade. Because not trading is, in fact, a powerful trading decision. The lazy trader understands this deeply. It's not about chasing every opportunity or jumping into every signal you see. It's about patience, discipline, and protecting your capital and peace of mind. This chapter is going to teach you why sitting out can be your greatest edge, how to recognize those moments, and how doing nothing is sometimes your smartest move. Why knowing when not to trade matters. Imagine you're at a casino. Would you bet on every single spin or hand? Of course not. You'd wait for the odds to be in your favor, or simply walk away if the table looks bad. Trading is no different. Many beginners, and even some experienced traders, fall into the trap of feeling like they have to be in the market all the time. They chase every signal, hop onto every hype train, or try to make up losses by increasing trade frequency. This is the path to exhaustion, stress, and ultimately losses. Successful traders understand that the market is always there tomorrow. You don't have to force trades. In fact, forcing trades is the fastest way to lose. Trading when conditions are bad, when your mind isn't clear, or when your system says no, can wipe out months or years of progress in a heartbeat. When you learn to say no trade with confidence, you protect your capital and your mental health. The mindset shift, not trading, is a skill. Most people think that trading means buying or selling all the time. But trading also means waiting. Waiting for the right setups. Waiting for the right market, conditions. Waiting for your own mind to be clear and focused. Not trading takes patience, self-control, and courage. It's easy to get caught up in the hype, peer pressure, or the fear of missing out, FOMO. But the lazy trader knows better. They know that sitting on the sidelines is not weakness. It's strength. It's discipline, and it's often the best way to protect yourself from unnecessary losses. When to say no trade, recognizing low-quality setups. The first reason to avoid trading is simple. No good setup exists. Your system might be built to catch specific signals, say a moving average crossover or a certain price pattern. If those signals aren't there, it means the market isn't aligned with your edge. Trying to force a trade when your rules don't give a green light is like trying to drive a car without gas. It just won't go anywhere. This is where many traders fail. They see the price moving and think, well, I need to do something. But the best move is often to do nothing. Be patient. Wait for your system to tell you it's time. Your capital is precious. Don't risk it on random guesses or wishful thinking. This patience separates winners from losers. Avoid trading during low volume or uncertain market conditions. Another time to avoid trading is when the market lacks liquidity or volume. Low volume, days, holidays, or times when big players aren't active often mean erratic price movements and false signals. Imagine trying to catch a wave when the ocean is flat. It's just not worth it. Many lazy traders avoid trading right before big news releases or during weekends because the risk of sudden, unpredictable moves is too high. Understanding your market's rhythm helps you stay out when conditions are poor. Over time, you'll learn to recognize the days when it's better to watch than to trade. Managing your emotions. Don't trade. When you're not mentally red-eyed, trading is as much psychological as it is technical. If you're tired, angry, stressed, or distracted, your decisions will suffer. Making trades when your mind is foggy or emotional leads to impulsive moves and mistakes. The lazy trader respects their mental state. They know that a clear, calm mind is the best tool for trading. So if you're feeling overwhelmed or anxious, take a break. Walk away from your screens. Do something to reset your mind. Go for a walk, meditate, or simply rest. When you return fresh and focused, your trading will improve dramatically. How to build no-trade rules into your system. If you want to be a lazy trader, you need to build no-trade conditions into your plan. It's not enough to have entry and exit rules. You also need to define when you don't trade. This could include rules like don't trade during low volume days or holidays. Don't trade if your system's conditions aren't met exactly. Don't trade when a major news event is about to happen. Don't trade if you're emotionally unsettled. Having these rules written down helps you avoid emotional decisions. It creates structure and discipline. It makes no trade a conscious, powerful choice instead of a hesitation or fear. The power of taking breaks, resetting your trading mindset. Sometimes the best no-trade decision is a longer break. Maybe you had a losing streak. Maybe you're feeling burned out or doubting your system. Taking time off to step back and reset your mindset can save you from costly mistakes. Many professional traders take regular breaks between trading cycles. They use that time to review their journals, improve their skills, and recharge. If you feel frustrated or tired, don't be afraid to take a day, a week, or even longer off. Trading is a marathon, not a sprint. FOMO. The biggest enemy of lazy traders. Fear of missing out is one of the biggest challenges traders face. When you see a big move happening and you're not in, it's tempting to jump in last minute, but this usually leads to buying at the top or entering without proper setup. The lazy trader fights FOMO by trusting their system and waiting patiently for the next opportunity. Remember, there will always be another trade. Chasing after the market destroys discipline. Real-life stories, when not trading, saved the day. There are countless stories of traders who saved themselves by sitting out. One trader I know was tempted to trade right before a major Fed announcement. His gut told him to stay out, and he did. While he rested, the market moved wildly, triggering stops everywhere. When he returned, his account was intact, while many others lost big. Another lazy trader stuck to her system and refused to trade when she was feeling emotionally off. That day, the market went crazy in unpredictable ways. She avoided losses because she respected her mental state. These stories show that not trading is not missing out. It's protecting what matters most. Embrace no trade as part of your trading lifestyle. To be a successful lazy trader, you need to embrace the idea that sometimes the best trade is no trade. It's part of respecting the markets, respecting your capital, and respecting yourself. When you accept this, trading becomes less stressful and more enjoyable. It becomes a tool for freedom, not anxiety. You trade when conditions are right. You sit out when they're not. This balance will keep you in the game long term. Final thoughts. The lazy trader's greatest edge. The skill of knowing when not to trade is what separates the pros from the gamblers. It requires discipline, patience, and respect for the market. It protects your capital and sanity, and it gives you the freedom to trade on your terms. The lazy trader doesn't feel pressure to be active all the time. They wait, they watch, they trade only when it makes sense. This approach will save you money, time, and stress. So the next time you feel the urge to jump in without a clear reason, pause. Ask yourself, is this the right moment? Or is the best trade no trade? Master this question, and you'll master the Freedom Blueprint. Turn trading into a lifestyle, not a prison. When you first think about trading, you might imagine fast-paced screens, constant decision-making, and endless pressure to keep up. That image scares a lot of people away. They picture trading as a prison, trapped in front of their computer, anxious about every tick in the market, feeling like their life depends on every trade. But here's the truth that lazy traders embrace. Trading doesn't have to be that way. In fact, the whole point of lazy trading is to design a lifestyle that gives you freedom. Not just financial freedom, but freedom in your mind, your emotions, and your time. This final chapter is about building your personal freedom blueprint. creating a trading life that works for you, supports your goals, and lets you live fully, outside the charts. Because lazy trading is not about being lazy. It's about being smart, intentional, and free. Freedom is the ultimate goal. Think about why you wanted to trade in the first place. Most people start because they want more freedom. Freedom to work from anywhere. Freedom to control their time. Freedom from a boss or a 9-to-5 grind. Freedom to spend time with family and friends. Freedom to travel or just relax without worrying about money. If your trading life feels like a burden or prison, then you've lost sight of the goal. Trading should serve your life, not consume it. Lazy trading is all about designing your trading. Style around freedom. It's about working smarter, not harder. About using rules, routines, and habits to create space. Not fill every moment with noise and stress. The Freedom Blueprint is your personal plan for this life. Financial freedom is only the start. When most people hear freedom, they think financial freedom. Having enough money to pay bills, buy what they want, and not worry about income. That's important, no doubt. But money alone is not enough. You can be rich and still feel trapped by your trading routine, stressed by the markets, anxious about losses, overwhelmed by too many trades or hours staring at screens. True freedom includes mental and emotional peace. The lazy trader values this just as much as money. You want to feel calm, confident, and in control. You want your trading to enhance your life, not take it over. This mindset change is key to building a sustainable trading career. Time. Freedom. Trading on your terms. One of the biggest benefits of lazy trading is time. Freedom. Instead of being glued to your screens all day, you can design a schedule that fits your life. Maybe you trade just a few hours a day, or even a few days a week. Maybe you focus on setups that take less time to analyze. Maybe you automate parts of your trading or use alerts to reduce screen time. The point is, trading becomes a tool that works for you, not a task you have to slave over. When you free your time, you have more energy for the things you love. Family, hobbies, health, or learning new skills. You create balance instead of burnout. Emotional. Freedom. Master your mind trading will test your emotions. Fear, greed, frustration, and doubt can all sabotage your success if you let them. Lazy traders learn to manage these emotions so they don't control their decisions. Emotional freedom means having the confidence to stick to your plan, even when the market gets wild. It means accepting losses as part of the game, without panic. It means being able to walk away when you need a break, without guilt. This freedom comes from building strong habits and routines, keeping a trading journal, and practicing self-awareness. When your emotions are in check, your trading becomes smoother, less stressful, and more profitable. Designing your daily routine for freedom. How you organize your day has a huge impact on your freedom. Lazy traders build routines that make trading easy and efficient. For example, instead of checking the market every minute, you might review key levels once in the morning and once before close. You prepare your trades ahead of time and stick to your plan. You schedule breaks and downtime to reset your mind. You avoid distractions and create a calm workspace. These small habits add up to a lifestyle where trading fits around your life, not the other way around. Build systems, not hustle. Many traders believe success comes from hustling, doing more trades, more research, more hours. Lazy traders know better. They build systems that work automatically or with minimal effort. These systems include clear entry and exit, rules, risk management, and predefined no-trade conditions. Systems remove guesswork and emotional overload. They allow you to trade with confidence and consistency. The more you trust your system, the less you have to stress over each trade. That's freedom. Outsource and automate. You don't have to do everything yourself. Part of the freedom blueprint is learning to outsource or automate parts of your trading life. Maybe you use trading, bots, or alerts to watch for setups. Maybe you hire a coach or join a community to share ideas and support. Maybe you use software to track your trades and analyze your performance. Technology and teamwork can save you time and mental energy. They let you focus on what you do best. Money management for freedom, one of the biggest killers of trading. Freedom is risking too much. If every trade can wipe out your account, you'll live in fear and stress. Lazy traders know that protecting capital is the foundation of freedom. They use smart position sizing, stop losses, and diversification to manage risk. When you protect your capital, you protect your freedom too. Keep trading another day. You trade without fear because you know your losses are controlled. Freedom to learn and grow. Trading is a journey, not a destination. Lazy traders see every trade as a lesson. They embrace growth and learning as part of their freedom. They keep journals, review mistakes, and constantly improve. This mindset keeps trading fresh and exciting, not stale or frustrating. Don't need to be perfect, just better than yesterday. This mindset frees you from the pressure to be right all the time. Freedom means saying, no part of your blueprint is learning to say no to trades, distractions, bad advice, or your own impulses. Saying no is a powerful act of freedom. It means you control your trading, not the other way around. You trade your way on your terms. This discipline is the hallmark of lazy traders. Living the lazy trader life. At the end of the day, lazy trading is about designing a life you don't want to escape from. It's about trading in a way that supports your values, your family, and your dreams. It's about turning trading into a tool that helps you live fully, not a task that drains. When you master the freedom blueprint, you have more than money. You have peace, balance, and happiness. You've turned trading into a lifestyle, not a prison. Lazy trading is your pathway to freedom. Not just the freedom to make money, but the freedom to live your life fully, on your terms. This chapter isn't just a conclusion. It's your invitation to design your trading life, to build your blueprint for freedom, to trade less, live more, and be truly free. If you want to, go deeper. Remember that the journey doesn't stop here. Every day, choose freedom, trade smart, trade lazy, live free.
Imagine being able to transform every conversation, every relationship, and every opportunity just by mastering your emotions. This audiobook gives you the tools to unlock emotional intelligence and sharpen your social skills so you can connect deeply, communicate clearly, and succeed effortlessly. Start your journey now. Introduction. Let me ask you a question. Have you ever walked into a room and instantly felt the energy shift? Maybe someone was silently upset and no one had to say a word, you just knew. Or maybe you've met someone who seemed to have this effortless ability to connect, communicate, and make everyone around them feel comfortable and heard. What is it that makes these people different? It's not just talent, good looks, or even intelligence in the traditional sense. It's emotional intelligence. And combined with sharp social skills, it's a superpower. The real secret to success in today's world, having a high IQ or being book smart, simply isn't enough. The people who rise to the top, whether in their careers, relationships, or personal happiness, have something more. They know how to manage their own emotions. They know how to read others. They can connect with people on a deeper level. They're calm under pressure, adaptable, and emotionally resilient. That's what this audiobook is all about. Mastering emotional intelligence and social skills so you can unlock your full potential and thrive in every area of life. What you'll learn in the chapters ahead, you're going to discover the practical, science-backed tools that emotionally intelligent people use every day, often without realizing it. But here's the best part. These are learnable skills. You don't have to be born with them. You can develop and master them with the right mindset and daily habits. Here's a quick preview of what you're about to dive into. We'll start by breaking down what emotional intelligence really means, not just the buzzwords, but the core elements that drive it. Then we'll explore the science behind it, why your brain reacts the way it does in emotional situations, and how to train it to work for you, not against you. You'll learn how to recognize your emotions, manage them in real time, and build genuine empathy for others. We'll decode body language and social cues so you can walk into any room with confidence. You'll discover how to speak in a way that makes people want to listen, and how to listen in a way that makes others feel truly heard. We'll cover social confidence, building deeper relationships, navigating tough conversations, and even how to use these skills in your career or business. By the end, you won't just understand emotional intelligence, you'll live it. Why this matters more than ever. Let's face it, our world is more connected than ever. Yet people feel lonelier, more misunderstood, and more emotionally overwhelmed than at any other point in history. Why? Because technology might connect us, but emotional intelligence is what binds us. It's what allows us to build trust, resolve conflicts, and create meaningful relationships, whether that's in a Zoom meeting or a face-to-face conversation. In a noisy world, being emotionally intelligent is like being fluent in a language most people have forgotten how to speak. What this book is. Not before we dive in, I want to be clear. This isn't some dry academic lecture filled with theory and fluff. You won't find pages of jargon or meaningless statistics. This is real, raw, and applicable. Every strategy you'll hear is something you can start practicing today. No matter where you're starting from, whether you're shy, socially anxious, emotionally reactive, or just curious, this book will meet you where you are and take you, step by step, toward real transformation. Who this is, for this audiobook, is for you if you want to feel more in control of your emotions and reactions. You want to connect with people more deeply and authentically. You want to improve your communication, both in personal and professional settings. You're tired of second-guessing yourself in social situations. Or maybe you just want to level up your people skills and become the kind of person others naturally gravitate toward. If any of that sounds like you, you're in the right place. A word of encouragement. Let me say this right now. If you've ever felt like you're just not good with people, or that emotions are hard to understand or express, I want you to know, that's not your fault. Most of us were never taught these skills. We learned math, science, and grammar in school. But no one showed us how to calm ourselves down when we're angry, how to set boundaries without guilt, or how to truly listen when someone is hurting. This audiobook is the education you should have gotten. And I promise, by the time you finish, you'll be equipped with the tools, confidence, and understanding to navigate life with emotional mastery. How to get the most out of this audiobook. Here's how I recommend using this. Audiobook. Listen with intention. Treat it like a conversation. Pause, reflect, and let the ideas sink in. Take notes. Jot down insights or strategies that speak to you. Even one idea could change the way you think or act. Practice one thing at a time. You don't need to master everything overnight. Choose one skill or technique per chapter and start applying it in your daily life. Revisit as needed. Come back to the chapters that resonate most when you need a refresher. Repetition builds mastery. The journey ahead. You're about to go on a journey that could dramatically upgrade your life, not by changing who you are, but by unlocking the full power of who you've always had the potential to become. You already have the spark inside you. This audiobook is just the fuel. So let's get started. Let's master emotional intelligence. Let's build the social skills that open doors, build bridges, and change lives. Because when you get your emotions right, everything else starts to fall into place. Chapter 1. The science behind emotional intelligence. Let's get scientific, but keep it simple. Before we dive into the how-to of mastering emotional intelligence, we need to answer a big question. What exactly is emotional intelligence? And how does it really work in your brain and body? Don't worry, we're not going to get lost in technical jargon or brain scans. But it's important to understand the science behind emotional intelligence. Because once you know what's happening inside you, chemically, neurologically, and psychologically, it becomes easier to take control of your reactions and reshape how you think, feel, and act. So let's break it down. What is emotional intelligence? Emotional intelligence, often called EQ or emotional quotient, is your ability to recognize, understand, manage, and influence your emotions and the emotions of others. It's made up of 5 core components: self-awareness, knowing what you're feeling and why; self-regulation, managing your emotions in healthy ways; motivation, using emotions to fuel positive actions; empathy, understanding the feelings of others; social skills, navigating relationships and interactions effectively. Think of EQ as your internal GPS. It helps you navigate tough conversations, make smart decisions under pressure, and build relationships that actually work. And here's the cool part: EQ isn't fixed. Unlike your IQ, which tends to stay relatively stable throughout your life, your emotional intelligence can grow as much as you're willing to work on it. The emotional brain, meet your limbic system. Let's get into your brain for a moment. Inside your head is a small but powerful part called the limbic system, and it's the emotional command center of your body. This system includes structures like the amygdala, which is like your emotional alarm system, and the hippocampus, which helps store emotional memories. When something happens around you, someone cuts you off in traffic, your boss criticizes you, or a friend gives you a compliment, your brain's first response comes from the amygdala. It asks, is this a threat or a reward? If it senses danger or emotional stress, it triggers the classic fight, flight, or freeze response. Your heart races, your palms sweat, your breathing changes. This is your biology in action, getting you ready to react. But here's where emotional intelligence comes in. The prefrontal cortex, the thinking, rational part of your brain, can step in and help you respond instead of just react. EQ is the ability to pause, evaluate the situation, and choose how you respond. It's the difference between snapping at someone and taking a breath, between sending that angry text or thinking twice, between letting fear hold you back or channeling it into courage. The amygdala, hijack. When emotions take over. Have you ever lost your temper and thought, that wasn't me, I don't know what came over me? That's called an amygdala hijack, when your emotional brain overrides your rational brain. It happens in a split second. Your amygdala sounds the alarm before your prefrontal cortex has time to process. In that moment, your body is flooded with stress hormones like adrenaline and cortisol, preparing you to react rather than think. But here's the good news. You can train your brain to pause, reflect, and rewire your automatic responses. Through mindfulness, breathing techniques, and the self-awareness exercises we'll cover later in this audiobook, you can give your rational brain the space it needs to step in before the emotional storm hits. That's the science behind emotional regulation. And it's one of the most powerful EQ skills you can build. Mirror neurons and empathy. Let's talk about empathy, which is another pillar of emotional intelligence. Have you ever yawned after seeing someone else yawn? Or felt emotional watching someone cry, even in a movie? That's the work of mirror neurons, specialized cells in your brain that help you understand and feel what others are experiencing. They create an internal simulation of someone else's emotion. When your EQ is high, these mirror neurons are especially active. You become more attuned to subtle cues, like changes in someone's tone, body language, or facial expression. That's why emotionally intelligent people are often called intuitive. It's not magic, it's neurology. And just like a muscle, your empathy can grow stronger the more you exercise it. The role of neuroplasticity. One of the most exciting discoveries in neuroscience is neuroplasticity, the brain's ability to change and rewire itself based on your thoughts, actions, and experiences. What does this mean for you? It means emotional intelligence isn't just a personality trait, it's a skill set you can develop with intention. Every time you practice staying calm during stress, every time you choose curiosity over judgment, every time you listen deeply to someone else's story, you are physically rewiring your brain to become more emotionally intelligent. It's like working out. The more reps you put in, the stronger your emotional muscles become. The link between EQ and success. Now let's get practical. Why does emotional intelligence matter in real life? Studies have shown that EQ is a stronger predictor of long-term success than IQ. In fact, people with high EQ earn more money on average. They are more likely to be promoted and trusted in leadership roles. They build stronger relationships, experience less stress, and enjoy higher life satisfaction. In one famous study by Daniel Goleman, author of Emotional Intelligence, it was found that up to 90% of the difference between top performers and average ones in leadership roles came down to EQ, not IQ or technical skills. This applies in relationships too. People with high EQs are better at resolving conflicts, expressing love and appreciation, and supporting those around them. So whether you're building a business, managing a team, raising a family, or trying to deepen your friendships, emotional intelligence is your secret weapon. Emotions are data. Here's one more powerful concept to remember. Emotions are not the enemy. They're data. They're signals that tell you what's happening beneath the surface. Anxiety might be telling you that something important is at stake. Anger could be revealing a boundary that's been crossed. Sadness might be inviting you to reflect or release something. When you view emotions as information instead of problems, you can learn from them instead of fearing or suppressing them. That's what emotional intelligence teaches us: to decode the message behind the emotion and to respond with wisdom instead of impulse. Practical exercise, emotional audit. Let's end this chapter with a simple but powerful exercise. Over the next 24 hours, do an emotional audit. Here's how. Every few hours, pause and ask yourself, what emotion am I feeling right now? What might have triggered it? How is my body reacting? Tense shoulders, racing heart, etc. What do I want to do about this emotion? What would be a thoughtful response instead? Keep a journal or use a notes app on your phone. Just 1 or 2 sentences per check-in is enough. This practice builds the bridge between your emotional and rational brain. It helps you start noticing patterns, and it gives you the space to choose how you respond instead of letting emotions control the show. Final thoughts for this chapter. You don't have to be a neuroscientist to understand emotional intelligence, but understanding the science behind it empowers you to take charge of your inner world. When you learn how your brain processes emotions, when you start seeing emotions as signals, not enemies, and when you realize that empathy and connection are wired into your biology, you step into a whole new level of personal power. Emotional intelligence is not just a nice-to-have. It's the foundation for everything meaningful, from confidence to communication to connection. And now that you understand how it works behind the scenes, you're ready for the next step. Chapter 2. Self-awareness, recognizing your emotions, the foundation of all emotional intelligence. Let's get straight to the point. You can't control what you don't recognize. And when it comes to emotions, self-awareness is the key that unlocks everything. Think of emotional intelligence like a house. If that's true, then self-awareness is the foundation. Without it, everything else, emotional control, empathy, social skills, starts to crack and collapse. What is self-awareness? Self-awareness is your ability to observe your own thoughts, emotions, and behaviors in real time. It's like being able to zoom out and watch yourself from the outside. Here's the big shift. Instead of being trapped inside the emotion, you notice it. You name it. You ask, what am I feeling right now? And why? Sounds simple? It is. But it's not always easy, especially in moments of stress, anger, or emotional overload. Why most people stay emotionally blind? Let's be honest. Most people are emotionally reactive. They're like leaves in the wind, tossed around by every feeling without understanding where those feelings come from. Why? Because nobody ever taught us to slow down and ask deeper questions. We were told, don't cry, stop being angry, just get over it. But here's what emotionally intelligent people do differently. They ask themselves, what is this emotion trying to tell me? That one question can change your entire life. The power of naming emotions, one of the most powerful tools in emotional intelligence, is labeling your emotions. It may sound basic, but studies show that just naming what you're feeling reduces the intensity of that emotion. This is called affect labeling, and it's backed by neuroscience. Instead of saying, I feel bad, try, I feel disappointed. Instead of, I'm just stressed, say, I feel overwhelmed because I'm afraid I won't meet this deadline. Instead of, I'm mad, say, I feel frustrated because my boundaries were ignored. The more specific your emotional vocabulary, the more clarity you gain, and with clarity comes control. Emotional triggers. Know them or be controlled by them. Everyone has emotional triggers, things that instantly set off strong reactions. Could be being ignored, feeling disrespected, being interrupted, feeling judged or misunderstood, being compared to someone else. These aren't random. They usually tie back to past experiences, core beliefs, or unmet emotional needs. Self-awareness means identifying your personal triggers so you're not blindsided by them. Next time you feel an intense emotional reaction, ask, what just happened? What did it make me believe about myself? Where have I felt this before? This gives you the chance to break free from autopilot reactions and choose a different response. Body signals. Your emotions talk through your body. Your body often knows how you feel before your mind catches up. Tight shoulders, shallow breathing, a racing heart, clenched fists. These are signs your body is processing something. When you learn to tune into your physical sensations, you get access to your emotions early, before they boil over. Try this quick body scan. Close your eyes and take a slow breath. Ask, where do I feel tension right now? Name the sensation. I feel pressure in my chest, or my stomach feels tight. Ask, what emotion might be causing this? This practice helps you connect with your emotions before they overwhelm you. Journaling for self-awareness. One of the best ways to build emotional self-awareness is through daily journaling. No, it doesn't have to be pages and pages. Just a few minutes a day can shift your mindset and mood. Try this journal prompt. What emotion did I feel most strongly today? What triggered it? How did I respond? What would I do differently next time? Over time, journaling reveals patterns, emotional loops, recurring triggers, and how your responses evolve. It's like having a mirror for your inner world. The stories. We tell ourselves, your emotions are not just about what happens to you, but how you interpret what happens. For example, someone cancels on you, you feel rejected. The story, they don't care about me. You make a mistake at work. You feel anxious. The story, I'm not good enough. Emotionally intelligent people challenge those stories. They ask, is this story true? Is there another way to see this? Am I taking this personally when it might not be about me? This mental shift from reaction to reflection is what separates high EQ individuals from the rest. Emotional check-ins, your daily practice. Here's a practical tool you can use daily, an emotional check-in. Once or twice a day, pause and ask, what am I feeling right now? What triggered this emotion? How is it affecting my thoughts and actions? What do I need right now? Comfort, clarity, movement, silence. You can do this in the car, on a walk, or during a break at work. These micro moments of reflection build the habit of emotional awareness without overwhelm. The power of pause. In emotionally charged situations, the difference between regret and wisdom is one thing: the pause. Before sending that angry message, before saying something you'll regret, before reacting, just pause. Take one breath. Give your brain a second to catch up. Ask yourself, what emotion am I feeling right now? And what would my highest self do next? That one pause can save relationships, careers, and your own peace of mind. Final thoughts for this chapter: self-awareness isn't about perfection. It's about attention. It's about tuning in instead of tuning out. It's about listening to your emotional signals and decoding what they're trying to say. It's about being honest with yourself, not judgmental, just honest. The more you practice self-awareness, the more empowered you become. You stop being a prisoner of your emotions and start becoming the master of them. You'll feel more in control, more grounded, more confident, and most importantly, you'll start building the emotional intelligence that transforms every part of your life. Chapter 3: Managing Emotions in Difficult Situations. Life happens. Emotions happen. What now? Here's the truth. Everyone gets emotional. Even the calmest, most grounded person you know has bad days, feels triggered, or gets overwhelmed. The difference between those who fall apart and those who stay in control isn't whether or not they feel emotions, it's how they handle those emotions. This chapter is about just that, managing your emotions when life gets messy. Because let's be real, it's easy to be emotionally intelligent when everything's going well. The real test is when someone cuts you off in traffic, your partner says something hurtful, or you get that sinking feeling of anxiety before a big moment. That's when emotional mastery counts most. Emotions are energy. Let's start with a powerful perspective. Emotions are energy in motion. They move through your body. They rise and fall like waves. They are meant to be felt, acknowledged, and then released. But here's what most people do. They suppress emotions, or they explode with emotions, or they try to escape emotions through food, social media, scrolling, or distractions. Managing emotions isn't about ignoring or controlling them like a robot. It's about feeling them fully, but not letting them control your actions. You can feel anger without yelling. You can feel sadness without shutting down. You can feel anxiety and still show up and do the thing anyway. The emotional thermostat versus thermometer. Here's a mental model to help you. Imagine a thermometer. It just reacts to whatever's happening in the environment. If it's hot, it goes up. If it's cold, it drops. No control, just reaction. Now imagine a thermostat. It senses the temperature, but then sets the tone. It regulates the environment. It takes responsibility for the atmosphere. Most people are emotional thermometers. They reflect the energy around them. But emotionally intelligent people are thermostats. They feel what's happening and then choose how they want to respond. Which one are you becoming? Step 1, name the emotion. This is always the first step. Why? Because you can't manage what you don't name. Let's say you're in a meeting and someone cuts you off mid-sentence. Your chest tightens, your jaw clenches, you feel a rush of heat. What do? You pause and mentally name it. I'm feeling disrespected. I'm feeling frustrated. This small moment creates space between you and the emotion. And in that space, you get your power back. Step 2. Breathe to reset. This may sound cliché, but it works. Your breath is your remote control for your nervous system. When emotions spike, your body goes into fight or flight. Heart races, muscles tense, vision narrows. But deep, intentional breathing tells your brain, we're okay. You're safe. Try this simple breathing pattern. Inhale for 4 seconds. Hold for 4 seconds. Exhale for 4 seconds. Repeat 3 to 5 times. This calms the amygdala, your emotional alarm system, and reactivates the rational brain. It's not magic. It's biology. Step 3. Ask better questions. Your brain is always answering questions, even when you're not aware of them. Low EQ people ask, why does this always happen to me? What's wrong with me? Why are people so difficult? High EQ people ask, what am I feeling and what triggered it? What's really going on here beneath the surface? How can I respond in a way I'll be proud of? Later, when you ask better questions, you get better answers and better actions. Step 4. Choose a response, not a reaction. This is the moment that defines emotional maturity. A reaction is automatic. It's your survival brain lashing out or shutting down. A response is thoughtful. It comes from clarity and strength. Let's go back to the meeting example. You were cut off. You're frustrated. You've taken a breath and asked yourself, what's really going on? Now you get to respond. That might look like staying calm and bringing your point back up with confidence, addressing the interruption later in private, letting it go if it wasn't worth the energy. The key is, you chose. Not your ego, not your emotion, you. The 90-second rule. Did you know that most emotional reactions last only 90 seconds unless you feed them? That's right. According to neuroscientist Dr. Jill Bolt-Taylor, when an emotion is triggered, there's a 90-second chemical process in the body. After that, it's up to us to keep replaying the story or to let it pass. So next time you feel anger, sadness, or anxiety rising, remind yourself, this will pass. I just need to ride the wave. Take the 90 seconds. Breathe. Stay still. Don't react yet. That's emotional self-control in action. Reframing. Change the meaning. Change the emotion. Emotion often comes from interpretation, not just the event itself. Let's say someone doesn't respond to your message. You could interpret that as, they're ignoring me. Emotion, hurt. They don't care about me. Emotion, anger. Maybe they're busy. Emotion, understanding. Same event, different meaning, totally different emotional experience. Emotionally intelligent people are masters of reframing. They challenge their assumptions. They look for alternative explanations. They stay curious instead of jumping to conclusions. How to handle emotional overload. Sometimes the emotion is just too much. You feel overwhelmed. You want to cry or scream or shut down. That's okay. Here's a quick emotional reset routine. Remove yourself from the environment if you can. Move your body. Go for a walk, stretch, do push-ups, shake it out. Express the emotion. Write it out. Talk to someone. Or cry if needed. Refocus your mind. Listen to calming music. Read something inspiring. Or visualize a peaceful place. The goal isn't to fix the feeling. It's to ground yourself so you can get back to clarity. Real-life scenarios. Let's apply this to a few situations. You're stuck in traffic, running late. Old you freaks out, curses, feels helpless. New you notices the stress, breathes, accepts what's out of your control, uses the time to listen to a podcast or reflect. Your friend cancels plans last minute. Old you feels rejected, assumes they don't care. New you feels disappointed, but asks for clarification, chooses to respond with kindness or set a boundary if needed. You make a mistake at work. Old you panics, feels like a failure. New you acknowledges the mistake, feels the sting, but reminds yourself that mistakes are part of growth and takes action to fix it. This is how emotional strength is built, moment by moment. Final thoughts for this chapter. You don't need to be perfect. You just need to be present. Managing your emotions isn't about suppressing them. It's about owning them. When you learn to ride the wave of emotion without being swept away, you become unshakable. You stay calm in chaos. You think clearly under pressure. You respond from wisdom, not impulse. That's what emotional intelligence is all about. And the best part? Every challenge becomes a training ground. Every tough moment becomes an opportunity to strengthen your emotional muscle. Chapter 4. Building empathy for stronger relationships. Why empathy changes everything. Let's be honest. Everyone wants to feel seen, heard, and understood. Whether it's your partner, a friend, a coworker, or even a stranger on the street, the deepest human craving is connection. And the secret ingredient? Empathy. Empathy is more than just being nice. It's the ability to step into someone else's emotional shoes, to feel what they're feeling without losing yourself in the process. In a world full of distractions, misunderstandings, and surface-level interactions, empathy is what turns relationships from transactional to transformational. The two types of empathy to master empathy. It's important to understand its two main forms. Emotional empathy, feeling with someone. When your friend is grieving and you feel that lump in your throat, that's emotional empathy. It's immediate, it's visceral. It's like your heart is tuned to theirs. Cognitive empathy, understanding someone's perspective. You might not feel their emotion, but you get it. You see where they're coming from, even if you disagree. This is especially useful in conflict or professional settings. The best communicators, they blend both. They feel with you and they understand you, sympathy versus empathy. There's a big difference. Let's clear this up once and for all. Sympathy is when you say, I feel bad for you. Empathy says, I feel this with you. Sympathy stands at a distance. It's pity. Empathy moves closer. It's connection. Imagine a friend has just lost a job. Sympathy says, oh, that sucks. Hope it works out. Empathy says, that must be really hard. I know how scary that uncertainty can feel. I'm here with you. See the difference? One creates distance. The other builds trust. The three-step empathy formula. If you want a simple way to practice empathy in real conversations, here it is. Listen to understand, not respond. This means you're not thinking about your reply. You're not judging. You're not interrupting. You're fully present. Eye contact, nods, silence when needed. Name what you notice. That sounds frustrating. You seem really overwhelmed. I hear a lot of sadness in what you're saying. Validate the emotion. It makes sense you'd feel that way. Anyone in your shoes would be feeling that too. You're not crazy for feeling this. It's human. Validation doesn't mean agreement. It means acknowledgement, and acknowledgement is healing. Common blocks to empathy. Let's be real. Sometimes empathy is hard. Here are a few things that get in the way. Judgment. Why are they overreacting? Comparison. That's nothing compared to what I've been through. Advice giving. Here's what you should do. Before they even finish talking. Distraction. Checking your phone mid-conversation. Emotional overload. Feeling too much and shutting down. Awareness is the first step. Once you know your empathy blockers, you can catch them in the moment and choose a better way. Empathy starts with self-awareness. Remember chapters 2 and 3. They weren't just about you. They were training grounds for empathy, because when you understand and manage your own emotions, you're much better equipped to hold space for someone else's. Emotionally unaware, people struggle with empathy. Why? Because they can't tell where their feelings end and the other person's begin, or they get uncomfortable and want to fix it too fast. Empathy isn't about fixing, it's about feeling with and sitting beside. Empathy in action, real-life examples. Let's walk through a few everyday moments and how empathy can shift everything. Example. First, your partner comes home stressed and snaps at you. Old reaction. Why are you taking this out on me? Empathic response. You seem really stressed, want to talk about it or just need space. Example 2. A friend cancels last minute for the 3rd time. Old reaction. Wow, you're so flaky. Empathic response. Hey, I'm feeling a little let down. Is everything okay on your end? Example 3. A coworker messes up a project and blames others. Old reaction. What a coward. Empathic response. It looks like you're feeling pressured. Want to brainstorm how to fix this together? Notice what changed. Empathy softens conflict. It opens doors. It builds bridges. Mirror neurons and the brain science of empathy. Here's where it gets cool. Your brain is wired for empathy. Inside your brain are special cells called mirror neurons. When you see someone smile or cry or wince in pain, your brain literally mirrors that emotion. This is why you tear up during emotional movie scenes. You cringe when someone gets hurt. You feel warm when someone hugs you. Empathy isn't just emotional, it's biological. But like any muscle, it strengthens with use. Building empathy in relationships. Here's how to cultivate empathy with the people who matter most. Ask better questions. What's been on your mind lately? How are you really feeling? About that? What do you need from me right now? Practice active listening. Reflect what you hear. So what I'm hearing is, ask clarifying questions. Avoid interrupting or jumping to conclusions. Stay curious, not critical. Instead of, you're being too sensitive, try, help me understand what made you feel that way. Remember, everyone has a backstory. That rude person at the store. Maybe they just lost someone. That angry coworker. Maybe they feel invisible. That cold friend. Maybe they're battling depression. Empathy lets you see the human behind the behavior. When empathy feels draining, yes. Empathy can be exhausting if you don't have boundaries. You're not meant to carry everyone's pain. You're meant to connect with it, not absorb it. If you find yourself overwhelmed, set limits. It's okay to say, I want to support you, but I need a short break to recharge. Detach with love. You can care deeply and still protect your peace. Refill your own emotional tank through rest, nature, movement, or silence. Empathy is a gift, but it starts with giving some to yourself first. Final thoughts for this chapter. Empathy is the skill that makes you unforgettable. It turns average listeners into trusted friends. It turns surface relationships into deep bonds. And it turns good leaders into great ones. When you practice empathy, you're telling people, you matter. Your pain is valid. You're not alone. That one simple message, it can heal relationships. It can change lives. And sometimes, it can even save them. You don't have to be perfect. You just have to be present. Chapter 5, Social Skills, Hundon 1. Understanding social cues, why social skills matter more than ever. Here's the deal. You could be brilliant. You could have the best ideas. But if you can't connect with people, read a room, sense the vibe, respond appropriately, your growth will stall in personal life, in professional life, everywhere. Social skills are emotional intelligence in action. They're the tools that help you build trust, navigate relationships, and avoid awkward missteps. And it all starts with understanding one thing. Most communication is nonverbal. That's right. What you say is only a small part of the message. How you say it, and how you read what others aren't saying, is what really counts. This chapter will show you how to read social cues like a pro, so you can show up with confidence, connection, and clarity in any situation. What are social cues? Social cues are the silent signals we send through body language, facial expressions, tone of voice, posture, timing, and more. They help us answer questions like, is this person comfortable or uncomfortable? Are they open to talking or not? Did my comment land well, or do I need to shift the tone? Are we connecting, or is something off? Mastering social cues is like learning to speak a second language, a language without words. The Big Five, social cues to watch for. Let's break down the main categories of social signals. Facial expressions. The face is a mirror of emotion. Even micro-expressions, those split-second flashes of emotion, reveal the truth. Raised eyebrows, surprise or skepticism, smiling with eyes, genuine warmth, tight lips or clenched jaw, tension or stress, furrowed brow, confusion or concern pro. Tip: watch the eyes. They often tell the story more than the mouth does. Body language: the way someone holds themselves says a lot. Open posture, eyes confidence, receptivity. Closed arms, eyes defensiveness or discomfort. Leaning in, interest. Turning away or stepping back. Disinterest or desire to escape. Notice posture shifts. They often signal changing emotional states. Tone: a voice, it's not just what you say, it's how you say it. A soft tone can signal calm or submission. A sharp tone can feel like a threat. Fast talking might indicate anxiety. A warm, even tone builds trust. Tip: listen to tone changes mid-conversation. That's where hidden emotions often surface. Timing and turn-taking social rhythm matters. Is the person interrupting or waiting their turn? Are they speaking too long without noticing others? Are they giving others a chance to respond? People with strong social skills know when to speak, when to pause, and when to let silence do the work. Personal space: everyone has an invisible bubble, and invading it sends strong signals. Too close, threatening or overly intense. Too far, ajar, disinterest, or coldness, just right. Comfort and mutual respect. Cultural norms vary, so be observant and adjust accordingly. How to read the room. Here's a quick method to instantly assess a social environment. The vibe scan. Visuals. What? Are people's body language and facial expressions saying? Intensity. Is the energy calm, tense, upbeat, or awkward? Behavior. Are people engaged, distracted, comfortable? Energy. Is the group dynamic positive or negative? You don't have to get it perfect. Just pay attention. Social awareness isn't about being psychic. It's about being present. Social intelligence. Pattern recognition. Ever wonder how some people just get the mood of a room? They've trained themselves to recognize patterns. What happens when someone brings up a certain topic? How does the group respond when someone jokes? Who dominates the conversation? Who holds back? They're watching, listening, adjusting. This isn't manipulation, it's mindfulness. It's about honoring the emotional and social flow of the group. Common social missteps and how to avoid them. Even smart, well-meaning people sometimes miss social cues. Here are a few examples. Talking too much about yourself. Fix: ask more questions. Balance the airtime. Missing signs of boredom or discomfort. Fix: watch for fidgeting, looking away, short answers. Being too intense too fast. Fix: let connection build. Don't trauma dump or overshare immediately. Ignoring group dynamics. Fix: read the room before making bold moves. Not adapting your tone or energy. Fix: mirror the other person's vibe, then lead with your best self. Remember, social skills are not about being perfect. They're about being aware and adaptable. How to improve your social awareness. Ready to level up your social reading skills. Try these strategies. Play emotion detective. In conversations, silently guess what the other person is feeling. Then check your accuracy by asking questions like, "You seem unsure. Am I picking that up right?" Watch people in-house. Public observe body language and interactions at cafes, parks, or events. What patterns do you see? What energy is being exchanged? Record yourself practice conversations on video. Watch your facial expressions, posture, and tone. You'll learn a lot about how others perceive you. Mirror, subtly. Subtle mirroring builds rapport. If someone is calm and reserved, match that energy. If they're warm and enthusiastic, reflect it back. Just don't overdo it. It has to feel natural. Ask for feedback from trusted friends or mentors. Ask, how do I come across in conversations? Be open. This is gold, from awkward to awesome. Social skill growth stories. Let's bring this home with a few transformation examples. Jade used to interrupt people constantly. She didn't mean to. She was just excited. After learning about turn-taking and observing group dynamics, she slowed down, became a better listener, and now people seek her out for conversations. Mike often made jokes at the wrong time and never understood why people pulled away. After learning to read facial expressions and energy shifts, he became more tactful, and his relationships deepened. Sarah felt invisible in groups. After watching body language, asking questions, and using eye contact, she found herself being included more and feeling seen. You can grow too. It just takes practice, observation, and intention. Final thoughts for this chapter: social cues are the signals that guide every interaction. When you learn to read them, you unlock the unspoken code of connection. You start sensing when to speak up and when to listen, when to push and when to pause, when someone needs space and when they need support. And most importantly, you become the kind of person others feel safe around, seen around, connected to. That's the heart of emotional intelligence in action. Chapter 6. How to improve communication in every situation. Communication is everything. Think about this. Every relationship you have, personal, professional, or even with yourself, depends on one thing: communication. When it's clear, respectful, and emotionally intelligent, things flow. When it's confusing, reactive, or unclear, conflict, distance, and frustration show up. Here's the truth. Communication is not just about talking. It's about connecting. This chapter will show you how to become the kind of communicator who doesn't just get heard, but actually understood. Someone who brings calm, clarity, and connection into every conversation. What makes communication truly effective? Effective communication has three major components. Clarity, you're saying what you mean without confusion or fluff. Tone, your emotional energy matches your message. Timing, you're delivering your words in the right moment, not just dumping them on people. If you can align all three, you become magnetic. People want to talk to you because it feels easy and safe. The 4 pillars of great communication. Let's dive into 4 essential pillars that will improve the way you communicate in any situation. Listening. First, talking second. This is where most people go wrong. They're focused on their response, not the other person's message. Active listening means giving your full attention. Yes, that means putting down your phone. Nodding or giving verbal cues like, I see, go on, or that makes sense, reflecting back what you heard. So what you're saying is, and here's a powerful truth, people don't open up when they feel heard. They open up when they feel understood. Choosing your words. Wisely, words are powerful. They can calm a storm or start one, build trust or break it, open hearts or shut them down. Here's how to use words that connect. Use I statements. Instead of blame, I felt left out. Instead of you ignored me. Avoid absolutes. Words like always and never create defensiveness. You always forget versus I noticed you forgot this time. Be direct and kind. Truth without empathy feels harsh. Empathy without truth feels vague. You need both. Mastering tone and body language, remember. How you say it often matters more than what you say. Your words might say, I'm fine, but your tone, crossed arms and distant eyes say, I'm definitely not fine. Align your nonverbal communication with your message. Keep your tone warm and steady. Maintain appropriate eye contact. Open your posture, no folded arms. Nod to show understanding and attentiveness. People don't just listen with their ears. They listen with their emotions, knowing when to speak and when not to. Some conversations need courage. Others need quiet. Ask yourself, is this the right moment for this message? Is the other person emotionally available to hear it? Am I speaking to be helpful or just to be heard? Sometimes the most powerful communication is silence with presence. Communication styles. Which one are you? There are 4 basic communication styles. Understanding yours and others can change everything. Passive avoids conflict, struggles to express needs. Often says yes when they mean no. Hidden belief. My needs don't matter. Aggressive, dominates conversations, interrupts. Criticizes or controls, uses tone to intimidate hidden belief. Only my needs matter. Passive-aggressive appears agreeable, but expresses anger indirectly. Sarcasm, backhanded comments, silent treatment. Hidden belief. I won't. Say it, but I'll make you feel it. 4. Assertive, honest, direct, and respectful. Speaks clearly about needs and boundaries. Listens with empathy. Healthy belief. My needs matter, and so do yours. Your goal. Move toward assertive communication. That's where connection and confidence live. How to handle difficult conversations. Let's face it, some conversations are hard, but with the right tools, they don't have to become hurtful. Here's a proven formula you can use. The CARE framework. C. Calm down first. Never communicate in the heat of emotional chaos. A. Acknowledge the emotion. I know this is uncomfortable, and I really want to talk it through. R. Respect their perspective. I see how this impacted you, even if I experienced it differently. E. Express your truth clearly. Here's what I felt, and what I'd love going forward. This method helps people feel safe, even when the topic is hard. Communication traps to avoid. Let's go over a few common mistakes that sabotage good communication. Interrupting. It sends the message, what I have to say is more important than what you're saying. Fixing too soon. Sometimes people don't want solutions. They want to feel heard first. Assuming instead of asking, ask for clarification before drawing conclusions. Using sarcasm or jokes to deflect. Humor is great, but not when it hides real emotions. Avoiding hard conversations. What you avoid grows. What you face heals. Quick tips for better everyday communication. Here's a toolbox of micro-habits that make a major impact. Use names. People feel more connected when you use their name. Pause before replying. A second of silence can save a misunderstanding. Watch for nonverbal shifts. Notice when people suddenly pull back or disengage. Say, "Tell me more." It invites people to open up. End with appreciation. "Thanks for sharing that," or "I'm glad we talked," goes a long way. Communication in different contexts. Let's break it down even further. In friendships, be vulnerable, not just entertaining. Check in regularly, not just when you need something. Apologize when needed, mean it. In work settings, be concise. Time is valuable. Focus on solutions, not just complaints. Use we instead of you to create a team mentality. In romantic relationships, name your needs clearly. Avoid scorekeeping. Express appreciation often, not just criticism. In family dynamics, be patient with different communication styles. Don't force heavy talks during high emotion. Create rituals where safe, open conversation is encouraged. Final thoughts for this chapter. Communication is not about winning. It's not about talking more or louder or smarter. It's about creating understanding and trust. It's about learning to speak with people, not at them. And here's the beautiful part. The better you get at communication, the less often you'll need to have hard conversations, because the daily flow of clear, kind communication builds stronger, healthier relationships from the start. You're not just learning to speak. You're learning to connect, heal, and lead with your words. And that changes everything. Chapter 7. Building confidence in social interactions. Confidence isn't a personality trait. It's a skill. Let's bust a myth right away. Confidence is not something you're born with. It's something you build, one conversation, one step, one win at a time. Even the most socially skilled people you see, on YouTube, at events, in leadership roles, weren't naturals. They learned to be comfortable around others. This chapter is your blueprint to build that same kind of unshakable social confidence. We're going to explore where social fear comes from, how to overcome it, and exactly what to do when you're in a room full of people and your inner voice starts whispering, "You don't belong here," because you do. And by the end of this chapter, you'll know exactly why and how to show up with confidence. What is social confidence? Really? Social confidence means you trust yourself to handle social situations. You're not obsessed with how you're being judged. You don't need to be perfect. You just need to be present. You speak with clarity, listen with curiosity, and walk away feeling proud of how you showed up. It's not about being loud. It's not about being funny. It's about being real and feeling safe in your own skin. Why we feel insecure in social settings. Let's get real. Most people have felt at least one of these. What if I say something stupid? They probably think I'm awkward. I'm not interesting enough to be here. I don't belong. Sound familiar? These are social fears, mental traps that create anxiety before and during interactions. And most of them come from early experiences where you felt judged, rejected, or left out. The brain remembers those moments. It says, let's avoid that pain again. So it triggers nervousness, overthinking, or even withdrawal. But you don't need to obey that fear anymore. Step 1. Shift the spotlight. Here's a powerful mindset shift. Stop focusing on how you're being perceived. Start focusing on how you're making others feel. Social anxiety is self-focused. Social confidence is others-focused. Instead of, am I being awkward? Try, how can I help this person feel seen and comfortable? This instantly shifts your energy and lowers your anxiety. Step 2. Own the awkward moments. Every confident person you admire has said something weird, made a joke that flopped, or walked into a room feeling out of place. Confidence doesn't mean avoiding awkwardness. It means not being afraid of it. Try this. Laugh it off. Well, that came out wrong. Own it. I totally blanked on your name, my bad. Redirect with curiosity. Anyway, what were you saying about when you show you're okay with your own imperfections, others feel relaxed, too. Step 3. Use body language to signal confidence. Your body leads, your brain follows. Here are a few powerful body hacks. Stand tall. Roll your shoulders back. Lift your chest slightly. It signals openness. Uncross your arms. Open body. Open energy. Smile softly. It invites people in. Eye contact, not a stare, just enough to show presence. Stillness. Fidgeting shows nervousness. Calm hands, calm mind. Even if you feel nervous inside, your body can signal safety to your brain and to the people around you. Step 4. Build social confidence in safe zones. Don't jump straight into high pressure. Networking events. Build your confidence gradually. Talk to baristas, cashiers, or neighbors. Ask someone at work how their weekend was. Compliment a stranger's outfit. These small social reps build comfort and confidence. The more you practice, the more natural it becomes. Step 5. Master your inner dialogue. The most important conversation is the one you're having with yourself. Here's how to upgrade your inner voice. Catch the critic. I'm so awkward. I'm still learning, and that's okay. Affirm your growth. This feels hard now, but I'm getting better every time. Visualize success. Picture yourself walking into a room with calm confidence. Rewire the narrative. Your brain is always listening. Step 6. Prepare without over-planning. Confidence loves preparation, but over-preparation backfires. Instead of scripting every line of what you'll say, focus on intent. I want to be curious about others. I want to share something meaningful. I want to be fully present. Also, have a few go-to conversation openers ready. What brings you here today? How do you know, mutual friend? What's been the highlight of your week so far? Simple, open-ended. human. Step 7. Learn to handle rejection. Sometimes you'll try to connect, and it won't land. That's life. Here's what to. Remember, it's not always about you. Everyone has off days or other things on their mind. Confidence means resilience, not perfection. Each awkward moment is a rep. Each ignored message is one step closer to someone who will respond. Your worth isn't tied to others' reactions. Step 8. Surround yourself with confidence builders. Who you spend time with affects how you feel. Find people who encourage your growth, accept your quirks. Celebrate your courage to show up. And when possible, limit exposure to chronic critics, negative energy. People who only take in conversations, confidence grows in healthy soil. Confidence is built through action. You don't need to feel confident to act confident. In fact, most confident people act before they feel ready. Then, the feeling catches up with the action. That's the key. Speak up in the meeting. Say hello to the new person. Share your idea. Tell your story. Start where you are. Use what you have. Grow one moment at a time. Quick confidence boosters for when you're nervous. Here's a toolbox of quick strategies. Power pose for 2 minutes. Stand like a superhero before an event. Box breathing. 4 seconds inhale, 4 hold, 4 exhale, 4 hold. Repeat. Mantra. I don't have to be perfect, I just have to be present. Posture, check. Tall spine, calm mind. Micro goal. I'll talk to just one new person today. Confidence is built in motion, not waiting. Real stories, real growth. Let's hear from a few everyday people who built confidence. Lena was shy at work and felt invisible. She started speaking up in small team meetings with just one sentence. Within months, she was leading discussions. She didn't wait to feel ready. She just started. Darius always froze in networking events. He gave himself one goal: ask 2 people about their career paths. He repeated it at every event. Eventually, he was introducing people to each other and hosting mixers. Priya had social anxiety for years. She started volunteering at a community center where she didn't know anyone. The weekly exposure and kindness of strangers reshaped her self-image. Confidence grows when you choose courage over comfort, even in small doses. Final thoughts for this chapter. Confidence isn't about never feeling nervous. It's about showing up anyway. It's not about dominating a room. It's about owning your presence, calmly, clearly, authentically, and it's not something others give you. It's something you build from within, through awareness, action, and self-trust. So go ahead, step into the room, say the first word, smile even when your heart is racing. Be bold, be kind, be human. Because the most magnetic person in the room isn't the loudest. It's the one who makes others feel safe, seen, and uplifted, simply by being grounded in who they are. And that person can be you. Chapter 8. Emotional Intelligence in the Workplace. Why emotional intelligence matters at work. Let's be honest. Most people don't leave jobs. They leave toxic environments, poor managers, and daily stress that could have been avoided with a little emotional intelligence. Workplaces aren't just about skill and performance. They're human ecosystems. Deadlines, meetings, personalities, pressure. It's emotional terrain. That's where emotional intelligence becomes a game changer. It affects how you handle feedback, how you navigate conflict, how you build trust, and how others perceive your leadership potential. In this chapter, you'll learn how to use emotional intelligence to not just survive the workplace, but thrive in it. The 5 pillars of emotional intelligence at work. Let's break it down into 5 core areas: self-awareness, self-regulation, motivation, empathy, social skills. Each one plays a specific role in your professional life. Let's explore each with examples. Self-awareness. Know your triggers. Imagine you're in a team meeting. Someone shoots down your idea. You feel heat rise in your chest. Maybe a little anger, maybe embarrassment. Without self-awareness, you might lash out or shut down. With self-awareness, you recognize, this feedback stings a little, but maybe it's not personal. Let me stay curious. Self-awareness means noticing your emotional reactions without letting them hijack your behavior. Try this at work. Pause before replying to emotional emails. Journal a few lines after stressful meetings. Identify your top 3 workplace triggers and reflect on why they affect you. Awareness is the first step to control. Self-regulation. Stay cool. Under pressure, let's face it, work can be frustrating. Missed deadlines, poor communication, office politics, self-regulation. Doesn't mean bottling up your emotions. It means responding instead of reacting. People with high self-regulation stay calm when others panic. Think before they speak. Handle setbacks without blaming. Don't gossip or escalate negativity. Try this. Practice. Name it to tame it. I'm feeling frustrated. Let me pause. Use deep breathing before emotionally loaded conversations. Take a short walk or break instead of reacting in the heat of the moment. Calm is a superpower in chaotic environments. Motivation. Go beyond the paycheck, highly emotionally. Intelligent people are self-motivated. They're not just working for promotions, they find purpose in the process. They ask, how can I improve today? What impact does my work create? How do I grow from this challenge? They also bounce back from failure faster. They see setbacks as feedback, not defeat. Try this. Set personal growth goals, not just performance ones. Focus on your progress, not just perfection. Find one thing each week that excites you about your role work, becomes more fulfilling when you connect it to something deeper than deadlines. Empathy. Understand. Before you judge, in the workplace, empathy means understanding your coworkers' stress, respecting different communication styles, listening to frustrations without jumping to conclusions. It doesn't mean agreeing with everything. It means seeking to understand first. Try this. In a tense conversation, ask, what's behind this person's behavior? When giving feedback, consider their perspective. When someone seems off, ask, hey, everything all right? Empathy builds trust, and trust builds great teams. Social skills. Collaborate like a pro. Emotional intelligence shines in how you connect with others. Great social skills at work include active listening, clear, respectful communication, conflict resolution, team building, being approachable and open. Try this. Give people credit publicly. Ask teammates how they prefer to communicate. Be direct but kind when addressing issues. Use names and eye contact. It builds rapport fast. The best professionals aren't just good at tasks, they're good with people. Applying EQ in common workplace scenarios. Let's put theory into practice. Here are everyday situations and how to use emotional intelligence to navigate them. Scenario 1. Receiving criticism without EQ. You feel attacked, get defensive, and shut down. With EQ, you breathe, listen, and ask for specifics. You say, thanks for the feedback. What would success look like in your eyes? Scenario 2. Team conflict without EQ. You take sides or avoid it altogether. With EQ, you mediate calmly, validate both sides, and look for common ground. Say, let's make sure everyone feels heard before we decide how to move forward. Scenario 3. Office gossip without EQ. You join in and fuel the fire. With EQ, you steer the conversation towards solutions or excuse yourself politely. Say, I don't know the full story, so I'd rather not assume. Scenario 4. Managing up without. Q. You dump problems on your manager and complain. With EQ, you come with solutions, show awareness of their pressures, and communicate with clarity. Say, here's the issue. Here are 2 possible solutions. What do you think? Leading with emotional intelligence. If you're in a leadership role, or aspire to be, EQ is your edge. Emotionally intelligent leaders Inspire rather than intimidate. Communicate vision clearly. Listen to concerns without ego. Recognize effort. And motivate teams. Stay calm in high-stakes moments. People don't just follow titles. They follow trust, presence, and empathy. Ask yourself, do people feel safe giving me feedback? Do I respond with patience or pressure? Do I know what motivates my team personally? Leading with EQ turns managers into mentors. The ROI of emotional intelligence. Let's talk results. Studies show that people with high EQ earn more over their careers, have stronger networks, experience less burnout, get promoted faster, are rated higher by their peers and teams. Why? Because they make things smoother for everyone. They lower drama, they boost morale, they make work feel human again. Practice your EQ workplace challenge. Try this for the next 7 days. Check in with yourself each morning. Ask, how am I feeling, and how might that affect how I show up today? Do one emotional check-in with a colleague. Ask, how's your week going? Anything you're juggling that I can help with? Handle one frustrating moment with calm. Pause, breathe, reflect, then respond, not react. Give one piece of sincere praise. A short, specific compliment goes a long way. Ask one open-ended question in your next meeting. It encourages dialogue and shows leadership. You'll notice, the more EQ you use, the more influence you earn. Final. Thoughts for this chapter: emotional intelligence in the workplace isn't just about being nice. It's about being smart with emotions, yours and others. It's about creating environments where people feel safe, seen, and supported. And when you show up with emotional intelligence, you don't just grow as a professional, you uplift everyone around you. Because the people who go far in their careers aren't just the smartest or most skilled. They're the ones others trust, respect, and want to work with, again and again. Chapter 9. Advanced Social Strategies for Success Leveling Up. From social skills to social mastery, you've learned the basics: empathy, communication, emotional regulation. Now it's time to go deeper. This chapter is for those who want more than just being good with people. This is for those who want to influence, inspire, and lead in every room they walk into. Advanced social strategies aren't manipulative. They're about becoming the kind of person who creates meaningful impact by connecting, understanding, and elevating others. You'll learn the art of persuasion, how to read a room, charisma triggers strategic vulnerability, how to handle power dynamics with gracelet, is unlock next-level human connection. The art of subtle persuasion. Persuasion isn't about pressure. It's about alignment. Influential people don't force decisions. They guide them. They understand psychology, timing, and emotional tone. Here are 3 powerful persuasion tools. A. Mirror and match. Subtly mirror the body language, tone, and pace of the person you're speaking to. It signals, I'm like you, which builds trust fast. People trust what feels familiar, but don't overdo it. Keep it natural, like a dance, not a copy. B. Lead with shared goals. Instead of saying, here's what I want, say, here's how we can both win. People resist when they feel pushed, but move forward when they feel aligned. Use story, not just logic. Facts tell. Stories sell. If you want to persuade, use vivid examples, personal experiences, and emotional anchors. I know how that feels. Last year, I was stuck too, is more powerful than a list of bullet points. Reading the room. Energy, emotion, and dynamics. Social intelligence means knowing not just what to say, but when and how. Reading a room means noticing energy shifts, sensing tension or excitement, adjusting your tone or message on the fly train. This muscle, observe before speaking. Scan facial expressions, posture, and silence. Ask yourself, what's not being said here? Example, you walk into a meeting, people are stiff, quiet, and avoid eye contact. Don't jump in with enthusiasm. Start with calm curiosity. Seems like there's a lot on everyone's mind today. What's top of the list? This skill turns you into a trusted communicator in any group setting. Charisma triggers. How to be magnetic. Charisma isn't luck. It's a learned blend of 3 things. Presence, full attention, no distractions, no rushing. Power, quiet confidence. Owning your value. Warmth, openness, kindness, empathy. High charisma, high presence, plus high warmth, plus high power. Here's how to activate it. Put your phone away when talking to someone. Speak slower and with intention. Smile with your eyes, not just your mouth. Compliment people on qualities, not just looks. You really know how to keep people calm in tough situations. When you combine presence, power, and warmth, you become unforgettable. Strategic vulnerability, the connection. Accelerator, want to build fast, real connection. Share before you shine. People connect through struggles, not just success. I used to struggle with that too. I felt nervous the first time I tried that. Here's a mistake I made that taught me a lot. This doesn't mean oversharing or making everything about you. It means letting people see the human behind the skill set. Vulnerability breeds trust, and trust is the foundation of influence. Social positioning, navigating power with grace. Every social group has unspoken dynamics. Who leads? Who influences decisions? Who's respected? Who's overlooked? Emotionally intelligent people notice this and navigate it with tact. How? To move with social intelligence. Compliment the quiet people publicly. Ask the opinion of someone being ignored. Support ideas and give credit openly. Never outshine your leader. Elevate them subtly. Offer ideas that benefit the whole group, not just you. And most importantly, don't demand respect. Earn it through humility, value, and consistency. The power of listening, next-level connection. Most people listen to reply. Leaders listen to understand. Want to be powerful in any conversation? Try this. Ask open-ended questions. What's been on your mind lately? How did that experience shape you? Don't interrupt. Let silence do its work. Reflect what you heard. It sounds like you're feeling overwhelmed because you care about doing this right. Deep listening is a superpower. It makes people feel seen, and that makes you magnetic. Building strategic relationships. It's not just who you know, it's how you know them. Here's how to build real, lasting, high-value relationships. A. Be consistently helpful. Send articles, intros, or encouragement without asking for anything. Thought of you when I saw this. Figured it might help. B. Show up. During quiet times, not just celebrations. Show up when someone is stuck, uncertain, or in the background. People never forget who showed up for them when no one else did. C. Stay in light touch. You don't need weekly calls. A quarterly check-in, holiday note, or saw this and thought of you goes a long way. Relationships compound over time, like interest. Invest early and often. Social adaptability, becoming a chameleon with integrity. Being socially adaptable. Doesn't mean faking it. It means knowing how to show up differently for different people and environments. It's the emotional equivalent of knowing when to wear a suit and when to wear sneakers. Adapt to tone of voice, speed of conversation. Formality-level humor style, but never compromise your core values. Adapt your style, not your integrity. Think of it like speaking different dialects of the same language. You're still you, just more fluent. Practice your advanced social challenge. This week, try one challenge per day. Mirror someone's tone and body language subtly in a conversation. Scan a room and guess the emotional temperature before speaking. Give a thoughtful compliment using presence, plus warmth. Share one authentic, vulnerable story in a conversation. Elevate someone who's usually overlooked in your group. Ask a deep, open-ended question and really listen. Reconnect with someone in your network with a kind message or offer. Then journal your reflections. What changed when you approached people with more awareness, presence, and empathy? Final thoughts for this chapter. Social mastery isn't about being loud, dominant, or always on. It's about making people feel seen, heard, and inspired to be better around you. That's the real mark of influence. And here's the truth. You don't have to be born charismatic. You don't have to be the most outgoing person in the room. You just have to care, learn, and practice. Every interaction is a chance to level up your impact. When you combine emotional intelligence with advanced social strategy, you become unstoppable. Not because of manipulation, but because of connection. And that's where real success lives. Chapter 10. Conclusion and key takeaways. You made it. If you're hearing this, you've just completed a journey most people only talk about starting. You didn't just listen to words, you invested in yourself. Let's pause and take a deep breath. Because what you've just done isn't small. You've learned to understand your own emotions. You've gained tools to connect with others at a deeper level. You've stepped into the next version of yourself, one that's wiser, calmer, and more socially empowered. Now let's wrap everything up and make sure you walk away with the most important lessons that you can apply for life. The core truth. Emotional intelligence is a skill, not a trait. If you remember nothing else, remember this. Emotional intelligence is not something you're born with. It's something you build, like muscle, like language, like leadership. It grows every time you choose to pause instead of react, listen instead of speak, ask instead of assume, own your feelings instead of blaming others, lead with empathy instead of ego. You're not just learning how to cope with life, you're learning how to master it. Key lessons from each chapter. Let's revisit the main takeaways from every chapter. These are your go-to principles moving forward. Chapter 1. Introduction to Emotional Intelligence and Social Skills. Emotional intelligence is the foundation of personal and professional success. Social skills determine the quality of your relationships. This journey is about growth, not perfection. Mantra. I can learn to understand myself and others. Chapter 2. The science behind emotional intelligence. EQ involves 5 core components: self-awareness, self-regulation, motivation, empathy, and social skills. It's measurable, improvable, and supported by neuroscience. High EQ correlates with better mental health, leadership, and life satisfaction. Mantra. Emotions are data. I can learn to decode them. Chapter 3. Self-awareness, recognizing. Your emotions. You can't change what you don't notice. Journaling, mindfulness, and feedback help you build emotional awareness. Naming emotions disarms them. Mantra. I pause, observe, and understand myself. Chapter 4. Managing emotions in difficult situations. Emotions are signals, not orders. Self-regulation is about space between stimulus and response. Breathing, reframing, and reflection are key tools. Mantra. I respond with wisdom, not impulse. Chapter 5. Building empathy for stronger relationships. Empathy is understanding, not agreement. Active listening creates emotional safety. Empathy strengthens trust and connection. Mantra. I see you. I hear you. You matter. Chapter 6. Social Skills 101. Understanding social cues. Communication is more than words. It's tone, timing, and energy. Nonverbal signals are critical. Social awareness makes you a better teammate, partner, and friend. Mantra. I tune into what others feel, not just what they say. Chapter 7. How to improve communication in every situation. Speak to be heard, not just to talk. Use clarity, warmth, and intention. Great communication includes listening, questioning, and timing. Mantra. I connect by being clear, kind, and curious. Chapter 8. Emotional Intelligence in the Workplace. EQ is your leadership advantage. Handle criticism, conflict, and stress with grace. Build a culture of trust, empathy, and accountability. Mantra: I rise by lifting others. Chapter 9. Advanced Social Strategies for Success. Influence is about alignment, not pressure. Charisma. Presence plus power plus warmth. Read the room, speak with purpose, and connect authentically. Mantra: I inspire by being real, not perfect. What success really looks like. Success isn't just about achievements. It's about how you feel while you achieve them. It's not about having more friends. It's about having better relationships. It's not about never getting angry. It's about understanding where that anger comes from. It's not about avoiding hard conversations. It's about learning how to have them with care and clarity. Mastering emotional intelligence doesn't mean you'll never struggle again. It means you'll struggle better, with more resilience, more awareness, and more wisdom. That's real growth. Your ongoing practice plan. Here's how to keep building EQ and social skills beyond this audiobook. Daily check-ins. Ask, what am I feeling? Why? How can I respond better today? Weekly reflection. Write about a social interaction that challenged or inspired you. Monthly challenge. Pick one EQ skill to focus on each month, like active listening or managing stress. Accountability partner. Find someone to practice communication and self-awareness with. Share wins and lessons. Annual reset. Revisit this audiobook in a year. You'll hear it differently because you'll be different. To the future. You imagine yourself 6 months from now, calmer under pressure, more connected in your relationships, a better communicator. Someone others admire, trust, and respect, not for your image, but for your presence. That future is built one emotional choice at a time. You've already started the path. Now keep walking it. One final note. Your power is in the pause. In the end, emotional intelligence is this: the power to pause, to feel deeply without being ruled by your feelings, to lead with heart without losing your edge, to be human and still grow every day. You don't need to be perfect. You just need to be present. Thank you for listening to How to Master Emotional Intelligence and Social Skills. If this journey helped you, share it with someone who's ready to grow too. You're not just changing your life. You're changing how you show up for the people around you. And that changes the world.
Hypothetical told Bloomberg deal-making in the Gulf delivered emerging markets growth for developed market risk. That's it for Horizons, Middle East and Africa. I'm Tom McKenzie in London. Stay with me for Daybreak Europe. European futures pointing higher, US futures also on the upside. Stay with us. This is Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. Happy Friday, everyone. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks in the green as investors await delayed US inflation data. Fed Chair frontrunner Kevin Hassett calls for a cut next week. Meanwhile, the yen strengthens with the BOJ said to be likely to raise rates this month. Indian Prime Minister Narendra Modi extends a warm welcome to Russia's Vladimir Putin as New Delhi defies pressure from the US over its ties with Moscow. Plus, a Bloomberg scoop, Warner Brothers is said to have entered exclusive talks with Netflix to sell its extensive film, TV studios and HBO assets to the streaming giant in a move that would bring seismic change to the entertainment industry. There was a little bit of trepidation in the earlier part of today's session that was being seen in the Asian markets as we lead up to the inflation print. Backdated it is, but we know the Fed is keeping an eye on it. PCE, of course, dropping later today. But that trepidation has largely been washed out, at least for now. European futures on the front foot. Things have even turned around in Asia as well, across the MSCI Asia Pacific. We'll do a deeper dive of that shortly. European futures then looking to build on the modest upside that came through yesterday, up 0.2%. So you're looking for 4 straight days of gains for European stocks alongside their US counterparts. FTSE 100 500 futures looking to add just 2 points. S&P E-minis pointing higher by 0.2%. Very modest gains coming through across the US yesterday, but they were there nonetheless. Nasdaq 100 futures looking to add 100 points, up 0.4%. Let's flip the board and have a look cross-asset. Interesting that the dollar and the last 5 weeks is down 4 out of those 5 weeks. You're seeing a bit of dollar softness once again today. That is a boost, of course, largely for EM assets. 410 right now in the US benchmark 10-year, largely stable, but you did see yields creeping high yesterday by the end of the close. Mixed picture when it comes to the jobs data, and we'll break that down for you shortly with Valerie Teitel. The Japanese yen currently then 0.3% higher versus the US dollar, 154 on the reports that the BOJ is getting ready to hike on December the 19th and signal further hikes as well out. $63 a barrel on Brent, just a little softer by 0.1%, and Bitcoin back below 92,000, a little softer in the session by 0.2%. Let's cross over to Asia then. Winnie Su standing by in Hong Kong. Winnie, the sentiment appears to have changed, slightly more positive in your part of the world.
Yeah, exactly. We thought it was going to be quite a quiet session in Asia on Friday, but not quite so. So first of all, we take a look at what's going on in Japan, because yes, we've got that scoop saying that the Bank of Japan officials are ready to raise rates later this month if we don't see much of a shock when it comes to financial markets or the economy. And that's not just it. Like you mentioned, it's more about how they are considering to continue to raise rates if the economic outlook is realized, and hence you see that yen strengthening past that 155 level and providing more pressure on the Japanese stocks, with the benchmarks both down more than 1% because of that reliance of exporters for the Japanese companies. And sticking with the central bank moves, we've also got India's RBI cutting rates by 25 basis points, the first time in 6 months. And we're seeing here how the markets are reacting as we flip the board and take a look at the broader Asia market. So the India stock market benchmark here is holding on to gains up 0.4%. And we are seeing the real estate and the auto sector actually outperforming other sectors. And it's really coming after how the inflation has hit record low. But like you mentioned, overall Asian market fluctuating here, a bit of a cautious mood ahead of that PCE data we're expecting from the US. Kospi here is rising, driven by the gains in Samsung, and Hang Seng here also fluctuating a little bit. But when it comes to the Chinese market, we're highlighting one stock in focus today, which is the More Threads, which is the China's chip maker here. So you can see that on its debut day here, up more than 400% in Shanghai. And it is the second largest onshore IPO, raising funds of more than $1 billion US. And the funds are expected to be used in its AI projects. And it's such a big stock that we would like to highlight because of how it was founded by NVIDIA's ex-executive, and hence it started by making GPUs and has the ambition to potentially become China's next NVIDIA, and hence a lot of excitement around the country's self-sufficiency agenda and also China's technological capability going forward. Back to you, Tom.
Okay, that is a bonkers move, an upside of almost 500% for that domestic chip player over in China. You've got to love the Chinese retail investor. Winnie Su in Hong Kong, thank you very much indeed with the check on the Asian markets. Pressure, as Winnie was saying, on Japanese stocks, of course, on stronger yen on the back of that Bloomberg scoop around the BOJ looking to hike rates on December the 19th. Let's cross to the geopolitics of Russia and India right now, because India's Prime Minister Narendra Modi rolled out the red carpet for Russian President Vladimir Putin for his first state visit since Russia's invasion of Ukraine. The stakes, of course, are high for Modi, who's seeking to assert India's strategic autonomy after US President Donald Trump slapped tariffs of 50% on the nation's goods to punish New Delhi for its close ties with Russia. For more, let's bring in Bloomberg's Dan Strumpf in New Delhi, who's following all of this for us. Dan, talk us through the kind of welcome then that Putin has received by India's leader.
Yeah, good morning, Tom. Thank you so much. So you're absolutely right. This has been truly a red carpet welcome for the Russian leader here, quite literally. Modi greeting the Russian President Vladimir Putin at the airport in New Delhi, really quite a rare event for him. And it's really been all smiles between the two of them. You really do have a situation where these two countries are kind of in the same position right now, both facing sort of some unexpected isolation for sure. Russia, ever since its war in Ukraine, under global sanction. But this year you've seen India unexpectedly isolated by the U.S. and under pressure from President Donald Trump, which is manifesting itself in those 50% tariffs that you mentioned, which has really been quite damaging to India's exporters. So you really do see at the center of the agenda for this visit the economic partnership between the two countries, as well as their longstanding defense partnership as well.
Dan, what do you think the US reaction will be to this visit, particularly as we look at potential deepening of ties around defense, maybe energy as well, between Russia and India?
Well, you can expect it to not be very positive, for sure, Tom. I mean, you know, the U.S. president has really shown a lot of displeasure towards India this year over specifically its purchases of Russian crude oil, which were really at an all-time high earlier this year, and at least in the view of Washington, has really kind of helped to bail out the Russian war effort that has dragged on for a lot longer than many people expected. Now, one thing that's important to bear in mind is that India has curbed its purchases of Russian oil in recent months under U.S. pressure. Now you see very likely a deepening economic partnership that's likely to come out of this meeting, as well as some major defense deals that we're expecting as well. So for sure, it's not going to be looked on favorably in Washington. India is really the only major economy that Washington hasn't struck a trade deal yet with, you know, how that looks to unfold in the coming weeks, we'll just have to see. But for sure, this meeting is going to be looked at very closely in Washington and not terribly favorably.
Okay, Bloomberg's Dan Strumpf in New Delhi on that state visit by the Russian leader to India. We appreciate it, Dan. Thanks for the update. Meanwhile, National Economic Council Director Kevin Hassett says the Fed should cut interest rates at its meeting next week, predicting a reduction of 25 basis points. It comes as speculation, of course, grows that President Trump is set to tap Hassett to lead the central bank. Let's bring in Bloomberg's Valerie Teitel. Val, this is more of a dog bites man kind of story. Shock horror. Kevin Hassett calling for 25 basis points cut. But it is interesting. We want to hear, the more we hear from him, the more interest there is, of course, particularly around speculation that he could be the next Fed chair. Anything he says has weight and importance.
No, exactly, Tom. And this interview he had on Fox News, he was actually asked, you know, how quickly should the Fed be lowering rates? And he did mention that the Fed should be data dependent, should be data responsive, and aim for low employment and low inflation. So again, maybe not necessarily claiming that the Fed should be cutting rapidly, but should be waiting for the data to do so. He did say, though, that in the long run, we need to get to a much lower rate. So that is his stance. It's been his stance for a long time this year, as he does believe that Trump's policies should have a disinflationary impulse on the U.S. economy in the next year. I do want to mention, though, that there is some speculation that he could run into some road bumps when it comes to his confirmation process in the Senate. Remember, it's a two-stage confirmation process. Not only does he have to accept the nomination from Donald Trump, he has to sit in front of the Senate Banking Committee and get their approval before then sitting in front of the entire Senate and that vote coming through. When it comes to the Senate Banking Committee, the votes are quite tight when it comes to Republicans and Democrats split. It's a 13-11 split on the Senate Banking Committee. So one Republican holdout can really disrupt this nomination. So again, just a reminder that even though Trump might make the announcement before the end of this year, maybe the early next year, there is still a lot of speculation on just how easy it will be for Kevin Hassett to eventually get that Senate confirmation, given he is so close to the U.S. president. So this kind of chatter in the markets did see his odds of becoming Fed chair yesterday just drop slightly. We're all the way up to 90% a few days ago. We're now standing at 75%. So I guess a reminder that this process could still be long and ongoing.
That's really interesting. That's a really interesting caveat, isn't it? Because there is that process that he would have to go through, or any nominee would have to go through in terms of confirmation. And there is always the risk, as you say, of potential roadblocks. Let's get to the data. Help us understand what came through, because we had the claims data on one side and then we had the Challenger survey on the other. Where do things stand in terms of the labor market of the U.S., given what we saw yesterday?
Look, there's been a mixed picture on the labor market, but I do think the market gave a lot more weight to the weak ADP print that we had a few days ago rather than the data that we got yesterday. We had the weekly jobless claims that actually came at a 3-year low, so pointing to the fact that maybe the labor market isn't as soft as we think. But the survey week for jobless claims was the week of Thanksgiving, and last year we were also dealing with a Boeing strike, so there's some kind of crazy seasonal signals that we have to keep in mind as well. So the market kind of shrugged that off, that tight jobless claims number yesterday, and still is of the notion that the labor market is on a weakening track. Again, let's talk about the data that we have upcoming. We have PCE inflation today, but that is the delayed print from September, so very unlikely to shift the Fed's thinking from their decision next week. We have 2 more weeks to wait for the November CPI and the November non-farm payroll release. They're coming the week just before Christmas. That is going to be instrumental to how the Fed shapes policy at the beginning of next year.
Okay, and that seasonal craziness as well, worth bearing in mind. Valerie Teitel, thank you very much indeed, making sense of the jobs data for us and leading up, of course, to the PCE print that comes out later today. Talking of which, here's what else to think about today. 2:15 p.m. UK time, the ECB's Villeroy will be speaking in France. Of course, the French Bank of France governor, but also a member, of course, of the ECB's Governing Council. So we'll be tuning in, or at least taking lines from that. Interesting to hear from him. And at 3 p.m. UK time, it is, as Val was saying, the US personal income and spending and PCE gauge, of course, personal consumption expenditures gauge, which we know the Fed scrutinizes, even if it is the September number. 3 p.m. UK time. Meanwhile, we'll get University of Michigan sentiment survey as well. Break that for you. You can get a roundup of the stories you need to know to get your day going. In today's edition of Daybreak, terminal subscribers can go to Day B, go on the terminal, and the deal, potential deal between Warner Brothers and Netflix is one of the key stories for us today. What that could do to the entertainment industry. Seismic is the way it has been described. Coming up, Germany's Chancellor Friedrich Merz faces a key test in Parliament later today in a pension bill vote. We'll find out the implications of that political peril, potentially, for the German Chancellor. That's coming up. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, German Chancellor Friedrich Merz's ruling coalition faces a key vote later today. Parliament set to decide on a pension bill, part of the reforms pledged by Merz to reinvigorate Germany. Let's bring in Bloomberg's chief Europe correspondent, Oliver Crook, who, of course, spent a number of years in Germany following the politics and the economy of that country. What is at stake then, Ollie, for the German Chancellor today?
I think once again his authority is at stake, which is something we've seen really from the very beginning of his chancellorship. He's not somebody that was beloved really by anybody in the German sort of political arena, even within the CDU. And there's this pension vote that's going before the Bundestag today, in which there is a rebellion, not just from the broader parts of his coalition, but actually within a fragment of his own CDU, the youth wing, where there are about 18 votes They have a majority in the parliament of only 12 votes. So theoretically, if the CDU, this part of the youth movement, basically were to vote against it, he could lose this vote. That being said, he's actually getting an unlikely ally in the far left Die Linke that is basically going to abstain from the vote, therefore taking out those lawmakers from the pool. Thus, likely this will pass. But once again, Tom, this is very reminiscent of basically even the first day of his chancellorship. Well, you'll remember there was supposed to be a procedural kind of rubber stamp vote in the Bundestag that brings in the next chancellor. And for the first time in modern German history, that failed because he could not garner the votes of his own coalition to make him chancellor. So again, once again, this is sort of Friedrich Merz dealing with a sort of authority problem within his own government at a time when, again, the economy continues to contract, continues to stagnate. We've had years of that happening. We have potentially 1% growth into next year, but that we've seen that movie before, Tom, where we expect a little bit of growth next year, then revision after revision down back to zero. And those are the odds that are facing Friedrich Merz. And we should say that consistently since he took over, the AfD is now polling above the CDU.
Wow, yeah, and a reminder of the political fragility of that coalition and its ability or lack of ability to actually implement change on the ground in Germany. Ollie, meanwhile, of course, you have a lens also on the international sphere and a focus on what's happening with the Ukraine. Are we making progress in terms of eking towards any kind of deal? We hear that Ukrainian negotiators are on their way to Florida.
Yeah, so we understand that they are in Florida. They've already held some preliminary talks with some of the Americans. We did not get a whole lot of readout from those meetings. That is, we're very much in wait-and-see mode, basically, since there was that diplomatic flurry with so much information on that 28-point plan. Ever since that sort of went public, everything's gone really underground in terms of the negotiations. So we don't actually know what the 19 points of the 19-point plans are. We heard from Zelensky overnight in the briefing. He's awaiting to get what he says in his nightly briefing, obtaining full information about what was said by the Russians and what other pretexts he says that Putin has found to prolong the war. Basically, the question is this just Russia basically buying time in order to continue to wage the war without getting any consequence from the United States? The difference is in buying time today versus buying time 3 weeks ago is you do now have these American sanctions on Lukoil and Rosneft that are slowly eating away at the Russian economy. And I think ultimately what we're looking for, Tom, is for the Trump administration and for Donald Trump, three options. One is he gets fed up and he walks away from the peace process. Two, he decides Russia is actually the obstacle, ramp up sanctions on the Russians. Or three, of course, what we've heard in the past, he thinks it's the Ukrainians, and then he basically threatens to withdraw military and intelligence support. So those are really the three options, and it comes down, like so many things in these days, to the man in the Oval Office, who he sort of sees as going to be the impediment to peace. We should say there is a little bit of action to watch here in Europe. Friedrich Merz, maybe unable to wield his own authority within Germany, is going to Belgium today to dine with the Prime Minister of Belgium, which of course has been the big obstacle in moving forward on those Russian frozen assets. So maybe a bit of diplomacy in Belgium can break that through.
Yeah, that is certainly something to watch, isn't it, in terms of whether they can release that funding or at least be able to lend on the back of those Russian assets. Ollie, you are in Dusseldorf. You're going to be speaking to someone who is absolutely pivotal to the defence, not just of Germany, but Europe as well. Talk us through the interview you got lined up and why this is significant.
Yeah, Tom, that goes some distance to explaining this wonderful background that we have here. We're in Dusseldorf. We're about a few minutes away from the Rheinmetall headquarters. We'll be speaking to the CEO. And I should say, Tom, you mentioned that it's obviously central to the Ukraine story, the military buildup. I mean, this is a business that went from basically a market cap of less than $2 billion when the CEO took over in 2013, now over $80 billion. This has had a growth since the beginning of the war of 1,700%. And I think that unlike many of the other defense CEOs that you and I interview and that we speak to, there is one difference here at Rheinmetall. They have not hesitated to build out. A lot of these other CEOs have said, listen, we need to see the spending come through. We need to actually see this order backlog hit the sort of a P&L for us. He has said, no, we're going all out. We're going to build factories all across Europe. We're going to expand into all these different sections. We're going to start building satellites and find out all the gaps in basically European defense, and we want to fill those gaps. So that is going to be a conversation for a little bit later today with the CEO to really understand how he intends to execute this plan, and ultimately what is the ambition for this business in 5 to 10 years, one of the most ambitious companies certainly in Europe and potentially in the world.
Okay, really, really important interview coming up. Bloomberg's chief Europe correspondent, Oliver Crook, leading up to that interview. Of course, we'll bring that to you later today. Ollie, thanks for that update as well on the politics of Germany and movements around Ukraine, Russia and the US on that potential peace deal. We're going to continue the conversation, of course, on Ukraine with Andrew Pudzer, by the way. the US ambassador to the European Union. That interview at 9:30 a.m. London time on The Pulse. Coming up, J Street's record haul this year, switching focus, boosted by savvy bets on artificial intelligence. We're going to bring you the details next. This is Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Tehran, and this is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Bloomberg Daybreak Europe. Legendary investor and Berkshire Hathaway CEO Warren Buffett, of course, is retiring at the end of this year. For many investors, it is the end of an era. Bloomberg Originals looks at how Buffett changed investing forever and what's next for the company he built. Here's a preview.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway.
Greg Abel led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic.
He won't be writing the annual letter next February. This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
Well, subscribers can watch the full documentary on the terminal and Bloomberg.com. It'll also be available on Bloomberg's YouTube channels at a later date. Now, some other stories making the news this Friday. Bloomberg understands Jane Street's record trading boom this year has been fueled by smart bets on AI, particularly tied to Anthropic. Sources say Jane Street's investments in private companies and funds lifted third-quarter trading revenue by about $830 million, with Anthropic accounting for most of those gains. Jane Street is on pace for its best year ever, leapfrogging many Wall Street rivals. Meanwhile, Meta shares jumped on Bloomberg's report that Mark Zuckerberg is expected to make significant cuts to resources for building his company's so-called metaverse. We're told executives are considering budget cuts as high as 30% for units, including Meta Horizon Worlds and Quest VR. Zuckerberg had previously framed the project as the future of the company and the reason for changing its name from Facebook. US senators are seeking to ban NVIDIA from shipping advanced AI chips to China. They have introduced bipartisan legislation in the bid to codify existing US restrictions on exports of advanced semiconductors. The bill would effectively bar NVIDIA from selling its H200 AI chips to Chinese customers, as well as its more advanced Blackwell products. And Bloomberg has learned that Goldman Sachs paused a planned $1.3 billion mortgage bond sale for Cirrus One after a major outage at one of its data centers crippled CME Group. Sources say early feedback was due November the 25th, but days later CME's global markets went down for more than 10 hours due to a cooling system failure at Cirrus One's Illinois facility. The deal is now on hold, but may be revived in the first quarter. Coming up, we're going to look ahead to US PCE inflation data out today and what it means for the US economy with Ellie Henderson, economist at Investec. That conversation coming up. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good Friday morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks in the green as investors await delayed US PCE data. Fed Chair frontrunner Kevin Hassett calls for a cut next week. Meanwhile, the Japanese yen strengthens with the BOJ said to likely hike rates this month. Indian Prime Minister Narendra Modi extends a warm welcome to Russia's Vladimir Putin as New Delhi defies pressure from the US over its ties with Moscow. Plus, a Bloomberg scoop, Warner Brothers is set to have entered exclusive talks with Netflix to sell its film and TV studios. and HBO assets to the streaming giant in a move that would bring seismic change to the entertainment industry. Let's get to the markets then. European futures pointing to a fourth straight day of gains for European stocks. US stocks also set for a fourth straight day of gains if things hold. European futures then pointing high by 0.2%. FTSE 100 futures looking to add just 3 points. S&P E-mini after the S&P 500 notched up gains of just 0.1% yesterday, looking to build on that today, up 0.2%. Nasdaq 100 futures point to the gains of 0.4. Let's flip the board and have a look across asset. There's a bit of stability in the Treasury markets right now. Yields were a little higher yesterday in the session, 409 right now on the benchmark US 10-year. That could adjust, of course, around the inflation data that drops later today. The PCE gauge, of course. The Japanese yen is stronger in the session, up 0.3% on this Bloomberg scoop around the BOJ's thinking at its next meeting. 154 right now in the Japanese currency, and that is weighing on Japanese stocks. Yen strength higher, of course, Japanese stocks down on that story. Brent at $63 a barrel, and Bitcoin back below 92,000 at 91,996, just a little softer by 0.2%. Let's get more then on that news from and around the BOJ, the Bank of Japan, of course. Bloomberg's Valerie Teitel joining us now. Valerie, so we're hearing, it's not a huge surprise that the BOJ is thinking of hiking to 0.75% at its next meeting, but the signalling is interesting, and at a time, of course, when you have a new leader in Japan who's focused on stimulus.
No, that's right. You're right to point that out, Tom. We are 90% priced for a Bank of Japan hike when it comes to their decision in 2 weeks' time. But it's all about the guidance, and sources were telling Bloomberg overnight that they could leave the door open to further hikes next year. A hawkish hike from the Bank of Japan could be the one surprise we have left on the calendar before we wrap up 2025. We are seeing the yen strengthen off the back of this scoop. As you mentioned, it's stronger by around 0.3%, but the yen is hanging out at around levels the weakest all year. So again, a hawkish central bank decision, a hawkish guidance would be something that could stem the weakness of the yen of late. I do want to mention we are seeing a reaction as well in fixed income across the JGB curve. Some pronounced weakness in the front end. We have those 2-year yields in Japan up around 3 basis points, and we were reminded on Monday just how instrumental JGBs are to global fixed income. We heard from Ueda. He was speaking to Parliament, raising the bar for that December hike when he did. And we did see a global fixed income sell-off off the back of that. So it's not only just JGBs we have to watch, but its impact, at least on the Treasury market, on gilts, and on the European bond market as well. But let's go over the remaining Fed rate decisions that we have remaining this year, because we do have still a lot on deck before Christmas comes. The FOMC is the big one next week, obviously very likely to cut interest rates, as well as the Bank of England in 2 weeks' time. Both of those are around 90% priced for a 25 basis point rate reduction. The ECB is expected to stay on hold, and the Bank of Japan expected to hike. It's all about the guidance and moving forward and what they can possibly tell us about what they're going to do next year.
Okay, Bloomberg's Valerie Teitel, thank you very much indeed, breaking down what we expect to see. And let's throw ahead to what to think about when it comes to the Fed. The PCE gauge, of course, out later today. Let's bring in Ellie Henderson right now, economist at Investec. And Ellie, I want to start there with what you are thinking about when it comes to Fed. Does the PCE gauge later today, does it matter given how backdated it is all the way to September? Could it change the calculus, essentially, for markets that are almost fully pricing in a Fed cut at its next meeting?
The PCE inflation data is always important because it is the Fed's preferred gauge of inflation. But as you say, it is old news now. The data is for September. We received the CPI print earlier because it had to be released because that's what uplinks benefits ratings. But consensus is looking for a small tick up in the PCE inflation, the headline measure. What we'll be looking at is we'll be digesting the report and looking at those high import intensity goods to try and gauge more of a tariff effect, because we haven't seen much of a tariff effect in the data so far.
Is it your suspicion, is it your expectation that that tariff impact will come through and have more of an inflationary impulse into 2026 then?
Our base case assumption was that the tariffs would affect inflation. We have seen small pockets in the data, but I think what we're also looking at are reports such as from the Beige Book that came out that suggested that actually firms were taking a lot of the cost on themselves and spreading it across the supply chain. So it's possible that we've got our pass-through incorrect in terms of we kind of thought a 2/3 pass-through to the consumer.
You weren't alone, Ellie. A lot of economists called this one wrong, didn't they?
But it is also possible that it's just a lag thing. We do have still goods in bonded warehouses that aren't being affected by the tariff check because we had a lot of front loading. So time will tell. But at the moment, the Fed has to make a decision on the data they have now. At the moment, it looks like there's a greater risk to the labour market, and that's likely to prompt a cut next week.
So how clear is the picture for you and the team into 2026 with the potential that that inflation story does come through? As you say, it's not clear-cut yet, that doesn't come to kind of vindicate your views. Also at a time of stimulus from the US with the tax bill that's come through and the cuts there. So how do we think about how much clarity is there in terms of how far the Fed can go with a more dovish structure in 2026?
It is really hard, but ultimately interest rates are still modestly restrictive in the US, so there is room to dial back policy restrictiveness before we get to that neutral rate where policy doesn't weigh on the economy.
What is the neutral rate for you? Is it 3%, 3.5%?
It's a touch above 3% on our own estimates, and that's kind of where the Fed is guiding to. But I think you're hinting at it here that who knows what happens in the second half of next year, because we will have a new Fed chair. At the moment, Hassett seems to be the front runner, but we're not going to find out, accordingly, per Trump this week until the new year. And I think it's not a done deal until it's actually been announced. He might change his mind. But ultimately, it's going to be someone with a bias to lower rates. But the question is, that individual is just one person on the voting committee. Can they get their colleagues to vote with them?
Yeah, the importance, or at least the focus on whether or not they can influence their colleagues. Just before we move on to the UK briefly, do you think we get to about 3% on Fed rates then, given what you know right now, by the end of 2026? Is that realistic to assume that?
We are looking at an end-year target of about 3.25 to 3.5%,
okay,
but with a significant downside risk if you do have a chair that manages to influence his members.
Okay. How do we think about the BOE post-budget? The gilt markets have been outperforming their European peers, so that on one level is a win for the Chancellor, but maybe that points to investor concerns about the health of this UK economy. How do things stand as you think about the inflation dynamics and the positioning of the BOE?
The Chancellor would definitely be encouraged by the reaction on budget day, the fact that we saw gilt yields fall by about 12 basis points on the 10-year measure, especially given all the concerns going into it. I think that largely reflected that she increased the amount of headroom for her fiscal rules, but there are still many nerves in gilt markets. We might have had a good week, but we've seen in the media that when there's speculation about a potential leadership challenge, you do see gilt markets react, because there's the concern that if Starmer and Reeves do go, are they replaced with someone that maybe isn't as wedded to the fiscal rules? And that's a key thing we're looking out for next year.
And there's space now for the BOE to go further in rate cuts?
We think so. If you looked at the vote last time, it was 5-4, but you could see Bailey was very much on the fence, and it wouldn't take him much more to commit to a rate cut. So we think he will deliver with that vote when they meet it in the middle of this month, especially because now we've had one more inflation print that has actually showed that inflation has come down. Hopefully this peak in this mini cycle is behind us. If he was looking for the budget as a reason to vote for a cut, he may not have got that, because the measures in terms of the fiscal tightening doesn't actually come in for a couple more years outside the Bank of England's forecast horizon. But we think there's enough other reasons to vote for a cut.
Have we broken the back of sticky services inflation here in the UK? How do you project inflation and how that story evolves next year?
Well, next year we have the 20% increase in VAT on private school fees falling out of the comparison. So in January we should see a large step down.
Is that a significant factor in the inflation basket?
It does.
VAT on private schools?
It was a big contributor to the way up. So it's also a factor in our inflation forecast. We're also hoping that the rise in administered prices, such as water bills, aren't as big next year as they was this year, and that should also help inflation come down. But what the Bank of England's also going to be looking at is that underlying inflationary pressure, because that ultimately is going to determine longer-term trends for how far they go on rate cuts. But we think the direction for rates is down.
What would need to get UK economy growing above 1% in 2026? What would need to align for that?
Well, we hope that next year the government's pledges to increase house building, for example, will come to fruition, and we'll see a boost to economic growth that way. We're also, of course, looking to the AI boom. If you can efficiently use that technology, then there's potential for growth to run faster. Of course, if the UK does that, other economies around the world will do that as well. But
if those two things come together, what does UK growth look like for 2026?
We're hoping it's above what we are now. We're hoping, if we can kind of get to the 2%, that would be brilliant for the Chancellor. But that's not our base case at the moment. You have to have the stars aligning to kind of get to a faster pace of growth.
Base case is?
We're looking for above 1.5%.
Above 1.5%. Yeah. Okay. Ellie, fantastic. Thank you very much indeed. Happy Friday. Have a great weekend. Ellie Henderson, economist at Investec. Switching to corporate news now. Bloomberg understands that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. For more on this Bloomberg scoop, let's bring in our deals reporter, Manuel Baigorri. Manuel, how significant then would this be?
Tom, significant indeed, because it's going to send shockwaves in the industry. It's a transformative deal for the entertainment industry, not only in the US, but globally, given how powerful these franchises are. It would be definitely the biggest ever deal by Netflix. They've never done a deal of this magnitude. And it will also, be very, very consequential for competitors, take Paramount, Walt Disney, and others that are also growing in this field. So surprising also, Tom, to see a potential $5 billion breakup fee. That is quite remarkable, and perhaps one of the reasons why Netflix seems to be, according to our sources, pulling ahead of the game here.
Yeah, that's a chunky breakup fee, as you say, $5 billion US. Manuel, you are the deals expert, so what are you and the team watching for in terms of how this story evolves? This all could happen quite quickly, is my understanding.
Yes, Tom, it's moving really fast. We understand that potential agreement could be just as close as just a few days. We may see something announcing over the coming days. But as with any auction, we need to keep our ears close to the ground because things can move quickly in different directions. I mean, the fact that they have potentially signed exclusivity, that should grant Netflix with, enough legroom to potentially get, the terms signed. But you never know. Companies can move aggressively if they feel that they're losing out to a competitor. So I think the next few days are critical, although everything seems to suggest that it's Netflix really the one to win on this auction. But let's keep our ears pretty close because things can unfold in every direction.
Indeed. Bloomberg's Manuel Baigorri, thank you very much indeed on that potential tie-up between Warner Brothers and Netflix and the broader implications for the entertainment space as well. Coming up, European startups, meanwhile, appear to be regaining momentum in 2025. We'll be discussing the state of the sector with Atomico's Tom Wehmeyer. That is next. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Welcome back to Bloomberg Daybreak Europe. The value of Europe's tech sector continues to rise. According to Atomico's State of European Tech report, sentiment among the community is also picking up. 50% of survey respondents this year are more optimistic about the future of European technology than they were a year ago. Tom Wehmeyer, partner at Atomico and State of the European Tech report author, joins me now. Tom, this is something you do on an annual basis, so you have a finger on the pulse of what is happening across the European ecosystem. So thank you for your time. What stands out to you in 2025? What are fund flows into European tech looking like?
Well, I think, as you've just said, this has been a story of growth and momentum this year, rising ambition levels, rising optimism, and I think that's well-founded. We've seen record levels of entrepreneurship in terms of new startups being created, record share of new unicorns minted, so those billion-dollar companies, ecosystem value at an all-time high, and just seeing emerging European leadership in areas from AI to defence to nuclear fusion. And so I think if I look back on last year, there were still a lot of questions about, can Europe really do tech? And I think that question's been put to bed. It's a fact. And now the question moves on to, well, just how big can we take this ecosystem and how fast can we sort of scale that trajectory?
What's the regional breakdown in terms of countries that are drawing the most investment at this point into which sectors?
Well, I think the story that we've seen over the last decade has been technology diffusing all across Europe. So, if I look back to when we started our report 11 years ago, it was, the UK that was dominant. It's still the largest and most mature ecosystem, of course, but who can ignore what's happened in Sweden this year? Silicon Valhalla, just seeing amazing leadership.
Silicon Valhalla, I love that.
Yeah, amazing leadership there in AI, the likes of Lovable, Neko Health, Legora being some of the standout companies that have had great years there.
Is the fund flows into AI crowding out funding to other parts of the ecosystem?
Look, I think it's fair to say that AI's been the dominant theme. You wouldn't be surprised to hear that. It's been led by, some huge rounds into that emerging cohort of European AI leaders. Just the other week, we saw Black Forest Labs, we've seen Neko, as I just mentioned, Legora, Framer, so many big rounds there. But it's been about so much more than AI this year too. I think rockets, robots, drones, advanced materials, energy, these have all been sectors that have helped fuel record levels of investment into deep technology here in Europe.
On deep tech, you need patient, long-term capital. How much of a constraint is that kind of capital for the European ecosystem?
Well, I think this is one of the big questions for next year and the decade ahead, which is how do we basically scale up the firepower that we have to put increased capital behind the momentum that we see in the ecosystem. The reality is that we've been structurally underinvesting in funding the future of growth and innovation here in Europe. If you look at Europe's biggest institutions, they're woefully underallocated to investing in venture capital as an asset class. So pension funds, for example, here in Europe, 0.01% of their AUM currently flowing into European VC. So that's the big opportunity.
0.01%. How does that compare to their US counterparts?
Yeah, I mean, it's significantly higher.
Is it?
And so this is the opportunity. How do we mobilize European assets to fund the future in Europe? And I think what's exciting is that we're seeing a lot of catalytic programs, both at a regional level, but also at the national level, to make that change happen.
I saw Ursula von der Leyen, of course, the European Commission President, speaking at the Italian Tech Week, championing European tech. Is the team in Brussels, actually doing anything on regulation? This fragmented regulatory regime that European tech faces? Well, is anything materially changing, Tom?
I saw that too, and von der Leyen's message was, how do we make Europe worthy of our builders? And I think the good news is that the problems that we need to fix are really well understood. And actually, if you look at the roadmap for the next 12 months in Brussels, there's a whole stream of programs designed to fix the friction that we still see.
Is there? Okay. Over the next 12 months, we could actually see material changes?
Yeah, so, everything from the Scale Up Europe Fund to increase more capital flows to the 28th regime to help address the fragmentation. A bunch of different initiatives on the table right now in design, in discussion. And the question is, will they do the hard things and will they solve them in a way that actually fixes the problems?
Where does Europe compete and potentially win on AI, given the sheer amount of capital being invested in the US. I mean, the gap is dwarfed, isn't it? Where are we best positioned?
I think what's really interesting is that we tend to have this narrow scope looking at the general model builders. They've sucked so much of the oxygen and a lot of the capital out of the room, but this is a vast frontier of opportunity. And if you actually look past, general language models into areas like audio, video, communication, the likes of 11 Labs, Black Forest Labs, DeepL, or even in vertical AI with the likes of with Cradle and Corti, you are seeing emerging European leadership in so many different areas.
Okay, so that leadership is coming through. What are some of the key themes that you're watching for in 2026? If there was a couple of standout either names or themes or regions that you'd be watching for next year?
I mean, it's going to be another story of AI, and then I think the big story is, can we fix this friction? Will we see those policy changes come through, increase capital flows? Because if we do, I think we will help increase the scale of the upside that's possible, and also just help bend that curve and accelerate the growth and the momentum that we've seen this year.
Tom, fantastic. Thank you very much indeed. Really valuable insights in terms of the health of the European tech ecosystem. Tom Weymeier, partner at Atomico and State of European Tech Report author. A reminder that next week, Bloomberg Tech Europe takes a deep dive into ASML, Europe's most valuable company and one of the most important cogs of the global AI supply chain. The episode features an exclusive interview with Christophe Fouquet, chief executive, of course, of the Dutch chip equipment maker. Catch that conversation, 6:30 a.m. UK time next Friday here on Bloomberg TV. It'll also be on YouTube as well, of course. There's a lot more coming up. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
If you look at the communications from the Fed governors and some of the regional presidents, they now seem much more like they're leaning in the direction of a rate cut, which is I believe, the right
And how much would you like it to be?
You know, in the long run, we've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
That was National Economic Council Director Kevin Hassett, of course, and reporting from Bloomberg suggests that he is the front runner to take over from Jay Powell come May of 2026 at the head of the Fed. He also said in that interview with Fox News that he would continue to be data dependent when he was asked how much further he'd like to see rates pushed down if he was to take on that role in 2026. That brings us on to a preview around PCE and the data that drops later today. It is for the month of September, so it's backward-looking to some extent. Well, it is backward-looking, but we know that the Fed will still be looking at this, at least to some extent. Maybe it's slightly less important than it has been in previous months, but you can see the stickiness. Core is expected to come in, core PCE year-on-year for the month of September at 2.8%. The white line is the core, the blue line is the headline number. So as we think about the tariff effects that haven't come through as strongly as many economists expected, there is still this relative stickiness around core PCE. Consumer sentiment survey, consumer data in terms of shopping habits and the move down in terms of pricing is also something that we expect the Fed to be watching. But the PCE data, of course, coming out later today, we'll be watching that ahead of the Fed's decision. Markets almost fully pricing in that 25 basis point rate cut next week. Let's flip the board and have a look at what's happening in terms of the debt load and at least the issuance coming through from the US Treasury. Almost $30 trillion, topping $30 trillion, which is almost 100% of US GDP. There's a total amount of bills, notes and bonds doubling since 2018. So a question mark really in terms of whether that starts to become a pressure point at the back end of the curve. The 30-year, of course, President Trump elected partly on a pledge to reduce the deficit. We're not seeing much evidence of that so far. So that is just a data point to mark. To access these kind of terminals, you can go, of course, on these charts, find them on the Bloomberg terminal and across, of course, Bloomberg TV. You can get those on the terminal. There's a lot more coming up, of course. The opening trade is coming up. Some great interviews as well. Brian Monheim, Bank of America, 9:15 a.m. London time. Stay with us. This is Bloomberg.
Now, you've written that younger people today are not as happy as their parents were. That's in part because of social media and things like that makes people isolated.
So it's a complicated thing, but there's basically a climate and weather problem that we find, and I don't mean that literally. The climate of happiness is all about faith and philosophy in life, about family life, about friendship, and about seeing your life as a calling, your work as a calling that is meaningful and serves other people. And all of those have been in decline. That's the climate of happiness has been ticking down since about 1990. Then the weather, the hurricanes and happiness have been really threefold. Number one was the advent of social media and screens in everybody's lives in 2008, 2009, 2010, which has just raised absolute havoc in the brains of everybody under 35 years old. That's what my new meaning book is about. It's about how we use our brains differently, and it's vacating the parts of our brain that we need to assess questions of meaning. The second is polarization, where baby boomers have tried to conscript young adults into their culture war, particularly on campuses. You should feel aggrieved, you're a victim, everybody's trying to ruin the world, you need to be angry and afraid. And last but not least, of course, is what happened with the really misbegotten reaction to the coronavirus epidemic, which is to send everybody home, make sure that people don't interact socially, and that was catastrophic for happiness.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Global stocks in the green as investors await delayed US PCE data. Fed Chair frontrunner Kevin Hassett calls for a cut next week. The yen strengthens against the dollar and JGB futures fall after sources tell Bloomberg that BOJ officials are ready to hike rates this month, providing there is no major shock to the economy before then. And German Chancellor Friedrich Merz's ruling coalition faces a key vote in Parliament on a pension bill today. This as a group of younger lawmakers from his own party may rebel against him.
Okay, here we go. It kind of feels like the Friday before next week. There's a lot happening next week, BOJ and the Fed, and it's just been talking about that. So today kind of feels a bit like that. We've been creeping towards fresh record highs in terms of equities stateside. S&P futures, pretty similar picture over here on this side of the Atlantic, up kind of 2-3/10% is the broader picture. This is the thing I think you need to pay attention to next week. If there's a surprise coming next week, does it come from the Fed or does it come from the BOJ? If the BOJ raises rates and is hawkish, that feels like it could be potentially a bigger shock to markets. Keep an eye on what is happening with dollar yen right now. And copper continues to push ever higher. I think Citi is the latest one talking about this push continuing. What is interesting is that commodities are moving higher. Break-evens aren't showing much inflation yet. Does that start to change? Copper trading up nearly 2%. Plenty to talk about. The countdown to the opening trade starts right now. Friday the 5th, good morning. We've got a lot on the agenda this morning, but I think it's all mainly focused on what happens next week. Today's going to be interesting. Next week is going to be fascinating. You've got the Fed. Hassett says 25. He's the new Fed chair, it seems. Maybe we should listen to him. Not quite yet, but getting there. And we've got the BOJ. And I just wonder which one of these two things is going to provide the biggest shock. Which one of these central bank meetings is going to provide the biggest surprise for the market next week?
Yeah, absolutely right. We have to wait a little bit longer for the BOJ than the Fed, but we'll see which, where the surprises as we go through December, where they come from. The PCE data is going to be interesting today. That's where the market is focused in the very short term. But you're right, we do feel that we're setting ourselves up for next week. And so the lens we apply to the PCE, it's delayed, it's September, it's pretty old. But does it provide any reason not to cut rates next week? Would seem to be the question that the market is going to be asking around the PCE data. And the words that Bloomberg Economics are using is that it's probably going to just fizzle. It's elevated, but it'll just fizzle, which they suggest means it's not going anywhere very fast, which doesn't sound like the kind of data point that's going to stand in the way of a cut.
But the kind of it's this flow of news in front of the BOJ, which I think is fascinating. It's not next week, it's the week after. I appreciate that, but it's kind of this build-up. And I'm just kind of wondering where ultimately financial markets are going to react as we build towards these two meetings. The BOJ has been this kind of huge source of really interesting liquidity for global markets. The Fed, I think, is obviously the one that's been driving markets more recently. And the rally we've seen, Dan was pointing this out to me a few minutes ago, the rally we've seen in small caps and all kinds of other assets has been largely hinged on this idea that the Fed is going to be cutting by 25 basis points. But if the Fed is hawkish, is that a bigger surprise? Or the following week, if the BOJ is hawkish, or the week after that, is the kind of the bigger surprise? Where does it come from? This kind of drumbeat towards the BOJ, I think, is kind of next week through. It's going to be really interesting.
Yes, and we might not get a resolution to who leads the Fed, and would that be a surprise? That does seem to be that the market is setting itself up for it to be Hassett. I mean, that's a lot of the chatter, at least, and a lot of our reporting suggests that he is the person, and President Trump seems to have nodded towards that. But, we don't count anything as a fact until it is, and so we'll wait and see what happens there. Now, we've talked a bit about the BOJ. Let's dive into that in a bit more detail, shall we, Guy? Because our reporting then is suggesting that our sources saying that the BOJ is ready to raise interest rates if there is no major shock. We have to wait until the 19th of December for this meeting to take place. And so, there is time for a shock before the 19th of December, and there is often volatility around the BOJ just ahead of Christmas. But it's interesting that our reporting also suggests that they are going to indicate that they are ready to hike more.
So that's the bit that I think is really interesting, and that's what I mean about this kind of drumbeat and where the shock comes from. If that language continues, that is a big change, because that tells you that potentially Japanese yields can go higher. Japanese yields that have been suppressed for so long can normalize further. And Japanese investors, this huge pool of savings that exists in Japan, maybe doesn't spend quite as much time looking at the United States and Europe. It maybe spends more time thinking about how it's going to invest domestically. And that liquidity story, which has been so important for global markets, maybe starts to peter out.
Yes, and I wonder when that kicks in, you know, what rate is high enough to attract that money back to Japan? Is it just a question of interest rate differentials between the BOJ and the Fed, or is it more complicated than that? Interesting to think about the politics, because just a week ago, we were only 60% sure that we were going to get a hike in December from the BOJ.
Yep.
Now we seem to be 90% sure. So things have moved a huge distance in just a week. To your point about whether we get a hawkish hike, that would be another move again. And in the context of the politics and whether we get any pushback from politicians on that could get interesting.
The new government appears okay to, and appears to be on board with at least this one hike that's coming through. But the volatility building up to this meeting, I think, is going to be. The language is still being couched in terms of things can change, and you kind of look at the Fed and you think, I think maybe Powell's surprise. There is the potential for a Powell surprise, but it feels that I'm going to be more on tenterhooks now, waiting for a BOJ surprise than a Powell surprise. And I'm just wondering if that's what maybe starts to move things around a little bit as we head in towards Christmas. Liquidity starts to lighten up. That's potentially where the shock comes from. Germany.
Yes, let's talk about Germany, because this is a story that sort of crept up on me at the beginning of the week and now is sort of bubbling away in the background. It might be nothing to see here by the end of today, but it might be something that lingers on. So we've got 7-month-old coalition that is potentially at risk from this pension vote today. Not because the pension vote won't pass. It does seem as if, according to our reporting, that the pension vote will probably pass, even if members of his own party don't all vote with him. In particular, younger members of his party don't vote with him. But in a sense, that is the point. That tells us something interesting about his power base, about his ability to deliver the policy agenda. And that policy of fiscal stimulus in Germany around infrastructure, around defence, is so important for Europe right now.
But don't you think the genesis of this is interesting? In as much as this is younger members of Merz's party basically saying, don't raise pensions, don't spend even more on pensions at a time when we need to spend money elsewhere. And it's the younger cohort that is pushing back on this huge pension spending that is happening. And that has a reflection in what's happening in France. And it also has a reflection on what's happening here. This whole question around how you bring down social security in the UK is basically now increasingly centred around the idea of the triple lock. And this is going to be a problem for Europe. And the fact that Merz is experiencing it so early in his premiership, I think, is fascinating.
Yes, and so this has wider read across then, doesn't it, to other parts of Europe, as you say. There are plenty of other countries struggling with tough demographics, and how you deal with that. Increasingly, this will be a point we're talking about, the younger generation and their take on what's being provided for the older. The extra dimension in the German context is that the AfD is now leading in a lot of the opinion polls. And so that is something that clearly will be in the minds of anybody who is thinking about either rebelling against their party, with their party line on this, or falling into line. And that, the prospect of collapsing the coalition will be in their minds as they make those decisions.
So that's why Die Linke looks like it's going to potentially abstain, which could change the arithmetic within the Bundestag. And again, it's interesting that it's the left, this kind of old Eastern European anti-capitalist kind of roots in Eastern Europe that potentially is going to be voting or not voting in this process to change the arithmetic within the.
And so if you're a CDU leader of this coalition, that's not necessarily something that makes you look strong and in control of the agenda. So that's certainly something we'll watch.
Yep, busy day coming up, a busy week coming up next week. Fed versus BOJ, which one are you going to be focusing on? We've got all of that covered today. Naomi Fink is going to be joining us, Amova Asset Management Chief Strategist, joining us very shortly. Pooja Kumra, TD Securities Senior European and UK Rate Strategist, joining us as well. There's a lot going on at the front end of the curve. Pay attention. Beata Manthi, Citi European Equity Strategy Head, joining us, and Jose Manuel Campa, the European Banking Authority Chair, joining us in the second hour.
Lots to talk about then with our guests in the programme. Some of the things still on our agenda. We've talked about a couple of things. We've talked about US PCE. That is still due at 3 o'clock UK time. That comes. So that's delayed September PCE. We'll also get UMISH sentiment. So a nice take on the US consumer, perhaps. And we get this pension vote in Germany. I think that is going to be crucial, because even if it gets through, as we've said, there's a lot in the politics and the detail.
Noon UK time, 1 p.m. Berlin time, I think, is when we're going to get the results of that. What else do you need to know this Friday morning? Stellantis is touting promising signs of a turnaround at its Ram and Jeep brands after adding more powerful engines and new hybrid options. In comments at a Goldman Sachs conference, the CEO, Antonio Filosa, said the group received, get this, 50,000 orders for Ram pickups with the Hemi V8 engine. Pretty powerful engine, within 6 weeks of bringing that powertrain back online as an option for customers. Veloso also added there's also been huge, quote, huge interest for the new hybrid Jeep Cherokee and for combustion engines powering Dodge muscle cars. Like, muscle cars and combustion engines kind of go hand in hand in my mind. Anyway, Blue Owl Capital has raised $1.7 billion for its latest digital infrastructure fund. Its digital infrastructure trust also picked up interest in 11 US data centers from affiliated entities in a deal valued at $1.5 billion. The firm is making an aggressive push into the space, providing more than $50 billion in data center financing to Meta and Oracle. And Bloomberg has learned that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and HBO Max streaming services to Netflix. Sources say that Netflix is offering a $5 billion breakup fee if regulators don't approve the deal, and the two companies could announce the deal over the coming days. Are they going to be able to win an Oscar, is my question.
That's your question. I wonder, do they care more about winning an Oscar or about, getting one over on old Hollywood, which is what they will be doing either way, by winning an Oscar or this deal.
This will be old Hollywood. This is basically
exactly.
old and new coming together. And so therefore I think that distinction maybe disappears. I think what regulators do with this, I think, is going to be really interesting. Does this change the arithmetic when it comes to the consumer? Is this something that antitrust regulators will look at? It's interesting that the breakup fee is such a prominent part of this, and the antitrust story is going to be sort of front and centre.
What it means for other studios and their distribution, I'm sure, will be part of the conversation. Coming up on the programme then at 11 minutes past 7 here in London, we'll get back to that German story as the German government's infrastructure and defence spending boost lifts the country's medium-term growth outlook. We'll hear exclusively from the CEO of the German defence giant Rheinmetall. That's at 8:45 a.m. London time. Armin Papicher has been on the show a number of times before. Really interesting to get his take on where we are on the defence story and whether the German politics puts that in flux at all. Plus, in a Bloomberg scoop, Warner Brothers is said, as we've been discussing, to have entered exclusive talks with Netflix to sell its extensive film, TV studios and HBO assets to the streaming giant. We'll bring you more details of that with our deals reporter. Up next, we'll check in on markets as Bloomberg learns that the Bank of Japan is ready to raise interest rates at a policy meeting later this month. We'll be discussing that with Naomi Fink, Amova Asset Management Chief Global Strategist. Please get involved in these conversations. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Here we go, 44 minutes until the opening trade here in Europe. This is the futures picture here in Europe. Quiet, very similar to what we're seeing in S&P futures, which are up by, let's call it 0.2% right now. Equity markets, obviously, near fresh record highs. We're at record highs as we work our way towards the Fed meeting next week, which appears to have been pivotal. This move towards 25 basis points, absolutely central for U.S. equities. National Economic Council Director Kevin Hassett giving his take on what the Fed should do with interest rates ahead of that meeting. He made these comments on Fox News.
If you look at the communications from the Fed governors and some of the regional presidents, they now seem much more like they're leaning in the direction of a rate cut, which is I believe, the right
And how
move.
much would you like it to be?
You know, in the long run, we've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
What's the long run and what's a much lower rate? Questions maybe for tomorrow. Let's find out what the 2-year looks like today. Valerie Teitel, over to you.
Well, there was some pressure on the front end yesterday, Guy. We did see 2-year yields creep higher over the session. We are higher still on the week, around 3 basis points. But yesterday's weakness was really around some speculation that Kevin Hassett's nomination could run into some road bumps on the Senate Banking Committee. There is a tight split on the Senate Banking Committee. Just one Republican holdout can really disrupt his nomination. The senator from North Carolina, Tom Tillis, is on that Senate Banking Committee. He was one of the Republican holdouts when it came to the one big beautiful bill. So perhaps his nomination might not be as clear-cut as maybe the market would want. So we did see that weakness in the front end, and on Polymarket, his odds have now dropped from 85% to 75% to becoming Fed chair next year. However, this pressure on the front end didn't necessarily disrupt the equity market rally. We eked out some gains for the S&P 500 yesterday, a 3-day winning streak for the broad index, and we're less than half a basis point away now from all-time highs on the S&P index. Now, we know the month of December, portfolio managers out there really do want to protect their gains and limit their losses. So perhaps if the equity market starts to feel a bit more shaky, we could be due for some profit taking. It's all about what kind of signal could give the market to end up on that nervous line headed into year end. Perhaps it could come from a surprise decision from the central banks that we're still awaiting decisions from. As you guys mentioned, we still have 4 big ones left for the year. FOMC meets next week, and then the Bank of England and the Bank of Japan meet the following week, the week before Thanksgiving. The Bank of Japan is giving us some decent hints we could be in for a hawkish surprise.
That's what this is the story. Going into next week, thinking about the Fed. Is the Fed the surprise next week? What does Powell do? What kind of messaging does Powell deliver? Does it matter anymore going into next year? The BOJ really matters. Do we get 25 basis points as a hike, and do we therefore look for further hikes still to come? It kind of feels like that's where the narrative is. Let's try and develop that a little bit more. Valerie, thank you very much indeed. Joining us now from Tokyo is Naomi Fink, Chief Global Strategist at Amova Asset Management. Naomi, the Bank of Japan strikes me as being the most important event now between where we are now and year end. And next week kind of feels like it's going to be really kind of focused on where we go with this story. Yes, it's the Fed, but the BOJ, this huge pool of liquidity that exists out there in the world, and the Japanese provide a lot of it. And I'm wondering what your thoughts are on not only do we get a 25 basis point hike from the BOJ, do we get more next year? How high could rates go in Japan?
Well, it seems as though the Bank of Japan has signaled that they are prepared near term to hike rates, and I think the market's expecting it now. And so it wouldn't be out of line for Bank of Japan to step in with another rate hike. We know that Bank of Japan is on a normalization trend too, which means that they, in theory, shouldn't stop, even if they do have a lot of room between hikes until they get to somewhere around the neutral range. What is neutral? Well, I think that some of the Bank of Japan signaling says that in real terms, it's somewhere between -1 to 0.5%. So if we add 2% inflation to that, then we get 1 to 2.5. So the lower end of what the market seems to expect now as neutral is 1%. And even if we hike again, we still are short of that 1%. So I would at least expect the Bank of Japan to continue hiking until the lower end of that range.
What does that mean for Japanese pension funds? What does that mean for Japanese savers? What does that mean for the carry trade? Are we going to finally see the repatriation trade beginning to kick in? We saw this very strong auction this week of 30s. Are we starting to do we need to start thinking about that? And what are the implications of that if it were to happen?
Well, if we look at dollar-yen, the yen is very cheaply valued almost by any metric. Even the exporters are not expecting yen this week against the dollar at the end of fiscal year end. So it would make sense for both direct and portfolio investors to lock some of their gains in already. So some degree of repatriation wouldn't be so strange. But I would also add that there still is a decent amount of growth abroad. So I wouldn't expect people to be running for the exits on their overseas investments. I think some moderate degree of repatriation might be sensible to expect.
Yes, should we think about that, good morning to you, Naomi, should we think about that repatriation flow as entirely dependent on interest rate differentials? Is it the pace at which the US cuts, the Japan hikes, and the extent to which we close the gap? Is that what will drive that repatriation trade?
Well, I don't think it should be entirely dependent. No, I think that there is definitely some influence from interest rates, relative short-term interest rates on dollar-yen, but the investments themselves really hinge on whether you think you're going to get a better return overseas than you are in Japan. And in some cases, the answer is going to be yes. In other cases, it's going to be no. I guess where dollar-yen is right now tells us that it's gone a little bit too far. So where we do see those carry trades, the more near-term dependence on where short-term interest rates are, if that adjusts, we should see some degree of return to the yen.
What does the politics look like and the relationship between the government and monetary policy, Naomi, in Japan right now? There had been talk a few months ago about this new prime minister pushing back pretty strongly against the idea of rate hikes. But our recent reporting suggests they might be okay with a hike in December. Where does that leave the relationship and the prospect of any pushback from the government later?
Well, I think politicians, not only in Japan, but in other countries too, they have to walk the thin line between stating their preference and undermining central bank autonomy. And I don't believe that central bank autonomy in Japan has been undermined yet. In fact, we've heard some rhetoric from the government that they do entrust the Bank of Japan to operate policies such as to keep inflation in check. So I think there is a good chance that Bank of Japan is allowed to do their job, keep inflation in check. And long term, that's actually going to help everybody because households right now are suffering from a high cost of living.
Naomi, let's introduce the Fed into this conversation. How big do you think the gap could get or widen between the BOJ, or I guess it's probably narrowing, the Fed is cutting and the BOJ is raising rates. How narrow do you think that gap could get in 2026?
Well, I think that also not only obviously depends on Bank of Japan and Japanese inflation, but it also depends on where we go with U.S. growth and inflation. And right now we are seeing signals that are somewhat conflicting. We're seeing some softening in the employment picture, for example, but we see inflation still riding higher than target, which is also 2% for the U.S. So if we do see inflation ease off a little bit and we continue to see deteriorating employment prospects in the U.S., then we should expect the Fed to continue cutting rates. Of course, if we do see a hang-up that growth isn't as soft and inflation refuses to come down, then we won't see as quick a normalization from the Fed.
Naomi, and with that in mind, with the sort of relative growth prospects of those two economies in mind, we think a lot about what AI might deliver for the growth story in the United States. Get us up to date on what AI will deliver in Japan, the extent to which this technology is embraced, of course, and the speed that you would expect that to have an impact.
Yes, so whether AI is going to have an impact and the speed, I think, are rightly two separate questions. There's a lot of investment going on right now into AI, and I can only guess that a lot of that investment is going to bear fruit. It's just that not all of it is necessarily going to be bearing fruit next quarter or next year. Sometimes it takes a few years for that productivity to come through. When it comes to Japan, there are clear incentives for adoption of AI. There is a declining population and a labor supply shortage. So even as you hike wages, you still don't have enough labor to really fulfill the demand that we're seeing. You know, we have capacity constraints. So there's every reason that there will be continued adoption of AI and other digitization in Japan. And I think that's going to continue for several years yet.
Naomi, thank you very much. Thanks for joining us. Naomi Fink, Chief Global Strategist at Amova Asset Management. Thank you very much for joining us, really taking us to the heart of the Japanese conversation, but importantly, setting that in the global context, what the closing of that rate gap between Japan and the United States will mean for global markets. With global markets in mind, on a programming note, let me tell you, we're going to be interviewing the Bank of America CEO a little bit later on in programming here on Bloomberg Television. Brian Moynihan will be joining the team on The Pulse. We'll be getting his thoughts, of course, on the US economy and consumer. You certainly don't want to miss that conversation, 9:15 UK time. Still ahead on the programme, Germany's Chancellor Friedrich Merz faces a key test in Parliament later today. It's all about a pension bill, which is interesting in itself. The voting around it is interesting, and what it tells us about his wider agenda and his power to deliver it, also of interest. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Half an hour to go to the opening trade in Europe. The focus is on the Fed, the focus is on the BOJ. We've got a lot going on. That is where the narrative definitely is centered. That's where equity markets have been kind of moving over the last few days. Yesterday, we saw a decent session in the States. It's going to feed through, it looks like, into Europe this morning. The S&P futures are up by around 0.2%. Similar picture here in Europe. Maybe up a little bit more. The bond markets?
Yeah, not a huge amount of excitement in the European bond markets. We have seen, though, the Japanese market, the JGB market, responding to our reporting, increasing chance of that rate hike coming through them from the BOJ. That's pushed up yields, certainly at the short end, over on the Japanese curve. It's not having a huge impact here in Europe. We see a pretty mixed picture, actually, between France and Germany. We're either side of the flat line when it comes to the European bond market story. Let's think about the political narrative around these bond markets, though, and go to Germany. The German Chancellor, Friedrich Merz's ruling coalition faces a key vote today. Parliament is to decide on a pension bill, one of the reforms pledged by Merz to reinvigorate Germany. Let's bring in Bloomberg's Europe executive editor, Chad Thomas, who I'm very pleased to say joins us from Germany today. Chad, really great to have you on the programme. So talk us through what's at stake for Merz today, because even if it seems from our reporting that even if he manages to get this pension bill over the line, if he has to rely on the opposition to a great degree, then that still leaves lingering questions about his ability to lead the coalition.
Hi, Anna. Good morning. This really is a key vote for the new chancellor. Remember, we only had an election in Germany in February. He's only been 7 months on the job. Chancellor Merz has a very narrow majority in the Bundestag. It's only 12 seats, and so there are a handful of people within his own party, the Conservatives, who are younger members who are saying that this is unfair, this pension reform, that it's going to push the burden onto the younger generations, and they have suggested that they're going to vote against it. Chancellor Merz has been having difficulties getting legislation through the German parliament since he took office, in part because of this slim majority. If he has to rely on potential votes from other parties in order for it to pass, that will be very damaging for him politically in Germany, with a lot of people asking what authority he has if he can't even get his own party together.
What would this mean? What does this mean? Say today it doesn't go his way. What does the story look like in 2026? How vulnerable could he be? Chad, the whole European premise at the moment, from an investing point of view, is basically based around the fact that Germany is going to be delivering a big fiscal push. Is that in any way being questioned now as a result of what is happening potentially today in the Bundestag?
Well, that is the question here, Guy. Can they deliver on all these things that they have promised? There has been huge optimism, as you say, around Germany that they're going to loosen the purse strings. They have been doing some of that spending, but Chancellor Merz and his coalition partners, the Social Democrats, have said that this would be a fall of reforms and changes, and it just hasn't materialized because they can't muster enough votes and ultimately agree with one another on what it is that they want to do to stimulate the economy here.
Chad, great stuff. We're going to look forward to this. We think the results likely around 1 p.m. Berlin time, so we'll all be tuning in to figure out what is happening at that point. Chad Thomas joining us on this key vote in Germany. A little bit of news coming out of the UK, which I think is probably worth focusing on. Valerie was flagging this to us a little bit earlier on. The UK is to hold no long-dated conventional bond auctions in the first quarter. There's this whole idea, and the Dutch are also part of this story, that we're bringing kind of the issuance story into the front end of the curve. It's setting a timetable of gilt syndications in January, March. That's the quarter that we're seeing. But plans to sell long gilts via via syndication and mini-tender, but no long-dated conventional bond auctions in the first quarter. Let's talk about where we are with the bond markets globally and figure out exactly what is going to be moving us out of this year and into next year. We're joined now by Pooja Kumra, Senior European Rate Strategist at TD Securities. The temptation is already to start thinking about 2026, but I feel we're not quite done with 2025 yet. So let's talk a little bit about what we've still got to come. From a bond market perspective, what do you think has the biggest effect right now? What the Fed does next or what the BOJ does next?
I think Fed, just because for BOJ everyone will be out for Christmas holidays, so...
Okay. That could provide a little light liquidity, though.
We'll still be here, Pooja.
Yeah. Okay.
But I think for Fed, we all are getting fixated about what they do next week rather than thinking about how the dot plot actually evolves for 2026, 2027. And I think that could be a bit hawkish for markets because if you remember September, they were just looking for one more cut in 2026. And the fact that we are reaching closer to their neutral, right? Most of the members are sitting around the 3 to 3.5.
Yep.
I think the key right now for me, worrying part of the markets for next year is that there's no steady path of reduction in policy rates.
Yep.
Because either central banks are at neutral or they're very close to, and they need to find the right balance between the hawks and the doves. So I think that is one thing that's the key challenge. I think the fiscal part of it is something that we've already played this year, so I don't think it should come as a new surprise for markets per se. And
the reason I bring up the BOJ is that last Monday, this week.
It was this week.
This week.
Seems like such a long time ago.
It does, yeah. Beginning of this week, the strength of the 30-year auction caused quite a gravitational effect, here in Europe, but also significantly over in the United States.
No, totally. I think right now, every day we wake up, our curves are moving to what happens in Japan. So definitely it's a key driver for markets. But I think one thing they're doing right this time as compared to what we were discussing 2 years back, they did not pre-announce their policy. Right now, markets are going much more prepared as to BOJ is ready to take action. I think the key for even Japan will be the global financial conditions and how the fiscal plays out, right? Like they're also trying to get more hand of how this new government is exposed to the fiscal side. But it does have repercussions. We know Japan is a big holder of global debt.
Yeah.
They have reduced their holdings across board, but I think it does ultimately come down to the level of yen.
Yes. Pooja, let me ask you, I mean, something that links Japan with Europe had been this expectation that perhaps we see reduced supply at the long end, that investors might be, or that governments might be trying to raise money more at the short end. And in fact, that applies to various geographies, doesn't it? And to Guy's point a moment ago, we've had this confirmation that from the UK, from the DMO, the Debt Management Office, that the UK is to hold no long-dated conventional bond auctions in the first quarter. What does that do to your thinking? Does that sort of drive up demand for long debt that is already out there? Does it, I mean, we understand the reasons why they might be doing this. I mean, how does it play into your thinking?
I think this has been an ongoing thing since the beginning of the year, and it has been supporting the flattening move of the curve. So for me, I still like holding a flattening bias because there's clearly not much buyer base. But I think ultimately how the entire yield curve is driven is more dependent on BOE policies. Will they be able to deliver something that is dovish enough for markets? Because what we are seeing right now is that on hawkish central banks, we are bear steepening, right? The longer end of the curve is reacting more. So supply is one supportive story, but for me, it's more about how central banks place it, because if central banks shift to the dovish side, you create demand irrespective. So I think that is one thing.
And so what do we expect from the Bank of England? I mean, will there be anything to see here in terms of the language we get?
So it is a divided committee, and I don't think at this stage they would totally say that, you know, we are all clear after the budget and we are ready to cut rates. I think they will still have a very cautious tone, and if the tone remains similar to last meeting, I think it could be small bearish.
So do you think, I mean, mechanically bringing down inflation, which was one of the things we got from the budget, will that opens the way to at least one more rate cut?
Yes, that's what I was like. I mean, December cut is done, but I don't think that they want to totally rely on the government policies. They'll be more dependent on wage inflation in the Feb forecast.
Where do you think UK gilts, where do you think long-end gilts are going? I saw a call yesterday for 6%. I.e., the fact that the market at some point is not going to believe that budget and is going to say it was backloaded and the funding's never going to happen and the spending's already occurred, and as a result of which there's going to be a funding crisis.
I think definitely there is a trust element to it, right? I mean, right now, Reeves have got a thumbs up from the markets. Gilt market approved of it. But they are heading towards May election. And I think the key thing right now is, do we see any U-turns in all the measures that they have taken right now? I think what we have done right now is, for gilt markets, the March budget seems they are a bit safe because Rachel Reeves has managed to create a big 22 billion buffer.
Yeah.
But how does that buffer evolve into the May elections? I think that is the key driving part.
Okay, so you bring up the politics, so let's talk about the politics. Friedrich Merz is at risk. His government, this is Germany. This is the kind of the big spending story out of Europe. Keir Starmer's at risk. Emmanuel Macron at risk. Are we discounting, are we ignoring European politics too much next year? Could that, we've talked about the BOJ and the Fed, could European politics provide the turbulence in 2026?
No, certainly. I mean, UK is a bit scary one because we are more reactive to anything that happens.
Yep.
I think for France, you know, since 2024, we have been reliving the 2027 elections, right? So I think the story will repeat itself again. I think Germany is key for us because, you know, the entire year we have been in this hopes that we will have this big whatever it takes moment. And if you see a very fragile government, I am worried that this entire investment spending turns into a consumption spending, and which comes in form of term premium on bonds, right? So I think that is something that I would be more worried about.
Does it show up in bond markets then? Because, I mean, I've seen quite a bit of people talking about the risks around the euro perhaps here, but even that's a bit tangential. Does it really go so far as to impact on bond markets?
I think that term premium element will be there because ultimately markets will be like, we are seeing supply on a daily basis, but where is the growth coming from, right? I think that is something that I would be worried about. I'm less worried about it being as dramatic as what we see in UK moves or French moves. I think markets actually trust the bond market, but it just tells you that the term premium element will continue to increase.
Some of the language from the Germans around the growth story, really quite alarmist. The BDI, that group represents business, talking just earlier this week about the economy being in free fall and talking about the German government not doing enough, even though they're doing so much, but it's not quite yet.
We don't want more.
But it hasn't come yet. This is the problem. And if you look at the data short term, the data in the near term looks really quite poor out of Germany. And you need to correct that pretty sharpish, I think. And you do look at the ECB and think kind of, at some point, if this, how much are they hanging their hat on the idea that Germany is going to deliver next year?
I think to add to that point, they have just added 0.2, 0.3 percentage for their growth in the next 3 years. So they're not depending that much on this fiscal to add to growth. So they are not particularly optimistic.
Pooja, thank you very much. Pooja Kumar, Senior European Rate Strategist at TD Securities. You nearly jumped out of your skin when we mentioned maybe Germany doing more, but that's not the bond market doesn't necessarily want to see that. Right, we'll return to that conversation, no doubt, as we go through the weeks towards the end of the year and into next. Now, let's pivot to Warren Buffett, in fact. The legendary investor and Berkshire Hathaway CEO Warren Buffett is retiring at the end of this year. For many investors, it's the end of an era. Bloomberg Originals looks at how Buffett changed investing forever and what's next for the company he built. Here is a preview.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway.
Greg Abel led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic.
He won't be writing the annual letter next February. This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality isn't matched in the investment world.
Wonderful image at the end of that. Now, subscribers can watch the full documentary on the terminal and Bloomberg.com. It will also be available on Bloomberg's YouTube channels at a later date. Still ahead on the programme, the Stellantis CEO is touting promising signs of a turnaround. More on where the automaker is seeing growth in today's stocks to watch next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Tehran, and this is Bloomberg.
Welcome back, 7:48 here in London, and this is the picture across European equity markets. It looks green. Things are green on the board for European stocks. The Asian session has been slightly green, and US futures also pointing a little higher. Nasdaq futures up by 0.4% as we head towards the end of the week. Let's broaden the conversation then and talk to Skylar Montgomery-Koning from our Markets Live team, who is with us this morning. Skylar, good to have your perspective on the programme. It feels like we started the week with the BOJ. To some degree, we're ending the week with the BOJ as well, with a Bloomberg scoop that sources are telling Bloomberg that the BOJ is ready to hike on the 18th, 19th of December. as long as nothing enormous happens between them, which still leaves kind of half a month. So we will see. But what is your evolving thinking around the BOJ?
Yeah, sure. I mean, I think it's quite funny with the Bank of Japan. We tend to get the policy surprise before the actual interest rate announcement. So they like to well telegraph what they're planning to do. So I think it is very likely that we do get this hike. There were some questions around when it would come because of the fiscal going on there. But I think we knew the direction of policy very clearly. That means it's likely upside for JGB yields. It adds to kind of a number of reasons why JGBs are relatively unattractive within the kind of DM government bond complex. And it's not just because they're hiking as the rest of developed markets ease, but you also look at something like there's this big duration mismatch within the country. So as you raise policy rates, there's a worry that fiscal capacity gets deteriorated more quickly than elsewhere. You also have that a lower ceiling on where the policy rate can go because of that duration mismatch, and it's lower than other places. And so you still have a relatively unattractive yield. And then on top of that, you've got fiscal, which means growth will likely be higher. That's negative for bonds. At the same time, you have more issuance, and the Bank of Japan is reducing holdings. So it just means that you're still kind of relatively unattractive, and it adds to that bias.
Okay, can I just dovetail the BOJ and the Fed? I'm trying to wonder which one provides the bigger surprise. It feels like the BOJ is kind of taking the Fed's playbook of dropping lots of hints beforehand, and we've had one through Bloomberg today. I'm wondering if we get another one next week, just to kind of cement in, as you say, the idea that we are going to see this cut coming. Do they start signaling the idea as well that there could be more to come? And that's kind of wondering if the big surprise, that's kind of the ultimate big surprise here. Is that where the big surprise, or is the Fed going to provide the big surprise? What's priced for the Fed at the moment? Kind of the Fed versus BOJ. Which one should we watch more?
I think definitely the Fed, not only because it has more spillovers to global markets, but I think we've moved pricing very dovish in the last couple of weeks. So if you look at something like 25 basis points being pretty much guaranteed in terms of pricing next week, Kevin Hassett bets rising that he will be the Fed chair, as well as your terminal rate at 3%. It's harder to get lower than that without significant economic deterioration, which means those are three factors that could surprise on the hawkish side as you go into this meeting. So I think that's where you should be watching, especially because you get a new SEP, so you get new dots, you get new projections. And I think what will be key, especially because you have a new Fed chair next year, and we're moving away from this idea that the Fed chair represents the consensus, is a more divided Federal Reserve.
Yeah. And on the subject of the US, PCE later, very delayed. Does the market try to look through this number?
I think it's going to largely be ignored because we've already shifted pricing dovish. This is an old print now. You're also having expectations that core PCE will come in close to 3%. That's a very high bar to surprise hawkishly. And as I said, there's not as much room to surprise on the dovish side. So likely look through it. And the big surprise we're looking for in terms of that hawkish shift will have to be the Fed next week and commentary there.
Okay, Skylar, thank you very much.
Okay, let's talk about, you can get more coverage from the NLive team. And next week's going to be huge. MLive, you go on your Bloomberg terminal. Stocks to watch, we're starting in Germany. Chloe Melly, over to you.
Good morning, guys. So, let's keep an eye on German stocks today, given some of the political uncertainty that we have got going on in the country at the moment. There's a really key vote in the German parliament on a pension bill today, and the stakes are really high for the chancellor because some of the lawmakers in his own party have pushed back against that bill, and that could precipitate the demise of a coalition that's already quite fragile and potentially lead to new elections in the country. So let's keep an eye on some of those key German industries, of course, names across the defense, industrial, tech sector, and see how they react to that political instability this morning. Moving on to Stellantis, and there's a couple of things to keep in mind for Stellantis. Today, on the positive side, we've got an upgrade from DZ Bank, and also the CEO saying there were really promising signs of a turnaround at the Jeep and Ram brands. But on the other hand, the fact the company has refocused so much on the US is causing some trouble elsewhere, and the Canadian industry minister has said that she had served a default notice to Stellantis, and that this was really to protect that car-making sector in Canada, because Stellantis had moved some of the production of Jeeps to the US. So let's see how the market digests both those positive and negative developments for Stellantis. And finally, let's finish on the pharmaceutical sector, and UCB has upgraded its 2025 guidance. This is a biopharmaceutical company, and a lot of that is going to be driven by its skin disease drug Bimzelx, which has been having a really positive, really great performance this year. That's really driven the rally, quite an impressive rally that we have seen over the last year. And so we'll see if we continue on this really positive trajectory for UCB today on the back of that upgrade.
Chloe, thank you very much. Chloe Melly with an update on some of the individual stocks. Swiss Re also in focus. I'm reading that could be moved. On the move, they've announced a buyback, so that could be something we watch. The broader picture, though, does feel a little bit more December-ish, doesn't it? Little quieter, and very December appropriate that we are alert for news from the BOJ, because it seems to be their MO.
Yeah. Are they going to give us enough warnings, though? Is that what we're in the process of doing? The Fed has this history of kind of giving the market very strong hints through the Wall Street Journal. Are we seeing a similar thing being demonstrated by the BOJ, and does that continue in terms of the signaling that we get towards that meeting?
Yeah.
They want to do it before the meeting, it seems. So is it kind of next week, the week after, that those kind of hints continue and the drumbeat towards that meeting continues? Keep an eye on cybersecurity stocks as well out of Europe today. Keep an eye on auto stocks out of Europe today. There's plenty happening as we head into the market open. This is what futures look like, quiet-ish. Single stocks could be more exciting. That's what we're looking at into the open. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
We're nearly there. Fresh all-time highs kind of within view of US equity markets, but yesterday kind of bumped around a little bit trying to get in that direction. We kind of basically just kind of went sideways. This is where Europe went out. We kind of went out here. We rallied a little bit. There's a little bit of headroom therefore on top for the futures picture in Europe this morning. US futures are kind of up a little bit as well, but not by much. So let's take a look at European futures. It feels again like it's going to be a kind of bottom-up market rather than a top-down market. What are single stocks doing? Which key sectors are we going to be watching out for? Futures at the moment kind of pointing us Plus up by around, what, 0.2%? That's kind of the broader picture. Euro Stoxx 50 futures up by 0.2%, FTSE futures 1/10, DAX futures 0.2. CAC's up a little bit more, but not by much. So it's a kind of, it feels like we're in wait-and-see mode. Where does the catalyst come from? Is it bottom-up single stock stories that are going to be doing it? Is it central bank stories? What do we get from the Fed? What hints next week do we get from the BOJ? Does it continue this drumbeat towards the idea that we are going to be seeing maybe this hike coming through? But what is the message beyond that from the BOJ? ECB and the Bank of England we've also got on deck. Plus there's politics. Look at what is happening in Germany. That's a story that we're going to be paying attention to as well. So there's a lot going on, but I do wonder whether today's session, what kind of single stocks are we going to be watching out for?
Yes, well, one sector certainly in focus that you flagged to me earlier, Guy, was the cybersecurity space. So watching European cybersecurity stocks because of Sentinel-1, their forecast for fourth quarter numbers fell short of estimates. So we'll watch to see if there's any read across there. UCB, this is a biotech business, and they seem to be guiding a little bit higher this morning. So we'll see if we get a pop in the share price there. We're also focused on energy stocks. This again is to do with some ratings. So B of A Global Research cutting their recommendation on BP to underperform. So we'll watch to see if that has an impact. Guy.
Okay, here we go. Time for the Friday session. The week is almost closed. It's been a long week. There's been some really interesting things happening this week. Where do we find ourselves at the end of the week? Near all-time highs, certainly over in the United States. Europe kind of drifting sideways as the market opens this morning. FTSE 100 up by 0.1%. I'm interested to see how the CAC opens this morning. Maybe there's a little bit more momentum potentially in that market this morning. What's happening with luxury stocks? But Germany, front and center as well. What's going to be happening in Germany today? The politics is going to be having an influence. This 1 p.m. kind of announcement potentially on this key vote that's happening in the Bundestag today could be crucial for the afternoon session here in Europe. The IBEX is up by 0.2%, the big outperformer so far this year. The CAC's actually not delivering that much on the upside. I was expecting maybe a little bit more, but we're up by 0.3% on the CAC here on. Do we get a little bit more as we kind of start to fully open here in Europe? The DAX and the SMI will wait. We'll see what happens there in just a moment. Anna, sectors, single stocks, what are we looking at?
Yeah, sectors. So I'll start at the bottom of the pack, shall I? And rightly, our team flagging the energy sector to keep an eye on because of that B of A note. And I mentioned BP. It's actually wider than that. They've actually been pretty scathing of BP and Shell. So they downgrade to some degree, both of them. They cut their recommendations on BP and Shell as lower oil and gas prices are deflating refining margins. This is the view of analysts over at B of A, and that has had an impact on the start of trade this morning. So we see the energy sector as the worst performing. BP is one of the fallers within that, so it's down by 2.7%. So we're watching to see what happens with the wider energy space there. So that's the bottom of the barrel. Barrel inadvertent there. Insurance is also not looking great this morning. That sector down. Swiss Re actually down by just over 5%. So there's clearly something in the announcement that they put out this morning. But that's where we are at the bottom. They announced a buyback, which I had mentioned ahead of the open, but that doesn't seem to be pushing the shares higher this morning.
Rolls-Royce, AstraZeneca, EssilorLuxottica, Siemens Energy, Airbus. In terms of the kind of the points, that's where the gains are coming from in Europe. So a little bit of an engineering bias maybe coming through, industrials bias. I think there's a note out on industrials today, actually. Somewhere, I'll find that in just a moment. But elsewhere, a kind of reasonably eclectic mix of stocks. Airbus coming back a little bit. Some of the pharma stocks, which got beaten up a little bit yesterday, maybe coming back a little bit as well.
It seems, and you were flagging the copper price earlier on. That does seem to be pushing the basic resource stocks a little bit higher this morning, even as iron ore prices are a little weaker. But it seems like the copper story perhaps winning out, and the basic resources sector is one of the better performing ones this morning. Let's go to what's going on in bond markets, because yesterday we saw the markets moving, the gilt market specifically moving ahead of an expectation that we'd see the DMO pulling back on issuance at the long end of the curve. We got confirmation of that story this morning, and so actually in the event it seems that the markets don't have too far to move on the news. They moved on the rumour and they moved on the expectation yesterday, and we did see the long end of the curve moving quite substantially yesterday, but that's not the case today. We're seeing a slight move higher in yields, but it's sort of across the curve. Maybe it's already reflected in what we were expecting.
Absolutely. And it's going to be a similar story maybe elsewhere in Europe as well. There's a nice story on the Bloomberg terminal this morning talking about how the Dutch pension reform may force actually governments to migrate towards that front end, which in some ways is an opportunity, but also poses a risk, obviously, kind of as you bring the duration in, just means you're kind of more susceptible to the change in the wind.
Let's talk about what's going on in global stock markets then as we head towards the end of 2025 into 2026. Beata Manthi joins us, Head of European Equity Strategy at Citi. Beata, very nice to speak to you. Thank you for being with us. I'm just looking at some of your latest research, and you say that you remain constructive on European equities. So towards the end of the year, into 2026, what is the key driver that means you stay constructive on Europe?
Good morning. Yes, this comes from our 2026 outlook that has just been published this morning. And the constructive view is based on really many things coming together into the next year, positive triggers, right? So number one, we are having a more resilient global economic growth. It's been very resilient this year, despite the headwinds. We think it's going to remain this way into the next year. There is some softness out of the US labor market. That means the Fed will underpin this constructive outlook with the cuts. We think they are going to cut 3 times. And then domestically in Europe, we are going to have expansionary fiscal policy, finally, next year. This year it hasn't been expansionary yet, it's been restrictive. So we are going to see some of this expansion feeding through into the data. And let's not forget that the ECB easing cycle, that of course has come to an end a few months ago, the effects of that easing will only come through into the economy next year. And we are already seeing it in the outlook for EPS and outlook for broader set of sectors.
So on that fiscal push, we're closely following a vote that's taking place in the Bundestag today, and the German coalition trying to push through some pension reform. And a lot of people are looking at this to give a sense of the authority that the Chancellor has within his own coalition, his ability to deliver his programme, which of course includes a huge amount of fiscal spend. Is that just intact anyway, regardless of what happens with this sort of mini-drama around pensions today?
So what I would say is Germany has gone through seismic changes. This type of changes don't come through very smoothly, right? We knew there was going to be some teething phase along the way. But what I would focus on is the fact that the budget has been approved, the money is being issued and deployed. So things are going in the right direction. And look at the economic data, actually. The momentum of economic data in Europe continues to improve as per our Citi Economic Surprise Indices and underlying data. The data out of Germany today, earlier in the morning, in terms of factory orders,
very strong.
Up, very strong, up, revised up the previous month, and the domestic orders up almost 10% month on month, right? So you can see this fiscal and cyclical revival uptick starting to come through in the data. So that's exactly what we need.
We often talk about the fact that the US stock market is very concentrated, and the Mag 7 has delivered, in terms of the performance, a huge amount. In Europe, it's the banks. The banks in Europe are up 57% this year. The next best performing sector is the utilities, up 25%. Banks, it's all about the banks. You look at the IBEX, massive outperformance this year because of the banks. Are the banks going to deliver again next year? Because that appears to be crucial.
Absolutely. So perhaps you won't have a repetition of such a concentration of and dispersion in terms of sectors' performance that one sector is up 50% and everything else at least half behind. But given this macroeconomic backdrop I've described, this is a very good backdrop for banks to continue to do well, right? And then add to that actually perhaps some sentiment from the corporates picking up, sentiment from the consumer picking up. It's a very good backdrop. So we've been overweight banks, we continue to be overweight banks into the next year. But we also couple it with the sectors that will be beneficiaries of this industrial revival, of the fiscal, and of secular themes that are going in the economy. So today we've upgraded industrials to overweight, we've upgraded basic resources to overweight.
So it broadens out?
So it broadens out, yes.
Should US investors invest in Europe next year? Because the dollar looks like it's going to be a significant factor, a big kind of swing in that story. The IBEX has done very well this year, Spanish market, driven by the banks, up 44%. If I'm a dollar investor, I've done 62% in the IBEX this year.
Absolutely.
Does that tailwind for European equities continue?
the tailwind continues, but could take a different form, right? Because let's concentrate on this dollar. This is a very good point. Let's not forget that actually I rounded out IBAX to the entire European market that has done remarkably well, especially in the US dollars, despite a big chunk of the market doing quite badly.
Yep.
So it's been a market concentrated and driven by the domestic story, therefore banks doing so exceptionally well, right? Into the next year, we see it in the EPS, and the dollar, some dollar weakness into this year will help as well for the upswing in the internationally exposed sectors. So 15% appreciation of euro-dollar has been a huge headwind for EPS of that part of the market, actually dragging the entire EPS for Europe to only 2% from 8% expected at the start of the year. Next year, dollar could be a swing in the EPS broadening, so more sectors doing well from the EPS perspective and therefore performance perspective. And in terms of US investors, I think there continues to be the need for diversification given the volatility related to the rhetoric around AI theme, right?
Yes. Let me ask you about how that plays out for Europe next year. Where do we look in Europe, Beata? I mean, clearly we talk about the companies that make the cables, the companies that do the electrification. There are names we can point to, but and energy businesses. I mean, investing in grids and that sort of thing. Is that where the focus remains on the AI story next year?
I think Europe is at a very interesting crossroads where the broadening of AI, and we think the broadening is not only going to be about the providers of AI, but of users of AI, right? So Europe, with its domestic spend concentrated on infrastructure spend, part of it is build out of data centers, electrification. Our analysts also point out to the physical AI, so robotics in the manufacturing space, right? This is where fiscal spend in Europe, which is quite unique, is going to meet the next stage of AI broadening. So yes, a reason why we've upgraded industrials, because we've been overweight and bullish certain parts of it this year, but we are broadening it out as well.
Two kind of related questions in one, I promise. FTSE 100, is it still cheap? And is it going to be the commodity play next year as I see things like copper moving sharply higher?
So it's cheap versus other regions, but it has re-rated a lot, right?
Yep.
It's not cheap versus its own history. Nothing is in the global equities anymore, and FTSE 100.
Nothing is cheap anymore.
No, well, you can find some selective sectors, right?
Right.
So value is still cheap versus its own history.
That doesn't include banks anymore, does it?
Well, I would say banks are still cheap,
Wow,
despite an outperformance, because they are still trading at single-digit Ps, and they are versus their own history that we look a lot at.
But nothing is cheap. Not even the FTSE.
They are trading in the middle of the 25-year valuation. FTSE is in the 60th percentile right now. So
cheapish.
It's cheapish, yes, absolutely. So basic resources, definitely, as I've just mentioned, we have upgraded it to overweight. However, FTSE 100 is a very specific sector when it comes to the sector weightings, and it has a lot of weight in defensive sectors. Given the backdrop, you want to be more in cyclicals. So it doesn't mean that we are particularly bearish on FTSE 100. We have a decent upside over the next 12 months, 10%. However, on a relative basis, if the market wants cyclicality, continental Europe is better positioned to do that.
Yeah, defensive, but defence and banks have driven the FTSE 100.
Exactly.
This year. Anyway, Beata, nice to see you. Thank you very much indeed for coming to see us, Beata Manthe, bring us her outlook, if I can speak this morning, on next year, joining us from Citi. Core 6, let's talk about exactly what we are watching this morning in terms of some of the individual moves that we are seeing. It looks a little bit like this. We're going to be talking to Rheinmetall very shortly. That stock is down by 1.2% this year. Elsewhere, we are seeing farmers coming back, Nestle a little softer. But let's start with the energy space. A big note out this morning having a big impact in terms of the European space. Let's find out the details of that with Chloe Melle.
Good morning, Guy. Yeah, we are seeing some weakness across the oil sector this morning. So we had JP Morgan double downgrading Eni, and then Bank of America also downgrading BP. So both sets of analysts have said that this is a sector that will have to deal with the risk of oil oversupply coming next year, and that this is a sector that will also be facing those lower oil prices, lower gas prices, and deflating refining margins. And that will put pressure on the cash flow for those companies. And therefore, we are seeing this really drag down those shares, especially for BP, which is down 2.5%, excuse me, this morning. Moving on to the defense sector, and we have got two different stories there, with Rank Group up and Hensoldt down, and that's because of a note from Bank of America, which double upgraded Rank Group whilst downgrading Hensoldt, to saying that there was a really attractive pipeline of opportunity for Rank Group, but that the momentum was probably going to be slowing down for Hensoldt. So it's quite an interesting note that talks about two companies that are within the same country and within the same sector, but with two different stories going forward. Moving on to Greggs, which is up this morning after being rated a new overweight rating by JP Morgan, saying that it's will be a structural winner within that food retail sector. It's up quite strongly on the back of that upgrade. We're up 6.5%. This comes just a few days after news that an activist investor has been pushing Greggs to cut those costs so that it doesn't become a takeover target. But it's a good day for Greggs today. And finally, also a good day for UCB, which has upgraded its guidance for 2025. That is thanks to a really strong performance of its skin disease drug, Bimzelx, and that's really driven that rally over the last year. And we are up also this morning on the back of that guidance upgrade, and we are up almost 6% for UCB.
Chloe, thank you. Chloe Melly from our equities team, of course. Now, coming up on the programme, a Bloomberg scoop, Warner Brothers Discovery in exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. More on that just ahead. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise.
With some fun along the way.
This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. This is the opening trade, 18 minutes into Friday's session, which is delivering some green on the screen for European stocks, making some modest gains. US futures also pointing higher, E-minis up by around 0.25% to end the week. Now, Bloomberg has learned that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. For more on this Bloomberg scoop, let's bring in our deals reporter, Manuel Bagori, who's got all the details on this. Manuel, this is a story that's been unfolding for a while. Multiple conversations have been happening, it seems, at the same time. So how significant would this be if we see Netflix taking possession of this, one of Hollywood's crown jewels?
It is, Anna, a very significant move. Definitely also a surprising one by Netflix, which, as we all know, has been trying to find new sources of revenue and growth after being very successful in the paid streaming, becoming the world's largest. But now, obviously, the company needs to diversify and keep growing, and it is zeroing in on Warner Bros., the TV and film studios, plus HBO, as you well explained. A very remarkable move. It's been ongoing for a while. There's been a sale process there where different parties looking at it, but it seems as if Netflix is pulling ahead, and they just enter exclusive talks, which would lead to a potential deal fairly soon. That's what we hear from sources. So definitely a transformative deal in the entertainment industry ahead of us.
That's all, folks. How big a risk is there that this doesn't get done, that regulators stop it? I'm fascinated that all of the stories flag the breakup kind of fee that is being attached to this. And I'm assuming that's there for a reason. Are regulators going to be comfortable with this deal?
Yeah, that's a really good point, and also remarkable, the $5 billion breakup fee that we are seeing. We understand that they are actually offering just in case the deal falls apart. The regulatory landscape is always a bit of an uncertain one, and it can go either way. I'm sure advisors are spending lots of time going through all the potential scenarios. But it remains to be seen how possible it will be to actually go from signing potentially the deal in the coming days to actually completing the deal. It might be a bumpy road on that front, and that's why also the fact that Netflix has offered that massive breakup fee suggests that could be a breaking point also for them to gain exclusivity.
Manuel, great stuff. Looking forward to the reporting on this. Manuel Bagori joining us on the media landscape and how that's changing. I want to talk a little bit about how the auto sector is changing, because there's some quite significant shifts underway at the moment. Let's focus on Stellantis. Stellantis says buyers apparently are snapping up vehicles in its refreshed Ram and Jeep brands. The reason for this is that they've basically added a whole load of V6s, powerful engines, more options on the hybrid front are also coming through as well. The group apparently received 50,000 orders for a Ram pickup with the Hemi V8 engine in it within 6 weeks of bringing back that kind of powerful powertrain to the market. Let's talk about all of this with our transport reporter, Danny Lee. Danny, the V8 is back, the muscle car is back. Just talk about how this is going to change the outlook for Stellantis.
Yeah, this is a very important time for the relatively new CEO, Antonio Filosa, just to get this restructuring, this massive restructuring, to try and revive flagging sales for Stellantis. And ultimately, it's the recipe that you stay true to in business. Give the customer what they want, whether it be bringing back engines on some of those 4x4 pickup trucks or SUVs, and even to bringing in a whole range of hybrid options. Hybrids in markets such as the US has been very contentious. There is changes in legislation and rules which could affect the outlook and the consumer habits. But when it comes to some of its most important flagging brands, the likes of the Ram and the Jeep, these are critical changes that Antonio is making in order to try and revive the brands. And by making these changes, he is feeling more upbeat about demand, and maybe he's thinking about how this feeds into the rest of the portfolio of brands across Europe that he oversees and presides over. So clearly there is a lot of thinking going on and executing. And as you said, the 50,000 orders, bringing back a model with an engine, that's a pretty sizable success that he's now can assess and see whether that can translate into maybe other changes to other brands.
Yeah, we saw actually the auto sector was the best performing yesterday in Europe, Danny, as a result of a real shift in expectations for what this sector can deliver from here. Much troubled, of course. So what is the outlook for the wider auto sector as we look ahead into 2026?
Well, the wider auto sector is still kind of dominated by this level of Chinese competition. We already see the Chinese automakers really upping their targets to sell internationally. They've had a lot of success in Europe when you see the likes of BYD, who's outsold Tesla. But still, those legacy automakers in Europe, they are struggling in markets like China. That kind of legacy, the luxury story is also a bit of a struggle for some of the likes of BMW and Porsche and whatnot. So there is a challenge there, and so I think we're probably going to model for a little bit of 2026, and as we wait to see a lot of these restructuring and these transformational changes and strategic changes pull through.
But it feels like the Trump administration is backing away from some of the Biden-era emission standards that were put in. You're now starting to see real pressure coming out of Germany for Europe to do the same. Is that going to be the story in 2026, that actually it becomes easier to build old combustion engines than maybe push forward with new EVs?
I think that's a real question, right? Whether, what you see in the likes of the US and whether some parts of Europe, whether that they've calculated that cost, that keeping those combustion engines alive for a lot longer. And of course, I think at the heart of this will be jobs. It's a critical time for Europe, thinking about how to ensure that you keep these economies ticking over. It's those white collar or those blue collar manufacturing jobs at stake. So I think there's going to be a lot of hard thinking and pressure on the executives in the auto sector boardrooms just to see what the US does and how they might be able to follow and perhaps also appease Trump on things such as kind of cleaner, greener engines as such.
Danny, thank you very much. Bloomberg's Danny Lee joining us there with the latest on the auto sector. The auto sector, of course, close to the European economy, Germany, France. France, we're seeing the French President Emmanuel Macron has been making a visit to China. There doesn't seem to be a huge amount to show for the visit in terms of deals announced, but
no Airbus aircraft orders.
There we go. We're always looking for that.
Big aircraft orders.
We're always looking for those. But there are pandas. There are always pandas.
Pandas are really so the French are going to get some new pandas.
That's the biggest smile you've done all morning. I mentioned the word pandas.
He doesn't love a panda. So yeah, it's going to be really interesting. Do we get pandas here in the UK if we get a new embassy, a Chinese embassy? What's on the line here?
Hopefully not in the embassy.
Hopefully not. Well, maybe.
Yeah, I mean,
maybe London Zoo.
Bear in mind that they never belong to the people there.
No, they're on loan.
They're always on loan. Goes back to the 1950s, apparently. Use of pandas as diplomatic ambassadors by China, in this case to France. Coming up on the programme, we're going to talk about the European banking sector. Jose Manuel Campa joins us, chair of the European Banking Authority, the EBA. A new report out today around the risks that they are monitoring for European banks. That's next. This is Bloomberg.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time I went to Peru, trying to culture food, I never had this ingredients never used in Japan. Kind of like a wow, you know, and cilantros, chili, garlic, and olive oils. So a lot of good seafoods, complete a different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi, but Peru use fresh fish, make the called ceviche, cooked with the lemon juice. You know, never use the soy sauce. First time I eat this, kind of the wow. So then after this one, my open eye more, my cooking style that change, combine to Japanese style and another country food, then make novel style.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade. This is Friday, 30 minutes into Friday's session. Happy Friday, everybody. European equity markets are positive this morning, up by 0.3% for markets overall. Pretty similar gains across these European equity markets. US futures have also been pointing a little bit higher. Looks as if we're, at least from this early morning perspective, starting or finishing the end of the week on a high. A lot of volatility driven by central bank policy towards the beginning of the week. Expectations around the BOJ. Does that continue to be a theme as we go through December? The Fed meeting, of course, looms on the agenda for next week, Guy. We've got the Bank of England, the ECB. Plenty of central banking conversations still to be had. So we'll certainly keep those in focus as we look at these modest gains for European equity markets.
Slightly obsessed with the BOJ, and I'm wondering if kind of more hints come next week. They like to pre-warn. They like to keep us on our toes as we go into key meetings. Is that going to maybe eclipse maybe the story around the Fed next week? Plenty of people are telling me no, focus on the Fed, but keep an eye on the BOJ. Huge source of funding for the global economy. Let's talk about what we're seeing in the market this morning. Higher, lower, definitely got a bias to the upside this morning. 412 up, 178 down. Volume is fairly flattish. These are the leaders. We'll whip through these fairly quickly. Novo, UCB, and Banco Santander. Banks have been the key driver. Spanish banks in particular have been the key driver this year. Actually, I think the laggards are more interesting this morning. This Bank of America note on what's happening in the energy space actually having a fairly big impact. Shell and BP are both down on the back of that. BP really quite sort of hit hard by this note this morning. But Swiss Re is also down quite hard as well, down by nearly 6%, 5.7%. It does look as if the return of money to shareholders looks a little underwhelming. The outlook looks a little underwhelming. That seems to be the nod that we're getting through in terms of the reaction to Swiss Re this morning. So its stock is down by, as I say, 5.8%, Anna.
Let's get an update then on some of these central bank stories that we've been covering this morning. Bloomberg has learned that the Bank of Japan officials are ready to raise interest rates at a policy meeting later this month, provided there's no major shock to the economy or financial markets in the meantime. The central bank is also expected to indicate it will continue to raise rates if its economic outlook is realised, while remaining cautious on how far they will eventually push rates up. The German Chancellor, Friedrich Merz's ruling coalition, faces a key vote in Parliament later today. Parliament is to decide on a pension bill, part of the reforms pledged by Merz to reinvigorate the German economy. If the vote doesn't go through, it could precipitate the demise of his leadership only 7 months into its 4-year term. And European nations are looking to lower the length of their borrowing as an overhaul of the Dutch pension system reduces demand for longer maturity bonds. In an early sign of what could lie ahead, Austria's debt chief says this week that it has room to go lower in the average maturity of its debt after years of targeting longer tenors. We had an update from the DMO in the UK with this theme in mind as well, Guy.
Let's bring you a bit of breaking news that we've had over the last couple of minutes. It relates back to actually Friedrich Merz. We'll come to that kind of link in just a moment. But the headline looks a little like this. The US apparently is urging Europeans to oppose a plan. This is an EU plan that we see a loan being used to support Ukraine. And this is the basis of this loan is around the frozen assets, the frozen Russian assets. Now, Merz is meeting the Belgians today, which at the moment the Belgians are effectively blocking this this loan being pushed forward. And it's going to be interesting to see ultimately what comes out of this. But the US, which is in some ways this is one of the few levers that Europe has to pull at the moment, this loan, this critical loan for the Ukrainians. And the US are basically saying, no, don't do that. Yeah. In some ways you can argue this is the US maybe trying to remain in control of the narrative or dominate the narrative. But it's interesting they're pushing back on this particular idea.
Yeah, absolutely. This new line that US has been weighing on some of the European governments to try and oppose this plan is interesting. And we've seen Belgium, of course, being at the forefront of that. Belgium, for their part, they've had concerns domestically that they're the ones that would bear the risk if there were in future legal action taken against Belgium or the EU for having done this. Now, lots of European voices we've heard from them saying, look, we're going to put in place legal systems that mean that Belgium wouldn't have to shoulder all of the legal vulnerability here and all the risk. But that's not been enough for Belgium. And so it will be interesting to see whether Friedrich Merz is taking that message to Belgium when he goes to meet today, or is he mindful of that US pressure?
And it's interesting, the ECB has also kind of backed away from this too. But the European line seems to be basically that the money is here, and therefore it is our responsibility to figure out what to do with it.
Yes.
And Merz's line is, we're not going to leave this to the US. We control this asset.
Yes.
And the US, Washington, does not.
And the ECB hasn't necessarily spoken out against Europe doing this. They just said for their part, they won't break the treaty to enable it to happen. But they've seen ways of doing this without the ECB's involvement.
Okay. We'll continue to monitor this. This is obviously one of the key European stories they're going to be watching today. Let's talk a little bit about what we've seen so far this year. We were talking about this a little bit earlier on the programme. European equity market performance this year has been largely driven by banks. The banking story has been absolutely front and centre. It is by far and away the sector that has driven European performance. Look at markets like Spain, where there has been significant outperformance, and that has been largely driven by the Spanish banks. However, the European Banking Authority, despite all of this, which is a huge positive, is calling for continued vigilance in its latest risk assessment report, citing persistent geopolitical uncertainty, market volatility, and increasing operational risks. That's the headline coming out of it. So let's deal with the details of what we are seeing within this report. The chair of the European Banking Authority, Jose Manuel Campa, joins us around the table. Good morning.
Morning.
Nice to see you again. This is quite. I'm looking at the European banks and how they've done this year. Up by, 57% in terms of the overall performance that we've seen in terms of their share prices. You are, though, kind of in your report this morning talking about the risks, and you are a regulator, so you understandably kind of want to do this, but the language is quite strong. EU, EEA banks remain highly vulnerable to external shocks due to ongoing uncertainty is the line that really sort of stands out to me this morning. I'm a shareholder in a European bank. How worried should I be by what I read here?
Well, if you're a shareholder of a European bank, you're also a European citizen. If you think about the conversation which you were just having about the tensions of the Ukraine war, the fact is that we're in the middle of a war. We have a lot of tensions. There's tensions that have been rising over the last year. So we think that the geopolitical context is very difficult. And that geopolitical context somehow will permeate into the economy if risks materialize. And banks are cyclical industries. They will be exposed to that. So although the overall performance has been really good in the market, and not just in the stock market, also on profitability, on levels of capital, liquidity, low, non-performing loans, that's all looking very good, and that's great. Risks are there, and we need to be conscious.
But do you think shareholders are underestimating that risk?
Well, I'm not sure, because I think what shareholders have been doing is repricing a market that has been very, very poorly performing for many, many years. The banks, the European banks, were systemically undervalued on their equity prices relative to other Western banks, Anglo-Saxon banks. So a lot of that has been repricing, catching up, I would call it. Well, I think it's also good, the economic outlook for Europe right now. Unemployment is good. Growth is not great, but it's not negative. We're not in a recession. Again, there's cyclical businesses. So that's good. So I think that's all good. But nevertheless, and this is a risk assessment report. The geopolitical risk is the area where I think we need to focus. And that can materialize in many different ways into the bank's balance sheets.
Jose, good morning. Is there any particular worry about the German banking sector with all of this in mind? We heard from the German business lobby talking about the economy being in free fall. They're trying to persuade the German government to do more. Germany is trying to do a lot fiscally. Is there a particular concern when it comes to the impact of the conflict in Ukraine, the geopolitical realignment we've seen as a result of that is weighing heavily on Germany?
Right. As I said, the geopolitical risk can filter into the economy in different ways. Our focus has been, we think this is more likely to focus more on those sectors that are more exposed to international trade, international activity. The German economy is very exposed to that activity. I think that's the link that is there, and it's reasonable to think that it will be affected. I don't think that's a vulnerability for the stability of the system, but they're more exposed. Also, if I may, from the previous 2 or 3 years, we've also seen increases in commercial real estate exposures that are becoming what we call early non-performance, stage 2. And that has happened a lot in Germany as well.
I wonder, last time you came in, Jose, we were talking about areas where you wanted more transparency, private markets and the relationship between private markets and the banking sector. That's clearly an area you wanted more transparency. SRTs, significant risk transfers, you wanted to see more transparency there. Are you getting the transparency you need on both of those fronts to assess the risks from those dynamics into the banking sector?
Yeah, if I may, on those 2 examples that you put, the situation is quite different. I think on SRTs, I'm positive. I think we're making a lot of progress. There's also a proposal from the Commission on enhancing the securitization market in Europe, which I think will go in the right direction, and the co-legislators hopefully will approve that soon. So that's good signs. On the other part, I think we still have a big black hole, and I think that we need to continue to focus there in getting more information, better understanding of what the different linkages are, where leverage may be, where liquidity mismatch may be within the non-bank private credit sector that continues to grow, by the way. So that's an area of focus.
Bank of England's doing stress tests or trying to kind of talk to the industry about this. Do you welcome that? Do you think that there should be more of that? Are you thinking about doing something similar?
Yeah, absolutely. I think it's a very good exercise. When you made stress tests, also, I take it that you said to the non-banks.
Yes.
Yes, absolutely. I think that we need to have more information on how that part of the financial sector that's been growing a lot. And I'm not saying that it's all potentially dangerous. I'm saying it's just been growing and we don't know.
But do you think you should do? They're trying to launch. It's a voluntary process. It's not something that is formalised in the same way as stress testing in the banking sector. But do you think you need to be doing more?
I mean, I think both at the global level, the Financial Stability Board is working on this. At the European level, the European Systemic Risk Board, and we're working with them in trying to understand a mapping of how that overall sector is working, what the interlinkages are, and where potential vulnerabilities may be there. And I think that's an area for us of focus, and that we will continue to work in the coming years.
Thinking about risks, I wonder what your take is on, do you think that European banks have become more interested in stable coins? And if so, what is the reason there? Because I've heard lots of suggestions, Jose, about how this actually does link into geopolitics, and it links into the way that the dollar perhaps is becoming dominant after the Genius Act in the dollar stablecoin space, therefore, and that European banks have something to fear from that, and therefore are keener on a European version.
Yeah, no, I think there's big interest. I would distinguish between stable coins. I would also distinguish between technology, crypto technology being used in the financial sector, because you also have tokenized deposits, you have different ways in which the technology can be filtered. But we have seen announcements of projects by banks. Last week there was an announcement by 10 banks, 10 large banks in Europe, putting forward a project to build a stable currency in Europe. We have been seeing interest. I would say that take-up still is relatively slow.
Yes.
But over the long term, I think it's important to follow that.
Is that because, though, of worries about what the Trump administration could do in terms of access to payment systems, or worries about dollar dominance in stable coins?
Yeah, I think the area that's concerning for us is, first of all, we see that there is a difference in approach from the European to the Americans, particularly in 2 areas. Europe has a digital euro project, which they're spending a lot of time. In the US, they have made clear that they don't want to develop a CBDC, a central bank digital currency. Second part, as you said, the U.S. is putting a lot of emphasis on the innovation aspect that the industry can bring. We tend to be more concerned about the risks that the industry may bring. So those are two big differences.
Okay, thank you so much for joining us. Really good to get your perspective on a host of risks, I guess, pertaining to the banking sector. Jose Manuel Campa, Chair of the European Banking Authority. Speaking of the banking sector, Bloomberg will have an interview with the Bank of America CEO, Brian Moynihan. That's at 9:15 London time. So that's certainly worth staying with us for.
You want to stay with us regardless, because we've got some great conversations coming up on this programme as well. In a moment, we're going to take you to Dusseldorf. Armin Papandreou is the CEO of the German defence giant Rheinmetall. Oliver Crook will be in conversation with him very shortly. That's coming up. This is Bloomberg.
Estava sitiada.
Nisso eu começo, eu também não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Nisho tanya ki kon ahna ta suara pangau ahna lepa manchang le nyai kon mamanya.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Welcome back. This is the opening trade, 8:46 here in London. Over to Germany now, and Germany has ramped up defence spending to 108 billion euros, the most since the end of the Cold War. The move aims to bolster the armed forces and equip Germany to tackle a growing threat from Russia.
Peace deal or ceasefire, anyway, both things are strongly connected, but I think still it calls for action in Europe to actually ramp up, fill up stockpiles, and here I see still defense spending. I mean, the plans are there, that the demand is structurally high, which has been confirmed in a couple of meetings I had with German politicians, so we expect that the next 10 to 15 years defense spending will continue.
That was the Hensoldt CEO, Oliver Dure, speaking to us a little bit earlier on this week. Well, our very own Oliver Crook is in Dusseldorf today with another company that expects to benefit from Germany's increased spending. Oliver.
That's right, Anna. With all that spending and the German government in focus into the sort of military, we heard there from Hensoldt. We're happy to hear now from Rheinmetall, the CEO, Armin Papperger. Thank you so much for joining us here at your headquarters in Dusseldorf. I'd like to begin with the sort of flurry of diplomatic activity that's currently happening around Ukraine. If there is, in fact, a peace deal, first, what do you think the prospects of a peace deal are? And second, what does it change for Rheinmetall if, in, say, 2 weeks, there is no longer a war?
I wish that peace is coming in Ukraine because the Ukrainian people, but also the Russians, are suffering a lot in this area. War is really crazy. But I believe with all the discussions I hear, I'm not a politician and I have not the final informations about that, but what I hear from the press is it will be hard that we get peace.
And what does it change for Rheinmetall if there were to be a peace agreement?
Look, we are in negotiations with all the European and all the NATO partners at the moment with contracts. We signed a lot of contracts, and we see absolutely zero impact about that because the Ukrainian business is a business, but it's still a small business in comparison to the rest of NATO. If you see what we do, is there is a possibility to make 1 billion with Ukraine, but that's it, and the rest is growing much faster.
And also this discussion around Russian assets has been a very active one. Do you think that there will be a deal to touch that and get a reparations loans? And again, if they were to monetize those assets, what kind of difference would that make for Rheinmetall, for your business?
This is a political decision. Yeah, it's very hard for industry to say something about that. But if there are reparation payments from the Russian side, or if Europe can use the money, there will be an accelerator. It will not slow down, it will accelerate.
We've heard a lot from politicians really since the beginning of the war, and we've heard a lot about this timeline that Europe needs to be prepared to defend itself basically in the next 4 years. Is Europe a continent that will be prepared to defend itself in the next 4 years, given what you've been seeing in terms of the order books and industry? Are they matching that need?
We are in a good way, on a very good way. And you see what Rheinmetall is doing at the moment. We are building up 13 factories, new factories, or doubling or tripling the capacity of the factories. We are investing a lot of money, and we are able really to grow up the numbers. If it is ammunitions, if it is vehicles, we prepare. Europe industry is prepared. And the governments are also prepared because they spend the budget.
And in terms of assessing kind of soberly what the Russians, for example, are good at doing, what Germany and the Europeans are good at doing, what is Russia better at than Europe? What is Rheinmetall and Europe better at than Russia? And kind of how do you close that gap when you think about kind of the military capabilities that are required?
In some areas, I think the Europeans or the NATO is much better prepared on technology-wise than Russia. Russia is producing higher numbers. But if NATO and if the European countries are working together, we are very strong. And what we should do is prepare ourselves that nobody won't attack us.
And I think that in order to achieve that, obviously, the scale of ambition has to be very large. I would say that Rheinmetall seems to have much higher ambitions than many of the other CEOs that I speak to within the industry. You're building the factories. A lot of other CEOs are a little bit more cautious in their approach. What accounts for that difference in Rheinmetall trying to take advantage of that once-in-a-generation opportunity? Why do you think you are prepared to do that in a way that your competitors are not?
We believe the demand is high for the next 10, 15 years. And I'm not responsible for other companies, so I will speak not about other companies, but we believe that the way that we are doing that is absolutely the right way. We enable the governments, that they can react very fast. We create capacities here in Europe, which are also able to produce a level of ammunitions, of tanks, of electronics, which is on a war level.
And you want to close a lot of the gaps that exist in the European system. You've gone into new territory to do that. Where else do you see gaps, do you think, that Rheinmetall could fill? We've talked about satellites, for example, very recently.
Yeah, we started as an ammunition company. We stepped into platforms. Now we are not only on land platforms, we want to go onto the naval platforms. But everything, the glue between that stuff is digitization. And for digitization, you need also satellites. That is that we go into the satellite business, but we also go in new ammunition types like drones. And we produce this year for 120 to 130 million euro drones. So we are also a huge drone, or one of the biggest drone producers in Europe. But nobody takes care about that because the figures are still too small.
And thinking about the sort of the future and the degree of growth that you were sort of preparing for, there are always growing pains when you are growing at that rate. Where are the growing pains right now? Where are the areas of concern that you need to figure out? Is it labor, getting the kind of people to specialize in all of the things you're moving into?
We get a lot of people. So we have, this year we will have about 300,000 people who want to join Rheinmetall, which is great. And we can pick out 10,000 people because we hire about 10,000 people per year. The biggest problem that we see, don't call it problem, the biggest issue is that we bring the supply chain really under control, that the supply chain can grow like we grow.
And thinking about the supply chain, because that's the lesson we've learned during the pandemic, and we keep learning every couple of quarters. One of the issues in the supply chains that we've had a lot of attention on recently, raw materials, critical raw materials, rare earth metals. How close are you to being completely secure in that domain? How much of that of your time does that occupy?
We check it weekly.
Yeah.
I get a risk report every week on rare earths, on different materials, and we have to check it. And at the moment, we have it under control. Is that forever? I think for the next 12 months, everything is fine. For other materials like linters, we are fine for the next 4 years. So therefore, we do a lot.
And thinking about that risk assessment, do you think about potentially relationships souring with, for example, China, where a lot of raw materials come from? How insulated are you about that? How often do you think about China and its role within your supply chain, and how are you adapting it?
The Chinese part of our defense materials that we have is less than 1%, so it's very small. And China is, at the moment, in different areas, a very reliable partner. In other areas, like rare earths, is that they made a stop, but we can find other sources, so it's possible.
And I'd like for you to sketch a vision for us of this ambition, this massive ambition that you have for Rheinmetall, what this business looks like in 5 to 10 years from now, and potentially also how important you think that that is to European sovereignty, because we've learned what dependencies in Europe look like and the consequences that can be.
The European politicians are very clear about that. We must be a partner of the United States. At the moment, we are not a partner because we invested nothing over the last 30 years. And as I always said, President Trump is absolutely right to say, okay, the Europeans has to invest more. Now they invest. And with that investments, we become a partner, and then we can create also more technologies here in Europe.
And then one final question about the SAFE program within Europe. I mean, there's a lot of discussion that happens in Brussels. Very rarely does it turn into actionable programs. SAFE is one of those programs. It was oversubscribed. How important do you think would it be to get a SAFE 2 program, for example, for the Europeans to push that through? And how much of a difference would that make in satisfying precisely the ambitions that these politicians are talking about?
The SAFE program is a perfect program. SAFE and ASAP. I believe that ASAP 2 would be also very important with the direct investments to the industry. But SAFE is very good for the governments. And the governments now, especially also in the Eastern European side, but all the other Europeans also, Germany is not using it, but it's very important for them really to have safe investments in this area. Great program that the European Union started.
Well, Armin Papegger, thank you so much for your time and welcoming us here in your headquarters in Düsseldorf. That is the CEO of Rheinmetall there, with sketching out his ambitions, not just for the business, but also European defense further out for the next 5, 10, 20 years.
Oliver, thank you very much indeed. Fascinating conversation, particularly in the light of the news we've learned this morning about the US urging Europeans to oppose this EU plan to use frozen Russian assets to continue to fund the war in Ukraine. That obviously a huge geopolitical story that is developing right now.
Yes, and we'll continue to watch German politics with that in mind, with his trip to see the Belgians today in mind, and also what happens domestically in Germany. Will the situation that we just heard described there on German industrial spending and defence spending come to pass based on the politics?
You're going to want to stay tuned. Brian Moynihan is sitting just over there. He's going to be on the pulse very, very soon. Bank of America coming up next with Francine on the pulse. The week's nearly over. Not just yet, though. Plenty still to come. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
A warm welcome from Vladimir Putin as Russia and India seek to deepen their economic ties in the face of pressure from the U.S. president. Bloomberg learns that the U.S. has lobbied several EU countries to try to stop frozen Russian assets being used to fund Ukraine's war efforts. And the German chancellor braces for a key pension vote in parliament that could signal the end of his coalition if he loses. Plus, we have some spectacular guests for you this morning, including Brian Moynihan, chief executive of Bank of America. We also speak to the U.S. ambassador to the EU and the new lady mayor of the city of London. That's also a conversation on regulation and banks. Now, first thing is first, let's check on the markets. And again, there's quite a lot going on. This is the picture overall. Now, the S&P 500 on track to push towards a new all-time high. Investors really tilting towards risk on growing confidence in the U.S. economy and the prospect of interest rate cuts. You see the U.S. 10-year yield at 4.1079. Look, euro dollar 116.53, and then the one we also need to watch out for is copper at 11,639 points. Now, with a rate cut next week all but priced in, there's quite a lot of thinking around what the Fed does next, again, for further policy easing into 2026. Investors now gearing up for a potential year-end rally. So let's get on to the European markets map also to have a look at what the CAC 40 and some of the others are doing. You can see, again, I think a lot of the focus will be on Fed, and so therefore that data from the U.S., the DAX gaining 0.5%. For the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a consequential day for global politics with world leaders on the move against the backdrop of the Ukrainian war. A Bloomberg scoop this morning, the U.S. urging Europeans to oppose EU plans to use frozen Russian assets to back a massive loan to Kyiv. Now, it comes with the Russian President Vladimir Putin in New Delhi as he looks to deepen economic ties with India despite pressure from the White House. Meanwhile, the French President Emmanuel Macron is in China meeting President Xi Jinping with panda diplomacy back on display. Now, here in Europe, the German Chancellor faces a crunch vote that could lead to the demise of his ruling coalition only 7 months into a 4-year term. So joining us now, Julien Lafargue, Chief Market Strategist at Barclays Private Bank. We're also joined by Tina Fordham, founder of Fordham Global Foresight. So thank you both for joining us. I know you're looking at eco and a lot of the data. Tina, you're looking at diplomacy, and it feels like everything's happening at once in these 2 days. Would the U.S. President, actually Donald Trump, first of all, look at Vladimir Putin and Modi in India today?
Well, he was a little bit sad, wasn't he, when they all met up, Xi, Putin, and Modi at the Shanghai Cooperation Organization meeting. He seemed to feel a bit left out. But I actually think the Modi-Putin meeting is important, especially for Modi, who is working hard to show that he won't back down in the face of U.S. threats. But I think the real event is what's happening in Brussels today with Merz and Bart de Wever.
And so what are you expecting there?
I don't expect there to be a breakthrough, but it's impossible to underestimate how important this issue of the use of frozen Russian assets is to the outcome of European security, and then coming on the back of this bombshell new U.S. national security document that was published last night.
Julian, give me a sense of what this means for investors. I know investors have, I guess, seen points of stress, and that's translated into oil because of all the geopolitics. But actually, they're now largely, looking through a lot of the tariffs concerns. Could that come back at the forefront when you see big leaders across the world trying to sign deals?
Yeah, clearly, I don't think we're done with tariffs. Of course, we're waiting for the Supreme Court to express its opinion around the reciprocal tariff. It looks like, we're moving into a much more multipolar world, and so you're going to see alliances form in different corners of the world. And the result is you're going to have much more volatility and headline volatility around geopolitics. So this is something that we expect to continue in 2026, but way beyond as well.
Okay, let's also talk a little bit more about, of course, the visit of Vladimir Putin over in India. Our senior reporter, Dan Strumpf, is in New Delhi. So, Dan, just bring us up to date with the developments there.
Hi, good morning. Yeah, that's right. Vladimir Putin arrived here in New Delhi just yesterday. Today, we saw both Putin and Modi in their first bilateral meeting taking place this afternoon. We don't know exactly the outcome of that meeting just yet. We're expecting a press conference to bring some announcements there, which could happen actually just any minute now. But we do know that economic and trade talks are really at the center of this visit. Both sides have signaled that they are very eager to deepen their trade and economic partnerships, as well as partnerships around areas like migration. Is kind of a real way to sort of show that this partnership between India and Russia is alive and well in the face of pressure from the U.S., which both countries are facing quite heavily right now.
But so, Dan, I mean, is this on oil? Because India still needs quite a lot of Russian oil. And is there a danger that actually Washington reacts quite badly by imposing extra sanctions or try to break the two apart?
So Russia has been a growing supplier of oil to India this year. Now, that's been a real source of strain between the U.S. and India. India has been working to reduce its reliance on Russian oil, and that has come down in recent months. Now, what we haven't seen is the U.S. respond with an easing of its really quite debilitating 50% tariffs on India in response. And so what's happening is that India and Russia are looking to expand their partnership beyond these sort of traditional areas around energy and around defense to include a much wider range of trade in other goods. And for India, that really helps to kind of offset the impact of those tariffs from the U.S.
Dan, thank you so much. Our senior reporter there in India, Dan Strumpf. Julian, again, does this show up in inflation data at the margins if we're going to see more geopolitical allies and blocs coming together?
Well, we haven't seen it so far. If you look at what oil price has done year to date, clearly it doesn't feel like we are in this world where geopolitical tensions are quite significant. It will obviously create some tension, especially if we're seeing more tariff being implemented. But I think at this point it's very difficult to expect more tariff to be implemented as we're waiting for this decision by the Supreme Court.
And Tina, I mean, this also comes, I mean, there are two other things, right, going on at the same time. Emmanuel Macron is in China, so I want to get your thoughts on what that means for Europe trying to, you know, have a better relationship with China, maybe to counter India and Russia. And the other thing is also the German chancellor is really in a sticky spot. So how much does that weaken Europe?
Europe is caught between coercive powers. We always knew that 2025 was going to be a big wake-up call, but the really astonishing turn of events, you know, again mentioning this new U.S. national security strategy, is how the United States, Russia, and China appear to be treating Europe as a diminishing concern, despite being the world's third largest trading and economic bloc, and the way that feeds into support for leaders in elections and everything else really matters. What Macron is doing is hedge America. And similarly, Putin and Modi meeting today are also looking to shore up alliances. More volatility, has been mentioned, but what we're talking about is the remaking of the international global power structure, which won't settle into a new pattern. This is going to be messy for an extended period of time.
And the other thing, Tina, that I want to ask you about is that you're also writing extensively on this U.S. public discontent with affordability in the U.S. Does that really goes against the Trump administration? Are they being blamed for it?
So the affordability crisis is really, top of the list for U.S. public concerns as we head into this midterm year. We had the Tennessee special election take place, and although the Republican candidate won by a very comfortable margin, that district was won by President Trump by 22 points, and it dropped quite a bit. So there's a lot of panic in Republican corners about affordability. What matters is what the response is. At this point, the Republican National Committee response seems to be double down on MAGA, and you've seen President Trump say that affordability is a Democrat hoax and other kinds of dismissive terms. This reminds me of what the Biden administration was saying when Americans were upset about inflation, despite the fact that his administration achieved other goals. And it turns out inflation is really the most toxic factor in politics in developed markets.
And Julian, so what does that mean? It seems that uncertainty is probably the only uncertainty for 2026. So how do you build on that, given what Tina was saying for the markets?
I think, we've just released our Outlook 2026, and frankly, it was one of the toughest ones to write because there are so many wild cards that having a clear view as to how 26 will play out is very difficult. I think you want to do two things. You want to focus on the really strong underlying trends and build on that. And the second thing you want to do is you really want to be a bit more agile and tactical this year because the narrative is going to keep shifting, whether it's tariff, whether it's the Fed, whether it's geopolitics, and there's no way to predict how this is going to play out. So we have to approach every quarter with a different pair of eyes and see how we're going to position for the next 3 months, and then we do that again. I think that's the only way.
So, Julian, do you actually see opportunities beyond the U.S. and beyond AI?
Yeah, I think definitely you want to be able to diversify away from the U.S., away from AI. One particular part of the market that we think is extremely attractive at the moment is everything that is linked to quality. Quality as a style has underperformed massively. There is no reason why you shouldn't own quality if you're investing for the medium to long term. And we see this is where you want to put your focus on, whether it's on the fixed income side or the equity side. Quality is probably the style that we prefer at the moment.
And Tina, what's your wild card for 2026? Does geopolitics really also work through AI and this massive fight between the U.S. and China to be number one in the game?
Well, I would say this, Francine, but geopolitics does cut across all of these topics because, as you've heard me say so many times over the years, geopolitics is about power and power projection. It's not a negative externality, as economists like to talk about it. So whether it's AI, critical minerals, energy security, or these frozen Russian assets and how they are disposed of, it all comes down to this great power competition, and the other countries, middle powers like India, Saudi Arabia, Brazil, for example, really fighting to have their weight and their agency register in the global system. It's tough out there.
Yeah. It certainly is. Tina and Julian, thanks so much for joining us. Julian Lafargue, Chief Market Strategist at Barclays Private Bank, and Tina Fordham, founder of Fordham Global Foresight. Coming up next, we'll be speaking with Brian Moynihan, the Chief Executive of Bank of America. We also have two other interviews you don't want to miss. The U.S. Ambassador to the EU, and of course, a new Lady Mayor of the City of London, also a little bit later on in the program. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance. Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
The conversations that matter, the insights that you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, we've had a data blackout after the longest U.S. government shutdown in history. Investors, of course, closely watching the release of key inflation data a little bit later ahead of a widely expected rate cut by the Fed next week. Let's discuss what it means for the U.S. economy and the banking sector on Wall Street with Brian Moynihan, Chief Executive of Bank of America, which also just laid out new financial targets at its Investor Day last month, its first in almost 15 years. So, Brian, thank you so much for joining us. Congratulations on the Investor Day.
Oh, thank you.
I'll ask you about that in just a second. But first of all, how's the U.S. economy doing, actually? How's the U.S. consumer holding up?
The U.S. consumer is doing fine. And so for the month of November 25 versus November 24, the amount of money are 70 million consumers who's pushed about $4.5 trillion plus in the economy every year. They pushed in about, for that month, about 4.2, 4.5%. And so it was good, and around the Black Friday in the U.S. and the Cyber Monday and all the things they talk about, the spending was solid and good, and it's consistent with a growing economy. Our team has economy growing next year at 2.4%. So Candace and her team, who are the best in the business, that's their thing. But everything we see in the consumer side sets that up.
Is there a worry about affordability? So we hear it from certain pockets of consumers.
Yeah, and there is. And so this is why you have to sort of sort the aggregate economic impact of the consumer, our 70 million consumer spending, versus the different deciles of income and things like that. But if you sort it into thirds, and our institute that writes on this, the bottom third is growing. It's just growing at a slower rate than the middle third or the top third. And so that's what you hear about the K economy and things like that. The good news is, with the unemployment rate at 4.4% or so, the new claims for unemployment is still at a very low rate nominally compared to where they compare it to 19, but the actual labor force is bigger. Those are all good things. So the people are working, they're getting paid, et cetera, but they are worried about prices and affordability, and I think that will dominate the conversation until it settles in.
Would a Fed cut help?
A Fed cut helps, and our team believes the Fed will cut next week. They came to it slowly because the inflation is still higher than the target rates that the Fed would have.
And sticky.
It's sticky, although right when they started raising rates, people told me it takes 5 years to actually squeeze out inflation, and people just aren't patient, and so it takes a while. So it's been coming down, and it's it's sticky. Is that it's not making the incremental progress a little different, but I think the belief is because the labor market's softer, they'll lower rates. That's how our team got there. But we get into the hand-to-hand combat of next month and next week, and the question really is longer term. Our team thinks the Fed gets down to about a 3% Fed funds rate. The 10-year rate sits in 4.25%, 4.5%. And that's a more normal rate structure for the United States. And I think that's not a bad thing. If you have a little higher inflation, a little faster growth, and a normal rate structure, then I think the incentives created by very low rates and stuff are out of the system, and I think people can then act on economic incentives.
And so what does that mean? That animal spirits are back in terms of also, IPOs and M&A, or does it take a while to settle? The market was also a little bit of a tissel because of the possible new Fed chair being Kevin Hassett.
Yeah, I mean, I think you've got to, I walked the trading floor this morning, you've got to sort out people who worry about 5 basis points on the 10-year versus people who worry about the next 50 years of the United States and a strategic view of the world. But if you look at companies, the activity kicked up after the new administration came in because there are a couple things. One was that you could get deals through the system, get them done, especially the United States on it. And that's important. So in our industry, which we are not allowed to make any acquisitions deposits by the law, it's been on books for 30 years. But in our industry, as an investment banking firm, our advice is you can get deals done, and you're seeing the time frame to approve a deal drop by half. And that's important because the idea of a deal being open for a year and a half, that's tough on the companies, and so that's good news. Then the second thing is settling out the major policies that you guys talk about every day on trade and immigration and tax. Those are settling in so people can see that. There's still work to do, but I think that means that companies can look and discount cash flows and make decisions. And then even a rate structure that's higher, as long as it's consistent, they can plan into it.
Brian, you know Kevin Hassett, and you've known him for quite some time. Yeah. What kind of chair do you think he'll be? Will he bow to the president's will?
Well, he's got to be nominated first, so let's let the president do his work and make his decision. But look, I think all the candidates are highly qualified. Our job is to work with them. I think the Fed, as an institution, has to be independent. There's no question that. I think the U.S. Fed is the example for the world of how to run a centralized Federal Reserve with independence. There are parts of it that there's a lot of commentary about the supervisory side and the reach and the activities. That's a separate question. But the Fed independence on monetary policy is key. I think Kevin and all his colleagues that are talked about would all believe that and understand that and drive that.
Brian, there's a lot of geopolitics today. Macron's in China. We have Vladimir Putin over with, Prime Minister Modi in India. There's a lot going on with Ukraine. How do your clients work around this internationally? So you say, some of the tariffs have settled. Yeah. Do they worry about anything more for 2026, or do you think, again, they're ready to do deals?
Well, generally there's things that you look at, you say, I can have an impact on this or control it, or I can make a decision on it, and other ones you can't. And kinetic wars, war in Ukraine, getting the Middle East settled, Israel and the Gaza Strip settled down, the debates around Taiwan, all these things are on people's minds all the time. But the reality is there's not much you can do about it. Trade and tariff is different because that comes down to where they might locate supply chains, how it'll affect the cost of goods sold. And if you watch through the summer, it's become clear that there's sort of 10 to 15% increase is generally across the board result. That's helped businesses understand it better. And so I think that's been worked into their plans. And that's why you're seeing the relief come off from Liberation Day, where people were very confused, to now people have generally said the issues of China national security and stuff are unique. The issues of solving the Russia-Ukraine war are unique, but I don't think businesses sit there and say if that doesn't solve or does solve, if they're in very specific businesses, yes, but generally they're more worried about the ability to address markets and drive. And I think one of the things administrations worked on that gets lost in the percentages and count is the non-tariff barriers. And those are real barriers, both in the EU, frankly, through regulation and stuff, and in China and other places. And working on that is important for multinational companies, not only in the United States, but around the world, because to get access to markets without having to change product is a big deal.
what's your take on the UK? So we had a budget. It didn't 100% go well for all companies, but I think there was a sigh of relief that at least we know what there is. JP Morgan's building, massive building in London. Are you committed to London?
We have 6,000 teammates. We just announced we're adding another 1,000 teammates in Belfast that will specialize in certain areas that we know we can get the talent there and help grow that economy. And so we're in London. We believe in London. We've been here for a long time. It's just part of who we are. I think the UK, London in particular, is a great place for multinational, international operations. So Bernie Menz that runs international is here, and I walked the trading floor today, and the Asian traders and the Middle Eastern traders and the EU traders, and everybody was up and working. And so I think it's a great thing. The key is for the policies to make sure that you distinguish between companies that are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. Because if you're a good place with the rule of law and a great city that London and a great country that UK is, there's plenty of upside in the world where there's not that many places where people can get young kids to go to work. We're just about young kids. Remember, we bring 2,000 kids in from school every year. They've got to want to work in the cities, and so New York and here and other places have a leg up if they just handle it right.
So what do you tell the Prime Minister?
I tell them to make sure the regulation's fair and protect, but also materiality is the hardest thing for governments to understand. We have 6,000 teammates here. It's an incredibly important operation. It's 20% of our revenues. Our international business has grown nicely, but it's 20% of our revenue and things like that. We have hundreds of billions of dollars of capital to make sure things are all right. So if you make it hard to operate, that's when people start to make decisions, or make it uncomfortable for taxation for their workers. That's where they make decisions. Or expats coming in, that's where they make decisions. So I think our advice is be the best place for a non-UK based company to operate, and you'll get companies coming here. And it won't be that people leave, it's just where the next 500,000 people are going to go.
Brian, talk to me about your Investor Day. I mean, this was the first in 15 years. You set up some really ambitious targets. Are you happy with the way it went and the way it was received?
Yeah, it was great. It was a chance to show the hugely competitive advantage we have as a franchise, the moats we have on it, what all the technology spending done. We talked about what we do in AI that people are asking a lot about. We showed that it's actually not theoretical at Bank of America. The Erica will interface with 2 million customers today at Bank of America, which is an AI bot. So we gave that view, and we showed in each of the businesses how the competitive position they have. Their top businesses, number 1, number 2, number 3. They're growing organically, have been. And then the returns come back as the NII and the pricing on the fixed assets. So we talked about our net interest income growing at 5 to 7%. The industry's growing at 2 to 3%. That's really coming from the balance sheet continue to reprice while we generate good organic growth. And it was good. And so we thought the returns would reach 16% return on tangible common equity, moving up to 18. And last quarter we had 15, and we grew EPS, I think 25, 30%. It was a good quarter, and the team does a great job for us.
You know, I need to talk soccer or football. Yeah. I may get my nationality pulled away if I call it soccer, but are you now a football guy? I mean, you're sponsoring FIFA. The World Cup is coming to America.
Well, I have to say, as an American, I am a football person. It's just not the same football. Look, the draws tonight, we're very excited. We are a sponsor. We are the major financial sponsor for FIFA, working with Johnny and the team for the last 4 years now on this. Our team has got a set of programs. Just today we announced that if you apply and get a credit card, you get a chance to go into lottery to buy tickets and things like that. And our clients are excited. The cities are hosting are excited. We're working in the cities. We're working with other colleagues, other companies to put fields in these cities, FIFA and Visa and others. These are all important things, because what we're trying to do is bring soccer into places and have it, when the World Cup goes away, which will be a wonderful event, to have the FIFA World Cup continue through these fields.
Brian, the most difficult question, who do you support if not USA?
Well, we have to support the USA.
I know, but your second team, do you have a second team?
I've got too many colleagues around the world that have come after me for that.
You're going to get the calls, the hate calls. Brian, thank you so much for joining us. Brian Moynihan, Chairman and Chief Executive of Bank of America. Coming up, our exclusive conversation with Andrew Puzder, the U.S. Ambassador to the EU. We discuss the Russian invasion of Ukraine and, of course, competition and regulation concerns in Brussels. That's next, and this is Bloomberg.
for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Tehran, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. A warm welcome from Vladimir Putin as Russia and India seek to deepen their economic ties in the face of pressure from the U.S. president. Bloomberg learns that the U.S. has lobbied several EU countries to try to stop frozen Russian assets being used to fund Ukraine's war efforts. And the German chancellor braces for a key pension vote in parliament that could signal the end of his coalition if he loses. So let's return to our top story this morning. And Bloomberg understands that the U.S. lobbied several countries in the European Union in an effort to block EU plans to use frozen Russian assets to back a massive loan to Ukraine. Now, U.S. officials argued to member states that the assets are needed to help secure a peace deal between Kyiv and Moscow and should not be used to prolong the war. Well, joining us now for an exclusive interview is Andrew Puzder, the U.S. ambassador to the EU. Ambassador, thank you so much for joining us. So because of this Bloomberg scoop, can you just run us through the logic or exactly what the U.S. wants?
With respect to the Russian assets loan? Is that what you're asking?
Yes, Ambassador.
Can you hear me?
We understand that some U.S. officials have lobbied several countries in the EU to block EU plans to use some of these Russian frozen assets. What's behind that?
The first I heard about that was when I walked into the studio this morning. I haven't been briefed on it, and I have no idea.
Okay, Ambassador, do you think, is there a concern? I mean, have you heard about some of your officials briefing, or have you had calls from EU trying to understand what the official U.S. position is? What do you think the official U.S. position is on this?
Well, I don't want to speculate on what the U.S. position is, and no, I haven't had calls from anybody in the EU or the administration on this issue. Again, the first I heard about this was when I walked into the Bloomberg studio this morning, so I have no idea if there's been lobbying or if there hasn't been lobbying or who would be doing it.
Ambassador, talk to me then a little bit about regulation. You've spoken on regulation about the need for the EU to pull back its regulatory burden. What specifically are you referring to?
Well, I'd say the two principal areas would be what's called the Corporate Sustainability Due Diligence Directive, the Corporate Sustainability Reporting Directive, and then the Digital Marketing Act and the Digital Services Act. I think those are really contrary to the EU's best economic interests. One of them makes it very difficult for the EU to get inexpensive energy, which it desperately needs, and the other makes it difficult for it to get the cloud services and the sophisticated AI software that they need and the investment they need here on the European continent to participate in the AI economy. So I'm As the U.S. ambassador here, of course, I'm very interested in advancing President Trump's efforts to make America safer, stronger, and more prosperous. But that doesn't mean we have to leave Europe aside. We want to make America great again, but we'd like Europe to be right there with us, particularly in this AI war. And these regulations make it very difficult for Europe to participate in the AI economy.
Ambassador, yesterday, I mean, we heard a post that was quite aggressive on X from the Vice President J.D. Vance on the EU Commission's plans to fine X for not engaging in censorship. Again, I mean, we understand that the EU, is talking about breaching transparency requirements. What's your take on this? Is it censoring, or is there a way forward?
Well, I will say it's somewhat of a coincidence that every company that seems to get fined with respect to these digital services or Digital Marketing Act violations is an American company, and so I have not the X fine. The news just came out last night. I haven't had a chance to look through and see what the basis of that fine is, but I know the Vice President is very concerned about limits that are unfair against American companies, enforcement of legislation that's really contrary to the spirit of the free trade agreement, where we're trying to eliminate non-tariff trade barriers. When you're singling out American companies for regulatory action, that really is not within the spirit of that agreement. And he's also very concerned with aspects of free speech. The First Amendment is a very important right in the United States, the right to free speech, the right to free expression, and the Vice President is very concerned about violations of those rights.
Yeah, I mean, I think the Commission is talking about, accessing data, misleading users with potential fines. They have not decided yet. Ambassador, do you think it's targeting U.S. companies, or is it just targeting companies that happen to be American?
Well, they happen to be American because the legislation was drafted in a way that would basically cover only American companies. I think there's 8 companies that are covered by this legislation. I think 7 of them are American companies. And the only substantial, meaningful fines that have been imposed so far have been against American companies. So at some point, if you're an American company, you've got to sit back and say, look, am I being targeted here? Or is this an effort to try and advantage European competitors over U.S. companies? And if that's the case, it's something that the United States needs to respond to. And I believe the Vice President has been very active in that respect.
Ambassador, let's also look at the Corporate Sustainability Due Diligence Directive. Where do you see this going?
Well, I don't know where it goes. There's 2 problems with it. One, the big problem is that Europe needs energy. If Europe's going to run an industrial economy, it needs inexpensive energy or reasonably priced energy, and it needs abundant energy. And if it's going to participate in an AI economy, it needs even more energy because you have these terrific energy demands that come with these large data centers. If you're going to be a participant in the AI economy, and both President von der Leyen and Professor Draghi have been very adamant that Europe needs to participate in the AI economy, and the U.S. would like Europe to participate. But when you pass regulations that impose net zero mandates on oil companies, and when those mandates reach not only into the supply chain, the direct supply chains, but the indirect supply chains of companies that really have no nexus to Europe, that don't do business here, don't want to do business here, but are somehow in a supply chain of a large multinational oil company or fossil fuel company. When you make those kinds of restrictions, you make it very difficult for these producers to supply Europe with the energy that it needs. So I think it's a regulation that just is not in Europe's best interest and is not in the best interest of making Europe a prosperous and vibrant economy.
Ambassador, what about steel and aluminium? I know EU exporters, for example, are being hit by 50% tariffs, with 400 items now being subject to this tariff rate. Is there any progress or any sign of breakthrough in this?
Well, the idea with the iron aluminum tariffs, both the United States and Europe now have 50% tariffs. Originally, the United States was concerned that China is dumping steel and aluminum on the market, and we wanted to make sure that these derivative products, the 407 that you mentioned, that they wouldn't contain Chinese steel or aluminum, which could get dumped in America. Now, Europe is saying that's not going to happen, that's not what they're going to do. Our Secretary of Commerce and our trade representative were here in Europe last week and made it clear if we can make some progress on these lawsuits, these regulatory actions against America's tech companies, if we can make some progress there, we can make progress on these derivative issues too. So I think both sides are talking, both sides are negotiating, and I think eventually this will get resolved. I just don't think it's been resolved yet.
Ambassador, I just wanted to go back to Ukraine because today is a very, very crucial day for the EU's plan to tap these immobilized Russian assets to help Ukraine. What do you understand the U.S. position to be today?
Look, this is a European issue. This is something that Europe is trying to deal with. If you want to know where the United States stands on it, you'll have to talk to Ambassador Witkoff or Secretary Rubio or Jared Kushner, who are very involved in these negotiations. I don't want to comment on this area and have some impact on negotiations I'm not involved in. And so it's really difficult for me to comment on it.
I understand. We're just, if the U.S. were to call European countries to try and tell them, like, look, this is not the right way, do you think there's a danger that the U.S. is trying to force Ukrainians to capitulate to Russia? Is this how you would see it?
Well, I'm not going to comment on a hypothetical. I'm certainly not going to give my opinion on an issue where I could actually have an impact on negotiations that I'm not involved in. That's just not that's not something I would do.
Ambassador, thank you so much for your time, and thank you for joining us. Andrew Pusder, they're the U.S. ambassador to the EU. Now, turning to defense, and Bloomberg's chief Europe correspondent, Oliver Crook, sat down with the chief executive of Rheinmetall earlier this morning to discuss the challenges facing the sector.
I wish that peace is coming in Ukraine because the Ukrainian people, but also the Russians, are suffering a lot in this area. War is really crazy. But I believe with all the discussions I hear, I'm not a politician and I have not the final informations about that, but what I hear from the press is it will be hard that we get peace.
And what does it change for Rheinmetall if there were to be a peace agreement?
Look, we are in negotiations with all the European and all the NATO partners at the moment with contracts. We signed a lot of contracts, and we see absolutely zero impact about that because the Ukrainian business is a business, but it's still a small business in comparison to the rest of NATO. If you see what we do, there is a possibility to make 1 billion with Ukraine, but that's it, and the rest is growing much faster.
And also this discussion around Russian assets has been a very active one. Do you think that there will be a deal to touch that and get a reparations loans? And again, if they were to monetize those assets, what kind of difference would that make for Rheinmetall, for your business?
This is a political decision. Yeah, it's very hard for industry to say something about that. But if there are reparation payments from the Russian side, or if Europe can use the money, there will be an accelerator. It will not slow down, it will accelerate.
We've heard a lot from politicians really since the beginning of the war, and we've heard a lot about this timeline that Europe needs to be prepared to defend itself basically in the next 4 years. Is Europe a continent that will be prepared to defend itself in the next 4 years, given what you've been seeing in terms of the order books and industry? Are they matching that need?
We are in a good way, on a very good way. And you see what Rheinmetall is doing at the moment. We are building up 13 factories, new factories, or doubling or tripling the capacity of the factories. We are investing a lot of money, and we are able really to grow up the numbers. If it is ammunition, if it is vehicles, we prepare. Europe industry is prepared. And the governments are also prepared because they spend the budget.
And in terms of assessing kind of soberly what the Russians, for example, are good at doing, what Germany and the Europeans are good at doing, what is Russia better at than Europe? What is Rheinmetall and Europe better at than Russia? And kind of how do you close that gap when you think about kind of the military capabilities that are required?
In some areas, I think the Europeans or the NATO is much better prepared on technology-wise than Russia. Russia is producing higher numbers. But if NATO and if the European countries are working together, we are very strong. And what we should do is prepare ourselves that nobody won't attack us.
The Rheinmetall chief executive speaking with our chief Europe correspondent, Oliver Crook. Now, coming up, we'll be joined by the new Lady Mayor of the City of London, find out how Susan Langley plans to attract investment to the capital next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Welcome back, everyone. Now, Bloomberg has learned that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and the HBO Max streaming service to Netflix. For more on this Bloomberg scoop, let's bring in our deals reporter, Manuel Baigori. Manuel, how significant would this be?
Francine, it is very significant. Indeed, it's a transformative deal in the entertainment industry, not just in the U.S., but globally, right? Netflix has become such a major powerhouse, and Warner Bros. Is such an iconic brand. So it sounds like they're getting closer to the potential sale of the film and TV assets, as well as HBO Max. So that would definitely create a formidable, company in that space, and it will also send some shockwaves for other competitors. Comcast, Paramount, among others, were also eyeing these assets. So definitely a big transaction that seems to be just days away from a potential announcement.
Manuel, thanks so much. Manuel Baigori there with the very latest on Warner Brothers Discovery. Now, the City of London remains a global hub for talent and wealth, but has faced challenges over recent years. Well, someone tasked with improving the outlook is the new Lady Mayor of the City of London, Susan Langley, who joins us now. So, Lady Mayor, first of all, congratulations on the appointment. You come adorned with...
I come adorned with, yes, an awfully large badge. Yes, I do.
I mean, an awfully large badge because you have, an enormous job, actually. What do you hope to achieve over the next year in trying to promote London's financial services to the world?
Well, the role of the Lady Mayor is the ambassador for financial and professional services in the City of London and for the UK. And I like to think of the Mansion House as the embassy for FPS. So really, my role is to promote the city, 100 days overseas, travelling as global ambassador. But for the city, we have to focus on matching capital with opportunity, and that's both financial and also human talent.
Yeah, so what will you focus on? How do you attract more talent to the UK? Finally, we had the budget. It feels